Students, first I will explain what are the topics we have to study at the final level for DT to get exemption mark. Okay. So there are two parts: domestic taxation and international taxation. When you study, there are two ways. Either you can start from domestic taxation, finish it, then go to the international taxation. Or otherwise, start from international taxation, finish it, and then come to domestic. See, as you are completed inter and coming at the final level, it will be better to start from domestic taxation level, because international taxation, some of the chapters are that will be totally new for you. For example, transfer pricing, double taxation relief. In all those chapters, the questions are coming not at the primary level. They are asking only at depth questions they are asking. So it will be better to start from domestic and finish and then go to international taxation. Both way I can start. So I'm planning to start from domestic tax and then go to international taxation. International taxation, you should not make any choice. Compulsorily, you have to finish all the chapters in international taxation, especially the core chapters. First one is NR taxation. Just I will tell you the core chapters you have to study. Do not select any topics in between these chapters. You have to study 100%. NR taxation, the first chapter, international taxation, very important chapter, and then transfer pricing, TP, and then double taxation avoidance agreement or double taxation relief, then authority for advance ruling. Earlier there was a chapter in international taxation, but now it has been moved from international taxation topic and it will be included. It has been included in domestic taxation, that is digital taxation. The topic is equalization levy. But remember, for January 2026 exam, equalization levy is applicable. But from May 2026 onwards, equalization levy is completely deleted. They withdrawn that provision due to its complications, and a lot of industry is seeing a lot of complaints about that. So they withdrawn equalization levy. So for Jan 26, equalization we have to study. So I will take equalization levy, but if you are writing exam in May 26, remember that is no more applicable. Now these four chapters in international taxation, therefore out of 30 marks, around 20 to 22 marks they are asking from these four chapters. Then some other chapters are there, that is model convention, double taxation avoidance agreements, models are there, formats are there, United Nations model, OECD model, US model. US model is not applicable for CA final. UN model and OECD model, and these two models comparison, how the double taxation avoidance agreement will look like, and what is article 1, what is article 2, what is article 3, what is the major difference between UN model and OECD model. Those topics they are discussing in a chapter, that is model conventions. Not that much important, some 3 to 4 marks they may ask. In some attempt, they are not asking at all. And then there is BEPS, base erosion and profit shifting. High tax countries and low tax countries are there. So multinational companies or large corporates, they have a practice to show less income in high tax country and divert the profit from high tax countries to low tax countries, thereby evading the tax. That is known as base erosion. A country's right of taxation or a country's tax base is eroded, and they are booking profit in low tax countries or tax haven countries. So to prevent that, OECD, Organization for Economic Cooperation and Development, that OECD association, they put some action plans, action plan 1 to 15. There are two levels, BEPS 1 and BEPS 2. So BEPS 1, basically there are 15 action plans, and BEPS 2 is a follow-up of BEPS 1. So that 15 action plans is there. Basically it's look like a theory, but actually it is a policy. Some of the BEPS action plans has been accepted by India and put some amendments in income tax to make it par with this BEPS action plan. So that is BEPS. It's a theory area. Last time also they asked some questions in BEPS. And then these are the two other theory chapters, and one more theory chapter is there, interpretation of double taxation ordinance agreements or interpretation of double taxation convention. So purely dry theory. You can give maximum 2 or 3 hours. Some main concept you have to study. That's enough. So these three, I will say, less important for your exam point of view. You have to study, but not called as this first topic. This is very, very important. Very important. Cannot make any choice. All these 4 chapters, concept, even problems, past year questions, RTP, mock test, even a question in case scenario, all these things you should be very well, you have to study. And now case law, when it is come to case law, in this area, only some few case laws in NR taxation. In transfer pricing, not that much case laws. DT relief also some old landmark decisions, some 2-3 decisions. Authority for advanced ruling also 1 decision. So these are the maximum, some 8 to 10 case laws. We will do case law separately. Okay, we will discuss case law also. So this is international taxation. To study NR taxation, you need a very good idea regarding heads of income, right? Because NR taxation means assessment of non-resident. So assessment of non-resident, we have to study how to compute the normal income under the provisions of income tax law. So you have to study PGBP, capital gain, income from other source, set of provisions, even chapter 6A. So NR taxation, even though it is a pure topic, we need some knowledge in other topics also. So that is why always it is better first finish domestic and then come to international taxation. It is possible to study international taxation separately from the very beginning itself. You can start if you are confident in set off chapter 6 and all those topics, then you can start NR taxation fresh also, no problem. But what I am planning to do domestic taxation first and then we will go to international taxation. So remember these first 4 chapters is a must. The other 3 chapters second priority, right? After finishing these first 4 chapters, then we go to the second priority chapters. Domestic taxation. Salary, I am not recommending to study because at the CA final level, salary is not required. But I can do one thing, 1 hour or 1.5 hours, I can spend some time for salary to get an overall idea how salary is working, because probably you studied at the inter level only, right? A lot of time. So you are not that much memory, right? You know. So just will refresh. The major areas at the final level in domestic taxation, first PGBP. Each and every section, you need a very deep knowledge. PGBP, then capital gain, and then IFOS. I will take in detail all these topics, right? So PGBP, capital gain, IFOS. Clubbing of income not important at the final level, but sometimes they may ask a question in double taxation ordinance agreement with the clubbing adjustment, or NR taxation problem with some small clubbing adjustment. So basics of clubbing. So I can take that. Half an hour we can spend for that. We can cover clubbing. Set off. There are 2 levels. First one is basics of set off. So what are the rules of set off? You cannot set off PGBP against your salary. Capital loss cannot set off any other head. So these type of basic rules. That is first part. Then we can spend some 1 hour or 1.5 hours. We can finish that. The second area is the core area. Set off at the final level, especially section 72A, 72AA, and 72AB, and section 78, and section 79, and section 79A, and section 80. So that is very important. Restructuring, business restructuring, amalgamation, demerger, conversion of company into LLP, proprietorship is taken over by a company, partnership firm is taken by a company, and inheritance. And when a partner is died or retired, what is the impact of losses of that firm? All those topics are the core area for finance. So this area you have to study in detail. You have to do questions also. Then chapter 6A. Chapter 6A, even though it is an inter topic, we have to study in detail 80C till 80U. And some of the sections at the final level, we have to give more important in section 80JJ. Section 80 LA, and section 80 IAB, section 80 IAC. Sometimes in some attempt they are asking ATP, cooperative society. Then 80 intercorporate dividends. These are the core area. But other sections also you have to study. ATC, CCC, CCD, CCE, G, D, DD, DDB. All those sections also you have to study. But this area is not. So now we got the total income, right? PGBP, capital gain, IFOS, set off. We got GTI, gross total income. Reduce chapter 6A, we got total income. And now what? Now assessments. So company assessment, the most important area where compulsory question regularly coming from this topic, company. So company assessment is very big area because normal computation of a company, then MAT, minimum alternate tax. When it is come to MAT, there are two levels. A company which is not following Ind AS, which is following accounting standard, how you will find out the MAT computation, book profit and MAT computation, that is tax liability of a company. And if that company is following Ind AS, it's an Ind AS compliant company, how the MAT will be computed. So there are two areas. Normal company without Ind AS and company with Ind AS, that is MAT. And then there's one area. Another area, questions clearly saying, ignore MAT, compute total income and tax liability of the company. Regular question. Regular provisions of income tax law. A company will have maximum 4 heads. HP, PGBP, capital gain, IFOS. Set off some provisions. GTI, chapter 6A, maybe 80G or maybe 80 JJAA, 80F, all these type of chapter 6A. Total income, compute the tax. Either 30% or 25%, depends upon turnover of that company in financial year 2020-23. If the turnover in 2023 exceeds 400 crore, 30, otherwise 25%. Compute tax, surcharge 7% or 12% surcharge applicable, then says tax liability. Over. This is a regular question without any MAT adjustments or without any concessional rate of taxation provisions. Just normal total income and tax liability. I think last time also, this September 25 attempt also, they asked the normal question without any concessional provisions or MAT. Total income and tax liability. That is one area. Second area, MAT computation. If they are asking MAT computation, the possibility to ask total income as per regular provisions is less. And in very rare cases, they may ask both. That is pakka practical. What is a tax liability of a company? Tax liability of a company means tax computed as per the normal provisions of the income tax law, or MAT, whichever is higher. That is one area they may ask, very rarely, right? Recently, they are asking either MAT computation or total income computation. They are not asking both. But there is a possibility in 2016, 17, 18 years, while they are asking questions, it will be like that. Compute total income and tax liability of the company. They will not say ignore MAT. You have to do MAT also. That is one area. The second part, the recent developments, that is section 115BAA and 115BAB, concessional rate of tax. One for new manufacturing companies, which is started before 2023. And the second one is existing companies, they can opt for 115BAA. So there are two sections, BAB and BAA. So that two section concessional, there will be no MAT. Because if a company opting for section 115BAA or BAB, they are not liable for MAT. So that is another area. And then there is a taxation on buyback applicable to domestic company. But this buyback tax is not applicable with effect from 1st October 2024. So for Jan 2026 exam, there may be a possibility they may ask a question on buyback. From May 2026 onwards, buyback is deleted. That's withdrawn. No more buyback for company. No more buyback tax. And in this attempt, that is September 2025 attempt, they already asked the questions on buyback. So we can say that from January 26 onwards, they won't ask. For January 26, they won't ask a question on buyback. That is sure. This time they already asked. So from 1st October 2024 onwards, instead of buyback, there will be a new dividend. That is section 2, subsection 22, subclause F. That is, any consideration received by a shareholder upon buyback will be treated as dividend in the hands of the shareholder and taxable under IFRS. So company is not liable for payment of buyback tax. So these are the area related to assessment of company. Normal total income and tax, MAT, company following NDAs or not following NDAs, 2 types of MAT, and then 115 BAA, 115 BAB. These are the area, and along with the company assessment, we have to study ATM, intercorporate dividend, chapter 6 introduction. So this is the area of company, one of the most important area. The firm or LLP. So firm or LLP, another important area. After company, the next important area is firm or LLP. Usually they are asking questions, compulsory question based on company assessment, but in some attempt they are asking compulsory question instead of company, they will make it as a firm or LLP. And there is another possibility, one compulsory question from company and another they may separately they may ask a question on assessment of firm or LLP. That is also possible. So firm and LLP, the main area is section 40B along with some recent judicial rulings, case laws, and another important area related to firm or LLP assessment is AMT, alternate minimum tax rate. So this is firm. Actually, AMD applicable for any assessee which is not a company. But remember, for exam, usually they are asking AMD along with the firm or LLP. So this is another important area. Then assessment of individual, not that much important. Very rarely they are asking because individual assessment is a main topic in intermediate syllabus. But sometimes they may ask a questions on individual assessment. Usually what they are doing is individual assessment question they will connect to this double taxation. So when they are asking a questions on double taxation relief, it will be for an individual, right? Individuals, Indian income, foreign income, and there will be double taxation and how the relief will be computed. So in that question, there will be a lot of chapter 6A, all those things. Even section 115 BAC, that is default tax regime, all those things they can connect with the DTA question. Separately, they are not asking the questions on individual assessment. Then assessment of charitable trust, mainly section 11, section 12, section 13. That is charitable trust. That is also another important area. Every time they are asking a very good question from trust. So when it is come to assessment, the another area is some special entities, that is real estate investment trust or infrastructure investment trust or alternate investment fund, AIF. So these are the another last area in assessment, and sometimes they may ask questions on AOP, Association of Person. This time September 25 they asked the questions from Association of Person assessment, AOP or BOI. So these are the, and very rarely they may ask a questions on political party. Very not that much important. Sometimes they may ask political party. So assessments are over. So this area we can say out of 70 marks domestic taxation, you can expect 20 to 25 marks or maximum 30 marks from these topics. Then TDS, TCS, very important, especially TDS and TCS, very important. TDS, TCS, advanced tax. Then return of income and assessment procedure. Return of income and assessment procedure. Then appeals and revision. Appeals and revision. And then penalty. Penalty, especially section 270A and 270AA, all those. Computation of penalty, calculation of penalty, immunity from penalty and prosecution procedure, all those things, that is penalty. And in assessment procedure, we have a knowledge regarding searches. Okay. And these areas, purely they will ask a questions either based on recent amendment or based on a recent judicial rulings, or if they are not covering any of these topics, that is either the question based on recent case law or the question based on recent amendment in this area. If they are not asking in that area, definitely that question will be a very depth question, practical application of these areas. So 100% questions are based on analytical manner, right? Practical oriented question. There will not be any direct question in any of the topic. Do not expect a direct question. If you know the provision, by reading the question within 5 seconds, you will strike the answer. Okay, this is a solution, right? This is what they are targeting. Whatever you are writing will be 100% correct. If you are thinking for 2-3 minutes, definitely your answer will be wrong. So every question is based on practical argument. Right? If you cover these areas, definitely you will get 60 plus in DT. Remember, DT is a very vast paper, just like ocean, right? Very vast paper. I think this is the biggest paper in CFI. After you can say far. To some extent, IDT also bigger. DT is very, very vast paper. So if you very well studied these areas, and out of this area, please don't skip any chapter, right? All this you should be studied in a very detailed manner. Understand the provision, recent judicial rulings and amendments, problem solving. Enough. Okay. I will start from here. PGBP. We'll go this order: capital A, IFO, SEPRA, Chapter 6A, formal LP, and then trust, then these various areas. After finishing this area, again we will come to this order: NR taxation, transfer pricing, double taxation relief. Authority for advance ruling, again it's purely some law. No practical application problems, right? No numericals, just some application of law, procedure, who is the eligible applicant, all those things. Easy. 2 hours is more than enough to cover AR. Then our taxation, we need some 2 days or maximum 3 days we will require for NR taxation. TP, similarly 1 day or 2 days. DT relief 1 day. But authority for advance ruling, some 2-3 hours is enough maximum. And then this theory area also we will discuss. Okay. So this is the plan. Any suggestions? You okay? Yeah. And we will start with the PGBP, right? Even though you studied PGBP, remember I will take at the final level, right? In detail. In detail. There is a section under the income tax law, section 145. As per section 145, while computing PGBP income and income from other source, you have to maintain the books either mercantile system or cash system of accounting. When it is come to CFI, remember corporates, companies, as per Companies Act, mercantile system is compulsory. So for our area, CA final discussion, remember every corporate has to follow their books of accounts under mercantile or accrual system only. They cannot follow cash system. But regarding partnership firm, LLP, AOP, BOI, individual, etc., they have an option, either mercantile system or cash system, they can follow. When it is come to tax law, hybrid system is prohibited. Hybrid system is not possible. Either mercantile or cash system. Okay. But for exam point of view, remember, for companies, definitely there will be mercantile. Because as per Companies Act, they have no option. Mercantile is mandatory. Others, cash system they can follow. And now, while computing PGBP income and income from other source, sir, why it is saying like that? What about salary? What about HP? What about capital gain? Remember, salary is taxable on due or receipt, whichever is earlier. Whether you receive or not, if it is due, taxable. You received it, but not due, taxable. That is why advance salary at the time of receipt, it is taxable. But regarding salary for the previous year 24-25, it's due, but not received. Received only in 2026-27. In 24-25 itself, it will be taxable because it's due. So as per section 15, salary is taxable on due or receipt, whichever is earlier. What about HP? There is a building. Asset is the owner of that building. And that property, you let it out. Then gross annual value will be taxable. Whether you receive the rent or not, it doesn't matter. Okay, if there is unrealized rent, then it is okay. If there is vacancy, okay. But the property let out, tenant is there, rent is due, we will get the rent. Okay, then on due basis, it is taxable. Whether you receive rent or not doesn't matter. So, method of accounting is not relevant for salary, not relevant for HP. Capital gain, okay. If there is a capital asset, you transferred it, then capital gain arises. Only in conversion of capital asset into stock in trade, capital gain has to be computed only at the time the stock is actually sold. In case of compulsory acquisition, you have to compute the capital gain only when you received the compensation, any part of the compensation, right? Except these two situations, in all other cases of capital gain, if there is a capital asset then transferred, whether you received money or not, you have to compute capital gain. Method of accounting is not relevant. But PGBP, IFRS, method of accounting is very relevant. Either mercantile or cash system, which should be consistently followed. Frequently do not change method of accounting because Income Tax Department will object. Because as per section 145, regularly employed. There should be some consistency, some genuine reason for shifting the method of accounting from one to another. Okay, they will be accepted. So without any proper reason, you cannot change the method of accounting frequently. Current year mercantile, next year cash system, then again mercantile, again cash system, not possible. Now, while computing PGBP and income from other source, you have to follow ICDS, Income Computation and Disclosure Standards. Income computation and disclosure. The purpose is very clear. Your books of accounts may be prepared based on accounting standard or may be based on Ind AS. But when computing income under the tax law, you have to follow ICDS, Income Computation and Disclosure Standards. It is only for the limited purpose of computation of income under tax law. It is not for the purpose of maintenance of books of account, because books of accounts are maintained based on either accounting standard or Ind AS. So what is the problem? The financial statements are prepared, or statement of profit or loss is prepared based on Ind AS or AS. The same year, while making tax computation, we have to follow another set of standards that is known as ICDS 1 to 10. So there will be a big conflict between the two. The treatment in AS will not be accepted in ICDS, and the treatment in ICDS may not be acceptable in AS. So there will be a complications, right? There will be contradictions. So we have to reconcile while computing income tax law. So that is very important at the final level. Remember, inter level ICDS is not applicable, but for final ICDS is mandatory. In some examinations, they are asking ICDS adjustments in the compulsory question, assessment of company. But in some attempt, they are not asking at all. I think in the current last attempt, September 25, they didn't ask any questions on ICDS. Even last September also they didn't ask. But in some examination, they asked some 2-3 ICDS in one question. So we cannot take a chance. We have to study ICDS 1 to 10. Out of that ICDS 1 to 10, some 4 or 5 standards are very, very important. We have to go in deep level. Other ICDS, just to know the working, that's enough. So as per section 145, ICDS 1 to 10 compulsorily to be followed while computing the income under PGBP or income from other source. Even IFOS also, this ICDS is mandatory. But regarding other 3 heads, ICDS is not applicable. Only as per the income tax law, you have to compute, no separate standards. Now, if we are not following section 145, not complying 145, what is the consequence? As per section 144, the income of that assessee will be computed by assessing officer based on best judgment assessment 144. Further, there will be penalty also they can impose. So, best judgment assessment, what does it mean? According to the judgment of the assessing officer, he can compute the income. What is the implication? The implication is assessee will not get any relief. As per section 144, if there is a best judgment assessment, assessee should not be given with any relief. Even refund cannot be claimed in best judgment assessment. Definitely the income will be more. You have to pay more tax. You won't get any deductions or benefits otherwise, which will be available. But under best judgment assessment, you won't get any relief. So best judgment assessment is dangerous. According to the best of the judgment of the AO is computing the total income. That is known as best judgment assessment. So not complying with the section 145 is a violation, and which will lead to 144 best judgment assessment. So this is the introduction section you have to keep in mind while studying PGBP, section 145, method of accounting. Okay? So total 3 points. PGBP and IFOs, either mercantile or cash system, to be regularly followed. ICDS 1 to 10 to be followed only for the limited purpose of computation of total income and disclosure in ITR and tax audit report only for the purpose of tax law. Not for the purpose of books of account, because of books of accounts is maintained based on accounting standard or Ind AS. And third, non-compliance. Now we will go to see what are the provisions we have to study in PGBP. So for convenience of study, dividing into different parts. First of is chargeability, two sections 28 and 41. Then deduction part starting from 30 ended with 37. Disallowance 37 2B till 43B, and special provisions the last part. So we have to study all these provisions. Once you have a very sound knowledge in PGBP, it will help to study assessment of company, firm and LLP. A very short period of time we can finish. Only the additional provisions applicable for assessment related provisions, that only you have to study. So if you have very good knowledge in PGBP, IFOS, capital gain, then assessments of company and firm and all those things are very, very easy. But if you do not have a very good knowledge in this area, it will be very difficult to finish the problems, right? So we will start PGBP. So what is section 28, chargeability? Remember. Yeah. Okay. So chargeability. I will just give you an idea of chargeability. Every heads of income, the first section start with the chargeability. Salary, chargeability 15, house property 22, PGBP 28, capital gain 45, income from other source 56. So what is chargeability? What are the items to be taxed in that particular head will be explained in chargeability. And if there is any condition to tax an income in that particular head, it will be explained in that section only. So that is importance of chargeability. If a income is not covered under the chargeability scope, then it cannot be taxable in that particular head. Then we have to check whether it can be incorporated in any other head. And if all other heads are failed, then we can try to put under income from other source. So this is the way chargeability is working. So chargeability of PGBP section 28, and there is another supplementary section is also there, 41. 41 is also income side of P&L or PGBP. 28, the first item we are going to discuss. Income from any business or profession carried on by the assessee at any time during the previous year, taxable under this head. So they are using two keywords, business and profession. So what is the word meaning business? Business is defined under section 2 subsection 13 of the income tax law. Business says business includes trade, commerce, manufacture or any adventure in the nature of trade, commerce or manufacture. So what is adventure in the nature of trade, commerce or manufacture? An isolated transaction, not regular, sometimes it is happening, but it have the character of a business or profession. Then it can be included under PGBP. A person is buying some shares and selling it after some time. If he is doing frequently, there will be a dispute whether it is a capital gain or whether it is a PGBP item. So a lot of disputes are arising in share transactions and mutual fund transactions, etc. So there is a old Supreme Court case, that is G. Venkataswamy Naidu and Company. In that case, Supreme Court says to decide a transaction whether it is adventure in the nature of trade or commerce, we have to apply certain test. Number one, what is the intention of that assessee? What is the frequency of that transaction or magnitude of that transaction? What is the treatment in books? So whether the transaction is repeating, and what is the period of holding, or what is the time lag between these transactions, and what is the treatment in books, and what is the subject matter of that transaction, whether the subject matter of that transaction is usually a subject matter of trade, commerce or manufacture, or whether it is not like that. So depends upon these tests, we can decide from case to case basis whether it is a adventure in the nature of trade, commerce or manufacture or not. If it has the character of adventure in the nature of trade, commerce or manufacture, then it can be taxable under PGBP. Otherwise, we have to check about other heads. Usually, this dispute arises in case of share transactions. If a person buying a share, after 2 months, if he is transferring it or selling it, so there may be a dispute. Department will say it should be taxable under capital gain. Assessee may say, no, it is my business activity, it should be taxable under PGBP. Lot of disputes are arising in that area. CBDT already issued some circulars clarifying that. See, merely by seeing that a transaction is happening frequently, it cannot be said to be a PGBP transaction. Similarly, If a transaction happened isolated, it cannot be said to be a capital gain also. So from each case, we have to apply certain test. What is the intention of the assessee? Whether to held that transactions and to buy those shares and keep it for a very short period of time, take some market volatile advantage and sell it, then we can say that it is in the character of a business activity. If it is held for a long period of time and capital appreciation, we can say it is a capital gain. And in the books of accounts, whether that shares are accounted as a stock or investment. If it is investment, okay, go to capital gain. If it is accounted as a stock, go to PGBP. What is the magnitude of the transaction? Whether these transactions are repeating at regular intervals in an organized manner, PGBP. And not like that, go to capital gain. So some circulars also have been issued. So this is the area we have to keep in mind regarding adventure in the nature of trade, commerce or manufacture. The last part of the definition. That is the only area we have to focus at the final level. So sometimes a transaction may happen in a scattered manner. So those transactions, whether it should be treated as business or not, depends upon the CBDT circular. That circular is issued based on Supreme Court decision in G. Venkadaswamy Naidu and Company, which says that we have to apply certain test. After seeing whether these tests are satisfied, we can classify it under PGBP or income from other source. Otherwise, it can be go to capital gain. So some dispute will arise. Remember, capital gain, PGBP, completely different treatment, right? Capital gain, the income will be taxable if it is long term, flat rate. PGBP, normal rate. Capital loss, cannot set off with other heads. PGBP loss, we can set off with other heads. So the treatment is completely different. So misclassification will lead to a lot of adverse consequences. So classification is important. If an item taxable under PGBP, you must show it under PGBP. If it is under capital gain, show it under capital gain. Okay, misclassification will lead to some adverse consequences. So these are the area you have to keep in mind. Adventure in the nature of trade, commerce or manufacture. Now, profession. The word profession usually means you are doing some professional course, professional qualification, obtained some skill and knowledge, practice it, earns income like accounting, legal, medical, architect, engineer, chartered accountancy, MBBS. So these are the examples of profession. But when it is come to tax law, for exam purpose, we keep in mind that word vocation. Section 2 subsection 36 of the income tax law defines the word profession. So which says the word profession includes vocation also. So general meaning of profession we can take as per the dictionary meaning or General Clauses Act meaning. But for tax law purpose they are specifically insisting on item. Vocation. VOCATION. What is vocation? Some sort of ability, some skills or some intellectual things you are practicing and earning income. Examples of vocation: philosophy, activities carried on like preaching philosophy or preaching religious matters, teaching of Vedanta, religious preaching, right? And these religious leaders, they are making a lot of preaching and they are getting a lot of disciples and they are getting donations. All those incomes are taxable under profession. It isn't taxable under PGBP. Astrology, atheism, rationalism. So all these things are coming under the word vocation. So these incomes are taxable. But as you are aware, practically religious leaders, they are not paying tax because they are making it under the category charitable or religious trust. They are registered under section 12A and they are getting exemption through 11 and 12. That is why they are not paying tax. If they are not making it as a charitable trust, it will be come under PGBP. They have to pay tax. Preaching religious, teaching Vedanta. It's an old case, Krishna Mohan, Supreme Court. Teaching Vedanta is an occasion, taxable under PGBP. Dr. K. George Thomas, that's another Supreme Court case. Basically, he is a doctor, he is a surgeon. But one day he is attracted to atheism and rationalism. So he practiced atheism, rationalism. He is making preaching and writing books. And he got a lot of disciples and he got some donations from abroad to promote the idea. So that income he didn't pay tax. Department demanded tax on that income and doctor is saying, no, my profession is not teaching Vedanta or teaching these atheism matters. My profession is doctor, medical profession. For that I am paying tax, but this is not a PGBP income because it is from my disciples I am getting donation to promote the idea of atheism. so I am not liable to pay tax. And the case went to Supreme Court, and Supreme Court clearly says no need to argue, because section 2 subsection 36, the word profession includes vocation. The word vocation includes discourses on philosophy, atheism, religious matters, etc. So that is taxable. So these two words you have to keep in mind in first item. That's enough for final. You can go to the next item. So this part is very important. Vocation part is very important. Adventure in the nature of trade, commerce or manufacture is important. Some isolated transactions, there may be a dispute whether it should be taxable under PGBP or not. So some test we have to apply. Okay. Now compensation. There are total 4 types of compensation they are explaining. This area is not that much important, the second item, but just to know what the provision says. A person who is controlling the whole affairs of an Indian company, just like chief executive officer, or we can say global director, or head Indian operations. So that is known as a person controlling the whole affairs of an Indian company or affairs of a foreign company in India. So that person, usually he will be a professional or a big idea man. So that person will have an agreement with the company for 2 years or 3 years. He is appointed, and some very good remuneration is paying, and a lot of other facilities, perquisites is also provided, and he is a sole decision maker. So if there is an agreement between the company and that person, there is a possibility some dispute will occur and premature termination of that contract may happen. For example, Cyrus Mistry, he earlier was the chairman of the Tata Group, and some misunderstanding happened. So Tata Group expelled him from the chairman, and he filed a suit against the Tata Group saying that it is a premature termination. I have been appointed for 5 years. This is only the second year. They are expelling me, so I need compensation. So in that case, I think Cyrus Mistry won the case, and Tata paid some compensation to Cyrus Mistry. So Cyrus Mistry, actually the whole affairs of Tata Group controlled at that time. So that compensation received by Cyrus Mistry taxable under PGBP, because usually those type of person is not a mere employee, it's a professional. So that compensation, even though it is in the nature of a capital character, it must be taxable under PGBP. So that's the first item. Compensation received by a person who is controlling the whole affairs of a company in relation to termination or modification of employment contract. Even though Act uses the word employment, remember it is not he is not a mere employee. The person who is controlling the entire affairs of a company is like a professional. And second one, principal appointed agent for agency contract for 5 years, but second year or third year, principal is not happy with the way agent is working. So principal is saying, from tomorrow onwards, you are not my agent. I am going to terminate agency contract. Okay. Agent will say, no, you can't do that because it is for 5 years. It's only the second year. I will file a case against you for compensation. Probably those contract itself will have a compensation clause. So he filed a case and court says, give compensation. So agent is getting compensation from principal. So that compensation should be taxable under the head PGBP. Sir, anyway it is PGBP income, right? Then why they are specifically mentioning? We cannot say like that. Remember, agent is getting commission. It is a source of income. Agency is a source of income. By termination of agency contract, that source is going out. You are losing that source. If you are losing a source and getting a compensation, it is in the character of a capital receipt. Capital receipt cannot be taxable under a revenue head unless it is specifically provided by the law. Capital receipt can be taxable only in capital gain. To tax a capital receipt under capital gain, there must be specific provision. There must be a capital asset and it must be transferred. Profit or gain arise, capital gain will arise. But here there is no capital asset transfer. But a source of income is sinking and he is getting a compensation. It is in the nature of a capital receipt. If there is no specific provision like this, it can never be taxable anywhere under the provisions of the income tax law. It cannot be taxable at all. Capital receipt can be taxable under the tax law only if it is specifically provided. If it is not specifically provided, it cannot be taxable. Capital gain taxable under 45, capital gain. But there are very strict conditions. There must be a capital asset, it must be transferred. So capital asset should be there, transfer should present. Then only it can be taxable under capital gain. So otherwise capital asset cannot be taxable. That is why specifically they are saying there are a lot of Supreme Court cases before introducing this provision under section 28. Compensation for loss of source of income, capital cannot be taxable. That is why they created this provision. When they drafted the original income tax law, this provision is not there under section 28. It's added later to override that Supreme Court cases. So it's a capital receipt, but still taxable under PGBP. Generally, PGBP is a revenue head. You see income from other source. In IFOS, income from other source, gift is taxable. If the value of gift is more than 50,000, gift is actually capital receipt. Absolutely capital asset. You are getting jewelry, archaeological collection, work of art, paintings, sculptures, bullion, shares and securities, land, building. If you see the definition which says jewelry, archaeological collection, work of art, paintings, sculptures, which must be a capital asset of the donee, recipient. It's absolutely capital. But Act amended, they put it taxable under section 56. So nothing can be done, it will be taxable there. So remember, generally, salary, HP, PGBP, IFOS, revenue head, capital gain, capital profit. In these four revenue heads, a capital item can be taxable only if specifically provided. Section 28 contains some 3 or 4 items which are capital but still taxable because specifically they created the law. Okay, they are diluting the basic principle. Income means revenue, capital means capital gain only, but sometimes they are diluting that principle. Okay, and now that is why specifically created this. And then third one, a person owns a property or owns a business and he is managing it, but government is asking that person, we have to take over the management of your property or your business due to some general public interest or due to some other requirement of some law. We are taking over, government taking over the management of your business or your property. Your property may have some archaeological value or historical interest. So if you are managing it, it's not good. So we will manage it. So government is taking over the control, not the ownership. If the ownership is giving, it is a capital gain. They are saying management of business or property is surrendered to government and government is giving a compensation. That compensation in the hands of that owner of that property, it will be taxable under PGBP. So rarely happening. You have some very old property, it's got some archaeological value. You are managing it, you are the owner. You are getting some income from that property, but archaeological department is coming under any required law. They are taking the possession. That is a management they are taking, but you are still the owner. You can in legal title, in paper, you are the legal owner, but you won't get any control over that. The property will be controlled or managed by government. You are losing some revenue because if you are managing that, you are getting some revenue from that property, right? So now the government is taking over the control. Government will give you compensation. So that compensation taxable under PGBP. Fourth one is little bit important for final level. Fourth one. See, as a business, there will be a lot of contracts. That is why commerce students are studying Indian Contract Act. Business means full of contract, right? Even under GST also, supply is a contract, right? So everything there will be a contract. Contract is a must. Dealership contract, supplier of raw material and company will have a contract. Supplier of plant and machinery and associate, there will be a contract. There will be a lot of annual maintenance contracts, right? There will be a lot of contracts, franchisee arrangement contract, license contract. So there will be a lot of contracts in a business, and sometimes some of these contracts will be terminated knowingly or unknowingly, purposefully or not. Sometimes these contracts will be violated. In all those cases, there will be some penalty clause in that contract for the damaged party. So definitely we have to give some compensation to the other party if we are terminating, and if that other party is terminating, he will give us the compensation. So that compensation for termination of any contract relating to business should be taxable under PGBP. but it must be a revenue type of contract. It should not be related to a capital property, capital nature. So any contract relating to regular business, maybe dealership contract or contract with a raw material supplier or franchisee type of contract, any type of contract. If there is a termination and we are getting a compensation, then it should be taxable under section 28. Sir, if we are paying a compensation, what is the treatment? If we are the payer, we are not the payee, then it depends upon the nature of that compensation. If it is a revenue nature, you can claim under section 37. If it is capital nature, you cannot claim it. You cannot claim it. Because here what they are saying is income side. Regarding expense side, there is a very important section 37 general deduction. There is a very important condition. To claim an expense under section 37, it must be revenue in nature. So if this contract is in connection with the purchase of a capital asset or plant and machinery and terminated, and you are paying compensation to the raw materials, machine supplier, plant and machinery supplier, you are paying a compensation. So for that plant and machinery supplier, it is an income under section 28. But for you, it is not a revenue expense. It is in connection with the purchase of an asset. Asset is capital. So this is capital nature. Under section 37, you cannot claim. Sir, then what we will do regarding that payment? Under tax law, nothing can be done. You won't get any benefit. It's gone. In the hands of the recipient, it is income, taxable under section 28. Example, premature termination of distributorship, compensation for termination of consultancy agreement, compensation for termination of AMC contract. Those are the examples of this item. So these are the 4 compensation taxable under PGBP. So first 2 items are over. Now we are moving to the third one. So this item, just I am reading the provision because we have to study separately under section 44A. The idea is trade or professional or similar association. For example, Chamber of Commerce, Chartered Accountants Association, Lawyers Association. These associations are known as mutual concern. Generally under the tax law, mutual concern not have any tax liability, even though there is a surplus, because they are collecting subscription from the members and spending some money out of the subscription to the benefit of the members, and still there is any balance, that is not a surplus, that is not an income. To said to be an income, there should be 2 persons, right? But mutual concern means contributories and the beneficiaries are the same person. So just like a club, just like an association. So they are putting contribution, they are enjoying it, and there is a surplus. That is their own money. There is no dealing with outsiders. So it is known as concept of mutuality. They are not liable for tax. That is why social club and all these associations are not paying any tax. But if they are doing any specific service to members by extra charging any amount in addition to the membership, that is known as specific services. So from specific services, if they are getting any income, it is taxable under section 28. Don't worry, we will make a separate discussion. It's a separate topic, mutual concern, mutual association. Sometimes they will ask a question. So that we will discuss later. When we study at the end of this chapter, we will discuss 44A at that time. 44A is a tax planning available to this specific professional association. They will get some benefits from their deficiency. If they have loss, they will get some tax benefit. That is 44A. They will study later. This item, very, very important. Frequently they are asking in majority of the compulsory questions. Definitely there will be an adjustment based on this particular provision. You are a businessman, you carrying out business, or you are a professional, you are doing your profession, practice your profession. In connection with the business or profession, you are getting any benefits or perquisites or facilities. Sometimes that benefit or perquisite may be converted into money, or sometimes it cannot be converted into money. Whether it is convertible into money or not doesn't matter. If by carrying out business or profession, you are getting any benefits or perquisite, there should be connection between business and benefit received, profession, practice, and getting benefit. Then that value of benefit or perquisites must be taxable under section 28 in the hands of the recipient. So chartered accountant is giving tax planning to a corporate. The corporate is very happy. They are giving fees to the chartered accountant. In addition to the fees, that company gifted a gold ring to the chartered accountant. So value of that gold ring in the hands of the chartered accountant, taxable under section 28. Sometimes that corporate is giving gift of a car to the chartered accountant. The value of that car can be taxable under section 28. Harish Salve is appearing for Reliance and the case won in Supreme Court. So Mukesh Ambani was very happy. So he is gifting a BMW car to Harish Salve. In the hands of the Harish Salve, equivalent value of that BMW, taxable under section 28. Freebies received by doctors, that is another key area. So pharmaceutical companies or pharma companies are providing lot of benefits and perquisites to doctors. Foreign trip, petrol coupon, petrol voucher, gift coupon, resort stays, and lot of high value items are giving us gift or benefits to the doctors. So these doctors, they are getting this benefit to promote these brands, right? These multinational companies, medicines and equipments, to promote that, they are getting these benefits. So in the hands of the doctors, it is taxable under section 28 PGBP. So any business or any professional, sometimes some business, the businessman, he will purchase lot of goods from a particular supplier. So the supplier is happy because this particular person is the highest consumer of that particular goods. So sometimes he will give some gift to that customer, saying that you are the largest consumer of our product, so we are giving you a gift. So sometimes to achieving sales targets, some distributors are getting benefit from the manufacturers. See, Johnson and Johnson tile manufacturing company or some cosmetic manufacturing company. So they are giving some gift to the distributors for achieving the sales target, or they are making some extra sales. So they are giving some benefits. All those benefits are taxable in the hands of the recipient under PGBP section 28. It is absolutely business income. But there should be some connection between providing the benefit or providing the business and getting the benefit. And that benefit, sometimes they have to enjoy it, or sometimes they can convert it into money. So whether convertible into money or not, that benefit should be taxable under section 28. So it is very important. So against this particular, there is a particular circular number 5/2012 issued by CBDT, which is specifically targeting doctors. It clearly says that doctors or healthcare professionals getting a lot of benefits from pharma companies, absolutely taxable under section 28. So against that circular, they filed a case against CBDT, and in that case also, Supreme Court clearly mentioned it's absolutely for promoting the medicine, they are getting the benefits. So that is related to their profession. So it must be taxable under PGBP. So not only doctors, any professional or any businessman getting any benefits or perquisite in connection with the business or profession, it should be taxable in the hands of the recipient under PGBP. Now listen, under the tax law, there are total 4 type of gift. Employer-employee relationship, employee is getting gift from employer, salary, perquisites, section 17. If employee is getting benefits or gift from employer in money, any amount of gift taxable under salary. If it is in kind, more than 5,000, it is taxable under perquisite. Remember, relationship employer-employee. And second one, PGBP. Business client, professional client relationship, carrying out business or profession, getting benefits from the client, absolutely PGBP, irrespective of the value. There is no limit, irrespective of the item. Okay. Whatever item may be received as a gift, it is taxable under PGBP. And third one, no business client relationship, no employer-employee relationship, but gift is received. And for the recipient, the received item is a capital asset, and it should come under the definition: jewelry, archaeological collections, work of art, paintings, sculptures, bullion, shares and securities, land, building, money, more than 50,000. Other source. Fourth one, no employer-employee relationship, no professional client relationship, not these items, any other gift cannot be taxable anywhere under the provisions of the tax law. For my birthday, my friend gifted a BMW car, cannot be taxable anywhere under the provisions of income tax law. So gift means total 4 classification: employer-employee, business client, IFOS, not covered under tax law at all. That's the last category. So business gift, professional gift taxable under section 28. Very important. in the hands of the recipient. Now, what is the impact of the payer? Okay, for the payer, there are two impacts. Number one, specifically for the pharma industry, we should keep in mind when pharmaceutical companies are providing these gift or freebies to doctors, it is actually prohibited by law. Indian Medical Council Ethics Regulation, providing benefits and gift to doctors is prohibited. It is an illegal item, right? It is an illegal thing. So don't do that. If you are providing freebies or gift to the doctors to influence the doctor so that he will refer your particular medicine or equipments to the patients, definitely patient will buy that. So that is an illegal thing. It is prohibited by law. As per section 37, explanation 1 along with explanation 3, any expenditure which is illegal in nature, public offense, prohibited by law, contravention of law, then it will never be allowed as an expense under PGBP. So for the pharma company, what they are doing is illegal. They are giving these benefits to the doctors for influencing the doctor. It is illegal thing. So for the pharma company, these benefits paid to doctors is not allowed as a business expenditure. Usually, pharma companies in their P&L account debit side, they will shown under business development expenditure. Actually, that will be a lot of gift given to the doctors. Crores of rupees, right? Earlier, there was an allegation, Dolo 650, that manufacturing company is given almost 1,000 crore rupees gift in 2 financial years to various doctors and hospitals in India. So there was an allegation which some person filed some complaints with the Supreme Court. Earlier there was a Chief Justice, I think T.Y. Chandrachud. So he considered that case. I don't know exactly what is the outcome of that case, but there was an allegation, 1,000 crore rupees, right? So a lot of benefits are providing these pharma companies to doctors. So that will not be allowed as a business expense for the pharma company. But in all other cases, you see, Reliance is gifted BMW car to Harish Salve, legal counsel, for appearing in the Supreme Court case. So that is absolutely a legal expense or business expenditure for Reliance, because Bar Council did not prohibit accepting gift from clients. ICAI did not prohibit chartered accounts to accept gift from clients. No problem. So if chartered account is giving tax planning, company is happy providing a gift to the chartered accountant. For the chartered accountant, it is income 28. For the company, it is business expenditure under section 37 allowable. But for pharma companies, if they are giving freebies to doctors, not a business expenditure. Explanation 1 and 3 of section 37, prohibited by law, not allowed. Now the second thing you have to keep in mind, when we are providing a business gift or business related perquisites to the another person, if the value of that business perquisite exceeds rupees 20,000, we have to deduct TDS under section 194R. So if we did not deduct a TDS and that deducted TDS is not paid before due date for filing income tax return, then 30% of that benefits debited to P&L will be disallowed as per section 40A1A. So there is a TDS aspect. So what we are discussing now is the payer's impact, the provider's impact, the person who is paying the benefit or perquisite. He can claim it as a business expense under section 37, but for pharmaceutical company it is not possible because it is illegal, prohibited by law. Explanation 1 and 3 will trigger, so it will be disallowed. But for all others, it can be claimed as an expense, but on condition 194R should be complied. You can write it there. If you want it, you can write it there. Section 194R may be attractive. Sideways, you can put it section 194R. For the payer. Section 28 deals with the provision for recipient. Remember, but for the payer also, it is a business expenditure under section 37 possible. But 194R must be complied. Otherwise, for non-compliance with the TDS, there may be a disallowance under section 40A1A. 30% of that expenditure may be disallowed. So that disallowance will trigger. And this particular area, that is pharma provisions, is very, very important. A partnership firm and partner, there is no employer-employee relationship. Partners are the owners of the firm or LLP. So if they are drawing remuneration from their firm or LLP as authorized by the deed, so that remuneration in the hands of the partners should be taxable under PGBP. Similarly, interest on capital, we know as per section 40B of the income tax law, maximum interest on capital allowed is only up to 12%. So in the hands of the partner, interest on capital and remuneration received will be taxable under section 28 in the hands of the partner. For the firm, it is an expense allowable under section 40B, subject to 40B. We will study in detail in firm or LLP chapter. The key point is, whatever expense is allowed to the firm only must be income in the hands of the partner. Even though partner is drawing interest on capital at 14% as authorized by the deed, as per income tax law, only 12% will be allowed. So, even though partner is getting 14 in the hands of the partner, PGBP income is only 12%, because for the firm only 12% will be allowed. Excess 2% will be disallowed for the firm. So, what is allowed to the firm? Income of the partner. Similarly, remuneration. So, whatever remuneration is given, it is subject to the ceiling limit prescribed under section 40B. So, whatever is allowed under section 40B, that much only will be taxable in the hands of the partner, even though he is getting more, but only less amount is allowed to the firm. Allowed to the firm, what is the amount? That only will be taxable in the hands of the partner. So, that is also very important. But finally, there will be share of profit received by the partner from the firm. It should not be taxable, because for that profit already firm is paid a tax at 30%. So, again it will be taxable in the hands of the partner. It will amount to double taxation. So, in the hands of the partner, share of profit from the firm or LLP is exempted as per section 10 subsection 2A. Under the tax law, partnership firm and LLP treated same. Only in some 2-3 areas there is some difference. 44AD, presumptive taxation, firm can claim, LLP cannot claim. 44ADA, presumptive taxation, firm can claim, LLP cannot claim. But in all other major areas, that is interest on capital, remuneration, computation, assessments, rate of tax, all other area, firm and LLP treated same under the tax law. Okay. We will make a detailed study of firm and LLP in assessment of firm chapter. The sixth item in section 28. To avoid the competition, sometimes a businessman or professional will get into some contract with the competitor, that is known as non-compete agreements or non-compete fees is paid to the competitor to prevent the competition. So, any amount received or receivable under an agreement for not carrying out profession or not carrying out business or not sharing any intangible asset to a competitor. So, not sharing any know-how, patent, technology, etc., there will be 3 persons. A, B and C. A and B are doing same business and they are competitors, A and B. C has a unique technology. So, if that technology is taken under a lease agreement, if that or under a royalty agreement, if the technology is taken by A, definitely A will outperform B in the market. So, at that time B will go and see C and saying that please don't share your technology to my competitor Mr. A. Then I will pay you this much amount. So, that is known as non-compete agreements in connection with the third party regarding prevention of sharing of technology or patent, etc. So, any amount received or receivable under an agreement for not doing any business or not doing any profession or not sharing any know-how, technology, patent, copyright, franchise, license or similar type of intangible asset, please don't share to my competitor, then I will pay you this much amount. So, they are entering into a legal agreement and they are making amount. In the hands of the recipient, that amount is taxable under PGBP. So, any amount received or receivable in cash or in kind for not carrying out any business or not sharing any know-how, it must be taxable in the hands of the recipient under PGBP. What is the tax treatment of the payer? Okay, for the payer, why we are making these type of payments? Because to protect our business, to prevent competition. So, to protect our business, we are making compensation to the third party. So, in that case, remember, it is a business expenditure allowable under section 37, because any expenditure which is incurred for exclusively for our business or profession, we can claim it under section 37. So, this non-compete fees we are paying to protect our business. So, it is allowed as an expense under section 37. But we have to keep in mind 2 things. Number 1, as per section 194J, If the non-compete fees is more than rupees 30,000 in a financial year, then we have to deduct TDS at the rate of 10%. And that deducted TDS must be remitted to government before the due date for filing ITR. Otherwise, 30% of that non-compete fees will be disallowed and only 70% will be allowed as per section 40 subsection A subclause 1A or 40A IA. So that provision we have to keep in mind. We have to connect to that provision. And second one, if the non-compete fees is paid for more than 1 year, say non-compete fees is paid for preventing competition for the next 5 years, okay, then there is a problem. It is not a revenue expenditure, it is in the character of a capital nature because it is for 5 years. So two solutions are there. Solution number one, as it is for 5 years, we are getting a right to prevent competitor from competing with us. So it is a right, intangible asset. Go to section 32, claim depreciation 25%. Option 1. Option 2, we are not taking it as a right. We are taking it like a deferred revenue expenditure. It is for 5 years. So divided by 5, 1/5 each year, we can claim under section 37. So there are two views. In examinations, when they are asking these adjustment, ICI in suggested answers, what they are doing is take it as revenue expenditure divided by 5 under section 37. But in alternate answer they are giving, there is a possibility you can take it as an intangible asset. It's a right. Similar business or commercial rights. Business rights and commercial rights are depreciable as intangible asset. Then you can depreciate at the rate of 25%. So better keep the first view. That is better view. Over the period of that expenditure time period, divide and proportionate amount you can claim under section 37. So this is the treatment for the payer. Remember, if the non-compete fees is paid outside India to a non-resident or outside India, as per section 195, we have to deduct TDS, and that TDS must be paid to government. Otherwise, 100% of that expenditure will be disallowed as per section 40 subsection A subclause I 40A1. So lot of provisions in PGBP are connected to lot of other provisions. These connections are very important because they are asking questions in a connected manner, right? Not from a particular topic they won't ask a question. That definitely that will be connected with the other topics, other case laws, recent developments, recent circulars. So final they are asking adjustments like that. They are creating adjustments based on recent developments. Okay, so this is the provision. This is important. Non-compete fees. For the recipient, income under section 28. For the payer, business expense. Allowable under section 37. Now, conversion of stock in trade into a capital asset. There arise PGBP income. Conversion of stock in trade into capital asset. So, stock in trade converted into capital asset means initially nothing is happening. We are not getting any inflow of money. Simply what we are doing is converting our stock in trade into a capital asset, into an investment. We are not going to sell that anymore. We are keeping it as our investment. But up to yesterday, till yesterday, it was stock. But from today onwards, we are not going to sell it. We are converting it into our asset. So from the balance in the balance sheet asset side, earlier it was stock, but now coming under assets or investments. So the moment you are converting your stock in trade into capital asset, you are liable for PGBP income. On the date of conversion, what is the fair market value of that stock? It will be deemed to be sales. Actually, you are not selling it, but the fair market value on the date of transfer or on the date of conversion, it will be treated as a deemed sale and PGBP income will be attracted. So this is a very dangerous provision because we are not getting any inflow of money into the business. Simply we are converting our stock in trade into capital asset, but we are liable for payment of income tax on PGBP income. You are a share trader. You have a lot of shares as stock in trade, and on fine morning you are converting some 100 shares into your investment. You are not selling those shares in connection with your business. You take it as your investment. So in that situation, even though you are a share trader, now you are converting your 100 shares into your capital asset, into your investment. So in that situation, on the date of that conversion, what is the fair market value of that 100 shares? It will be deemed as sales. From that, reduce the cost of purchase of that share. Difference will be PGBP income. It will be taxable. So conversion of stock in trade into capital asset, a lot of example. You are a property dealer. You constructed a flat with 100 units, 95 units sold, 5 units remains as stock. So you have a thinking. So convert these 5 units into our administrative office, or convert these 5 units as our capital asset. We are not selling it because the property in a prime location. So there is a growth potential. We are not going to sell that remaining 5 flats. Keep it as our investment or office building. Definitely PGP income arise. The date on which you convert that 5 flats as your capital asset, what is the fair market value of that 5 flats on that day? That will be deemed as sales. From that, reduce the cost of construction or purchase. Difference is the business income. So you are a you have a jewelry trader. You are a jewelry trader. You have a jewelry shop. So some of your jewelries, the gold price is increasing. So you have an intention not to sell some gold. Keep it as investment. So out of the stock, you converted certain gold into your investments. Simply you are putting a journal entry, right? But under the tax law, you are liable for payment of income tax on the difference between fair market value and its original cost. So that is conversion of stock and trade into capital asset. After that, what? Okay, you converted. Now it is capital asset. PGP income arises, we paid income tax. This capital asset in future you may transfer. At that time, there will be capital gain. There will be capital gain. Sometimes certain persons will not transfer that capital asset. They will use it as for their own business. Then if it is a depreciable asset, you can depreciate. So what is the actual cost of that depreciable asset? Fair market value on the date of conversion. So in 2 ways they can ask in exam. One simple way, the concept clarity, I am just saying you purchased a stock. Cost of purchase rupees 10 lakhs in 2020-21. And this stock on 1st June 2024 you converted into capital asset or your investment. On that date, the fair market value is rupees 60 lakhs. And on 1st February 2027, you transferred that capital asset for rupees 22 lakhs. So here the difference between this, that is 10 to 16, 6 lakhs. This is PGBP income taxable in the year 1/6/2024, that is 24-25. This 6 lakhs is taxable as business income. And in future, when you transfer this, here full value of consideration 22, cost of acquisition 16, and balance 16 lakhs, long term capital gain. So appreciation between the date of conversion and date of transfer, capital gain. The original cost and conversion date, it is taxable as PGBP. So this is the concept. Suppose if you converted that capital asset, a stock into capital asset, and then you use it as a depreciable asset, then this 16 lakhs is the original cost or actual cost of that asset. On that you can apply depreciation rate. You can depreciate it. So there are 2 possibilities after conversion. Either you can keep it as capital asset and then sell it, capital gain, or use it for your own business purpose as an asset. Then as per the provisions of section 43, this fair market value on the date of conversion to be treated as actual cost of that asset, and you can depreciate under section 32. So this is the provision. This is the concept, but for our exam purpose, it's not like that. For examination, they will give you a P&L, statement of P&L. So a lot of items, net profit, all those things. The further information they are saying during the year 24-25, stock worth rupees, fair market value, they will give you the fair market value worth rupees 50 lakhs has been converted to stock, converted to capital asset. Just they will say like this. So how we will do the adjustment? Remember, the P&L account is given. So the further information they are saying during the year, stock worth rupees, fair market value 50 lakhs has been converted into capital asset. On the date of conversion, the fair market value is 50 lakhs. They are not giving any other data. Sometimes they may say the original cost of the stock is rupees 28 lakhs. They may say like that. In that situation, remember, already they prepared the P&L. So in the opening stock, this cost is already included. Closing stock, it's not there because it is converted into capital asset. So what we have to do is taking the net profit, add fair market value on the date of conversion, that is rupees 50 lakhs. That's it. So do not take the difference because already the cost of that stock is included in the debit side of the trading P&L. So only the credit side is missing. So just add 50 lakhs. So the profit is absorbed into PGBP income. So here you should not do like this, right? Should not do like this. That is 50 minus 28. So balance will be 22. Don't do like that because already this 28 lakhs is debited here. In the further information they are saying the fair market value of the stock which is converted during the year is 50 lakhs. So that 50 lakhs is not appeared in the P&L. So just add to the net profit. So this is a way this adjustment is appearing in problem. But theoretically, this is the provision. This is the theory. So if a stock is converted into capital asset on the date of conversion, what is the fair market value? It is deemed as income under section 28. What is 28? 28 is receipt. 28 is not profit. 28 is gross income. From 30 to 37 expense reduced, you will get the profit. So 28 is income. So deemed sales. Fair market value on the date of conversion is deemed to be the sales. So deemed to be the income means sales. So from that reduce the cost. You will get the profit taxable under section 28. After conversion, what? Okay, after conversion, if that is use it as a depreciable asset, then on the date of conversion, what is the fair market value of that stock? That should be treated as actual cost of that asset. Go to block of asset, add it to the concerned block, addition, and then claim depreciation. But if it is not, use it as a depreciable asset, we are keeping it as an investment and then we are selling it. Okay, capital gain. At the time of transfer, what is the selling price? Full value of consideration. And what is the cost of acquisition? We didn't purchase it. We converted the stock into capital asset. So fair market value on the date of conversion is the cost of acquisition. From that date onwards, from conversion date onwards, if the period of holding is more than 24 months, long term, otherwise short term. So difference between fair market value and actual transfer price, capital gain or capital loss may also arise, possible gain or loss. So this is the provision of conversion of stock in trade into capital asset. Don't confuse, there is a reverse scenario. Capital asset is converted into stock in trade. That is capital gain, section 45 subsection 2, specific provision is there. If capital asset is converted into stock in trade on the date of conversion, there will be capital gain. But in that case, capital gain computing only when the stock is actually sold. But here, it's not like that. Whether you transferred that capital asset or not, it doesn't matter. The moment you converted stock in trade into capital asset, you are liable for PGBP. Even though there is no single rupee inflow into the business, you are liable for notional business income, you have to pay tax. Income is notional. Tax you have to pay real money. Got the idea? So that is conversion of stock in trade into capital asset. Remember, in doing problem, large comprehensive question, do not take the difference. Simply add the fair market value to the net profit because already the stock cost will be debited to opening stock. Now, we are continuing the chargeability. If assessee engaged into export business, so this item is applicable only for an assessee who have any export activities. In case of export business, if you are getting any export benefits such as profit on sale of import license, cash compensatory support or export subsidy, export grant or duty drawback. So these type of benefits you are getting, it should be taxable under section 28 PGBP income. One item you have to keep in mind is profit on sale of import license. That is very important because license, intangible asset. License is intangible asset. Intangible asset means capital asset. Capital asset means the profit on sale is capital gain. But this particular item specifically mentioned under 28. So even though it is a capital profit, it is taxable under PGBP, not in capital gain. But any other type of license, trademark, patent, copyright, you transferred it, capital gain, capital gain. But this particular license, profit on sale of import license, even though it is a license, the profit is taxable under section 28. 28, that is important. And other things are usual. When you are paying any export duty, you can claim it as an expense. So when it getting duty drawback, refund, it is income. Logically correct. While paying a tax, especially indirect tax, it is an expense. So when you are getting refund, it's income. So other item, not that much, nothing curious, right? Export benefits, okay. Export benefit, so sometimes input tax credit, we will get some ITC refund, or sometimes duty drawback, customs duty refund, or sometimes direct subsidy will be received from government, or grant will be received from government to promote the export. All those, whether it is from central government or state government, it would be taxable under section 28 PGBP income. Next item. Next one is a special item. Usually under the income tax law, if an asset is sold, the selling price will never appear in PGBP. Why? Because asset is part of a block of asset. So from a block of asset, if an asset is selling, we are going to reduce it from block only. It will never appear in P&L account credit side. If it is any other asset, not a depreciable asset, it will never come under P&L in tax law because it is capital asset, capital gain. Take it as full value of consideration under capital gain. It will never appear in P&L. But in two situations, if an asset is selling, the sale value may be appeared in PGBP. Number one, scientific research asset, and second one, section 35 AD asset. So what is section 35 AD? Specified business. We will study, we will discuss in detail. So just I will tell. Section 35 AD means there are 14 specified businesses. 14 specified businesses. That is cold chain facility for storage or transportation of agriculture produce, warehousing facility for storage of agriculture produce, cross-country crude oil natural gas pipeline, 2-star hotel, hospital at least 100 beds for patients, warehousing facility for storage of sugar, slurry pipeline for transportation of iron ore, etc., etc. Total 14 business is there. If you start any one of that 14 specified business, whatever capital expenditure is incurred, simply speaking, whatever asset is purchased, no need to take depreciation. Charge the entire cost of asset into the debit side of P&L. You claim it as deduction from the first year itself. The moment you purchase, claim it as deduction. No need to go to 32 and claim depreciation. Entire cost of asset is allowed in 1 year as a deduction. That is 35AD. So what is the point in that? If you are debiting the entire capital expenditure into the P&L account, cost of the asset, there will be a huge loss. If there is a huge loss, means it's fantastic. No need to pay tax, and that loss can carry forward infinite period. So initial 10 to 12, 15 years, no need to pay tax. So that is the tax incentive, 35 AD. But sometimes some persons will misuse this provision. They will purchase an asset in the name of 35 AD business, claim it as deduction, and immediately after that, maybe 1 year or 2 years or maybe next month, they will sell it off. That asset will be sell it off. So that they will record a huge amount of loss. 35 AD loss. So no need to pay tax. Maybe some small amount of capital gain or profit may be recorded. Or if it is sold at a less price compared to the original cost, there will be no capital gain. So it is a actually misuse of the provision. So that is why they are saying, if any assets for which you claimed deduction under section 35 AD and subsequently if you sell it off, you are liable for PGBP income, original cost of that asset or selling price, whichever is lower, taxable under section 28 as business income. And if the selling price is over and above original cost, there will be capital gain also. Then capital gain will be taxable separately. So for example, 35 AD asset originally purchased in 2020-23 for rupees 25 lakhs. And during the current year, it is sold for 32 lakhs. And originally you claimed deduction under section 35 AD. You claimed. Why? It's optional. 35 AD is not mandatory. If you doesn't want to claim 35 AD, okay, no need to claim. Because if you are not a company and you claimed 35 AD, you are liable for AMT, section 115 JC, JD, JW, JF, AMT. If a person is claiming 35 AD, he is liable for AMT. If you are a company, anyway you are liable for MAT. But if you are, even though you are not a company, you are liable for AMD because you claimed 35AD. So that is why section 35AD clearly says optional. If you want to claim 35AD, you can claim 35AD and liable for payment of AMD. If you doesn't want to claim 35AD, okay, go to 32. Claim depreciation as usual, no AMD. So 35AD is optional. So if you claimed 35AD and that asset is sold, then original cost or selling price, whichever is lower, 28. But if the selling price is over and above original cost, definitely there will be capital gain also. So 25 lakhs original purchase, sold it for 32, then 25 or 32, whichever is lower, 25, PGBP income section 28, and difference, that is 7 lakhs, it will be taxable under capital gain, over and above original cost if it is sold. So what is the treatment in books? In books of account, original cost and selling price difference will be accounted as profit on sale of asset and will be credited to P&L. When it is come to tax law, that profit is capital gain. Reduce from net profit, put it under capital gain, and find out original cost and selling price. Compare and take the lower, add it to net profit. This is the way in problem adjustment is appearing. The theory is simple. If you purchased a 35AD asset, specified business asset, claimed deduction under section 35AD, and then you sell it, whether in the same year or next year, or even after 5 year or 10 year or 15 year, when you sell it, original cost or selling price, whichever is lower, business income. If the selling price is over and above original cost, there will be capital gain also. So this is the treatment of 35AD asset. Absolutely similar treatment for scientific research asset. But the difference is, that is taxable under 41, deemed profit. This is 28. That's only different. Section number only different. Concept is 100% same. For scientific research asset, you purchased an asset and you claimed deduction under section 35. Instead of 35AD, you claimed under 35. And then you sell it off. Original cost or selling price, whichever is lower, taxable as business income under section 41, deemed profit. Deemed profit, 41. If the selling price over and above original cost, there also capital gain. That will be taxable under capital gain. So same. That is 41, this is 28. Calculations are pakka same. Now, under section 35AD, 3 assets, deduction not allowed. Land, financial instrument, goodwill. So for these 3 assets, even though it is selling, there will be no business income. Because for those assets for which deduction allowed, claimed, allowed under section 35AD and then sell it off, this provision is applicable. Section 35AD clearly says you cannot claim deduction in respect of land, financial instrument, goodwill under section 35AD. So for these 3 assets, even though for the purpose of 35AD, as the deduction is not permitted under the tax law, at the time of sale, there will be no impact like this. One more thing, under section 35AD, while claiming a capital expenditure, if the cost is more than 10,000 in a single day, the payment should be made only by way of account pay check, account pay draft, or other prescribed electronic mode. So if you are making payment in cash or normal check under section 35AD, deduction not allowed. So those assets for which deduction not allowed under 35AD due to 2 reasons. Reason number 1, it is land, financial instrument, goodwill. This provision not applicable. Number 2, other assets, building or plant or machinery or furniture, but in a single day, the capital expenditure payment exceeds 10,000 to a person and payment made in not in prescribed mode. Prescribed modes are debit card, credit card, NEFT, RTGS, IMBS, etc. That is other prescribed electronic mode, or account pay check or account pay draft. If you are making payment in any other mode, crossed check or normal check or bearer check or cash, then in that case deduction will not be allowed under 35AD. So deduction not allowed under 35AD and then you sell it off, there is no treatment because income tax you are not getting any benefit earlier. So now when you are selling it off, no impact, no tax consequence. Yeah. Next item. Income from speculative transaction. Speculative transaction. So speculative transaction defined under section 43. The definition is very important. Transaction in any securities, especially stocks, security without physical delivery. So you are buying a security and selling it off, but there is no physical delivery of the security. Only the margin you are settled and you are earning a profit or loss. So that is known as speculative transaction. So transaction in any securities where there is no physical delivery, we can say it as a speculative transaction, which is prescribed under section 43. So what is the impact of speculative transaction under the tax law? Remember, speculative income, no problem, just like business income. But speculative loss, lot of issues. Majorly, there are three issues. Issue number one, speculative loss cannot set off with any other income. Speculative loss can set off only with the speculative income as per the provisions of section 73. Speculative loss can set off only against a speculative income. Number two, normally business loss we can carry forward for 8 years, but speculative loss can carry forward only for 4 years. And number three, whenever there is an amalgamation, demerger, conversion, succession, etc., that is business restructuring, predecessor's business loss will be allowed to the successor. Amalgamating company's loss can be taken over by amalgamated company. Demerged company's loss can be taken over by resulting company. Proprietor's loss can be taken over by the company which is taking over that proprietor. Partnership firm's company loss can be taken by the company, but speculative loss of the predecessor will not be allowed to successor. So these are the three impacts for speculative loss. Speculative income, no problem, just like normal business income. Against speculative income, other business loss you can set off, no problem. But speculative loss, restriction is for loss. It's dangerous. So if a transaction is classified as a speculative and if there is a loss, it is a big headache for assessee, because 4 years cannot set off with any other activity, and in case there is a restructuring, it will not be available to the successor. So certain transactions, even though there is no physical delivery, it is not treated as speculative. Exceptions. So these exceptions are very important, because these 4 transactions, even though there is no physical delivery, it will not be treated as a speculative. It will not be treated as a speculative means if there is a loss, it will be treated as a normal loss. You can carry forward for 8 years, set off with other heads, restructuring, available to successor, no problem. Number 1, trading in demat securities, that is electronic form. Condition, it must be carried out through a registered broker, and every guidelines issued by SEBI should be followed. Then demat securities trading will not be treated as speculative. Trading in commodity derivative, your main business is trading commodity derivatives, right? Then commodity derivatives are your stock and trade, business income. It will not be treated as speculative. Actually, there is no physical delivery, but there is one more condition: CTT should be attracted. Commodities transaction tax should be applied or applicable on that transaction. So then trading in commodity derivatives not as speculative, normal business activity. And third, trading in agriculture commodity derivatives will be treated as a normal business activity, not as speculative. For agriculture commodity derivatives, there is no commodities transaction tax. That is why that condition is not putting there, because actually it is not at all applicable. For agriculture commodity trading, commodities transaction tax not applicable in India. But all other commodity derivatives, commodities transaction tax should be applicable. Then only it will not be treated as a speculative. And then stock exchange brokers or stock brokers, they will have a lot of shares. They will expect some bullish behavior. So they will try to expect the price will be increasing. Sometimes they will expect the price will decrease. So they will have a lot of stock of shares. So if the price is varying, they will incur a loss. So to prevent that, they will enter into forward contract, hedging contract, that is known as jobbing and arbitrage, and price will be locked. So sometimes there may arise some profit, or sometimes they will incur some loss. That will not be treated as speculative, because their main activity is share trading. So they are keeping shares as their stock and trade. So there will be some anticipation. So that they are entering into jobbing and arbitrage. Its usual course of business will not be treated as a speculative. And then there is one more point. I am doing construction business for the next 5 years. I have to construct 1 lakh square feet space. So I need to purchase steel, cement, iron. The price is day by day increasing. I already entered into contract. If the price is increasing too much, I will incur a loss. So what I will do? I will enter into forward contract. I will enter into forward contract to lock the price of my raw material for my business activity. There is no physical delivery in forward contracts. The price is locked. So I incur a loss. Maybe income. Both are business. Not as speculative. It will not be speculative. So raw material, to lock the price of the raw material required for the business, if you are entering into forward contract or hedging contract, that is also will not be treated as a speculative. So these will be treated like a normal business activity. Sir, this is for purchase of raw material. What is the treatment if we are getting into a forward contract to purchase a depreciable asset? Then what is it back? Remember, to purchase an asset, if you are entering into forward contract or hedging contract and the price is locked, you incurred a loss. That loss must be added to cost of that asset, depreciable asset. Cost of that asset you can add and go to block, claim depreciation. If there is a forward contract gain arises in relation to purchase of an asset, reduce from the cost of the asset. So raw material purchase related forward contract entered, it is absolutely a normal business activity, not treated as speculative. So these are the 5 items which will not be treated as a speculative as per the provisions of section 43. 43 itself says the exceptions. Sir, then what is speculative? Basically intraday trading. Morning we are buying, before afternoon we are selling it off. Speculative. All others will not be treated as speculative. Only intraday trading practically we can say. So the speculative part is also important, especially those 5 exceptions you should keep in mind. And another point, set off related point should also be careful. 3 points, 4 years, only against a speculative income we can set off. And third point, restructuring, business restructuring, tax planning not possible for speculative loss. But if you have other normal business loss, that can be carried forward by the successor, even though the loss is created by the predecessor. Now there is a recent clarification that residential properties let out by an owner, even though the owner have 5 residential property or 10 residential property or 20 residential property, it will not be treated as a business activity. It must be taken to income from house property. Owner of a residential property. Commercial property. You have 50 commercial property. Your main activity itself is purchase commercial property, lease it out. Or construct commercial property, lease it out. Or develop commercial property, lease it out. PGBP. Go to PGBP. No need to go to HP. Residential properties. Owner. Let it out. It's a house property. It cannot be taken to PGBP. This area again we will discuss in some Supreme Court case law. After the end of the PGBP chapter, we will discuss what are the recent case laws we have to study, which will be given in the study material. So that all case laws we will discuss at that time. This point again we have to discuss because it's a recent Supreme Court decision. Chargeability section 28. These are the major items they are discussing. Right? We have to read, we must go through all these. So what are the connecting points I discussed that you should to keep in mind, because while doing the problems all these adjustments will appear. Now the next income side, income, some other issues discussion. One is sometimes the business people will take loan from banks or financial institutions, and due to some cash crunch problems they are not able to repay the loan. And finally the bank will call for a settlement, and in some cases some part of the amount will be waived off. So if loan is taken and subsequently waived, what is the tax treatment? That we have to discuss. Accounts, they may show it as an income, or sometimes they may set it off from the liability or something like that. But in tax law, what is the impact? So if a person is taking a loan and then that loan is subsequently waived by the bank, it has the impact of an income. If the loan is originally taken for revenue purpose of the business, cash credit or overdraft or term loan is taken for revenue purpose. Revenue purpose means to pay the arrears of salary, to pay the arrears of GST demand, or to pay the arrears of electricity power expense, or that that loan has been taken and used it as a working capital, then we can say that it is taken for revenue purpose. But if the loan is taken for capacity enhancement, or if the loan is taken to purchase a new asset, then it is capital purpose. If it is asset related, the waiver of loan must be adjusted to the cost of the asset, should be reduced from the cost of the asset. But if it is for revenue purpose and the loan is subsequently waived by the bank, then the principal amount waived by the bank should be treated as an income and it should be taxable under PGBP. So if there is interest arrears, that is also waived by the bank. Okay, if there is interest arrears also is there, that is also waived by the bank, then that should not be treated as an income, because normally bank interest or public financial institutions interest, that is interest paid or payable to the bank or public financial institution, it will be allowed as a deduction under the income tax law as per section 43B only if it is actually paid. If it is outstanding, it will never be allowed as deduction under tax law. So if you didn't claim the deduction under tax law regarding interest, then subsequent waiver has no impact, not at all income. But if earlier claimed as deduction and now waived off, income. So regarding interest outstanding on the loan which is waived off, if interest is also waived off, if earlier that interest is allowed as a deduction under income tax law, then its waiver subsequently will treat it as an income. If it is not earlier allowed as a deduction due to the operation of section 43B, then its waiver does not result in income. This is interest part. Regarding principal part, very clear. If the loan has been taken for revenue purpose and subsequently it is waived off, it is income. If it is taken for capital purpose and waived off, it is not an income. But if capital purpose, if it is specifically related to asset purchase or something like that, then the waiver should be adjusted to the cost of the asset. ICD is also clearly saying, if it is directly related to an asset, it must be reduced from the cost of the asset. So these are the provisions regarding loan taken and subsequently waived income tax treatment. Now the chargeability, second part, 41. Deemed profit. So total there are 5 items which are prescribed under section 41 as deemed profit. So the first item, any expense, interpretation, any expense, 30, 31, 32, 33, 34, 35, 36, 35D, DDA, 35E, 36, 37, any expense from 30 to 37. Earlier you claimed as deduction under the tax law in any prior year. Now in the current year, that expense, no more an expense, that expense is waived or recovered back. So if any expense earlier claimed as deduction, subsequently recovered, or in other words we can say cessation or waiver of a trading liability. Cessation or waiver of a trading liability. So one thing is very important, section 41 applicable only if assessee maintains books under mercantile system, accrual system. If you are maintains books under cash system, these items will not be there. Mercantile system. So you purchased certain raw materials on a credit basis. So what is the original entry? Purchase account debted to party. Purchase is debited to trading account. Party put under balance sheet. Total 10 lakhs rupees. And that 10 lakhs rupees you claimed as a deduction as a purchase. Raw material purchase under section 37. You claimed a deduction debited to P&L. Allowed because it's a raw material purchase. Normal business expense. 10 lakhs. But there was certain quality issues. So we bargained with the creditor and we are saying we will not give you 10 lakhs rupees. So that year is over, 2 years is over. At the third year, there is a time for settlement. At that time, creditor is saying, okay, I does not want 10 lakhs rupees, just 6 lakhs I am ready to settle. So we are making payment to the creditor only 6 lakhs. But that 10 lakhs liability is settled for 6 lakhs. So in our books of account, there will be 4 lakhs credit balance in party's account. So that 4 lakhs credit balance in party's account will be close to P&L. Under the income tax law, it is called deemed profit. Under accounts, we will call it as discount on creditors or profit on settlement of creditors will be credited to P&L. Under the income tax law also, it is income. So if it is not credited to P&L, we have to add it to net profit. if it is not credited to P&L. Sometimes they may account that credit balance into somewhere else, not into the P&L. Then we have to add back. So that is cessation or waiver of trading liability. Actually, loan taken and waiver is coming under 41 subsection 1. So this provision, this is actually a circular, CBDT circular, loan waiver. Actually, it is coming under 41(1) because working capital purpose loan taken means all the loan amount has been spent for various expenses which will be debited to P&L. Salary payment, working capital. Loan taken, salary paid, salary debited to P&L, claimed it. Subsequently, loan waived, income. Loan taken for payment of GST arrear and it is GST claimed as deduction. Then loan is waived, income. So 41 subsection 1 is very wide. Any type of expenditure earlier you claimed as deduction, but subsequently it is waived off or recovered or get it back, it must be treated as business income, taxable under section 41 as a deemed profit. It's very, very important, this particular item. Sometimes some people will pay GST collected and they paid to the government, and then they will go under dispute. It was actually not liable. And in the dispute, court announced that levy is illegal and refund to clients. So if the refund directly getting to the person who originally paid it, it is actually section 41, deemed profit. But usually directly that credit is very difficult to get because it will be credited to consumer welfare fund because there is doctrine of unjust enrichment under GST. Directly we won't get the refund. If the person who incurred that GST directly made the application, he will get the refund. But sometimes if we prove that the liability has not been passed on to the customer, then we will itself will get the refund. In that situation, whatever GST paid under dispute, earlier sale tax which is paid under dispute, and then court or tribunal made the decision that levy is illegal, give refund. So if we got refund from the GST department, that refund must be treated as income, 41(1). And subsequently, if that refunded money has been again refunded to customers, you can claim it as expense. So it is very important. There is a Supreme Court case, Polyflex India Limited. In that case, Supreme Court clearly mentioned under the income tax law, if any IDT paid under dispute and you obtain refund, it is an income. And subsequently, when that money is ultimately paid to customers from whom you collected, then you can claim it as an expense. But if the refund is not received by us, credited to consumer welfare fund, then it is not an income. If assessee obtained the refund directly from the GST department after the case won by the assessee, after the dispute, then it must be treated as an income under section 41, Polyflex India Private Limited. It's a Supreme Court case. And one more issue, sometimes March 2025, High Court or Supreme Court decision came, order came in March 2025. This amount should be refunded to clients. But department refunded in April 2025. Just 1 month, but 2 financial year. So the question is whether it should be taxable as deemed profit in 24-25 or 25-26. So JK Synthetics Limited, Supreme Court, they are saying only when it is actually received. So only in April 25, that means 25-26, it is taxable under section 41 as business income. So regarding this first item, even though it is a single sentence, cessation or waiver of trading liability for expense earlier allowed as deduction subsequently recovered, the practical implication is very wide. And then second one, under the tax law, only one assessee can claim depreciation under straight line method, that is an assessee engaged in generation of electricity power. So they can claim depreciation straight line method as an option. They may have an option to choose WDV at the first year itself. Once they select it, they cannot change. So if they are opted for straight line method and depreciated asset on straight line method, and then that asset is sold, and if there is a profit, earlier what is the depreciation claimed on that asset, to the extent of that amount, that depreciation already claimed, what is the profit you are getting, that profit should be taxable as balancing charge. That we will discuss an illustration while we studying section 32 today. At that time we will discuss the illustration. At that time again I will explain balancing charge. Okay, now I am not going too much discussion. Now going to the third item, already discussed, that is scientific research asset for which you originally claimed deduction under section 35 and subsequently after the research purpose is over, you sell it out. Then the selling price or original cost of that asset, whichever is lower, deemed profit under section 41. If they are not considered in P&L, we have to add because it's a deemed profit. And if the selling price is over and above original cost, definitely there will be capital gain also. So that is scientific research asset, just like that of 35 AD. Sometimes after the scientific research purpose is over, as a tax planning, assessee will not sell it off, because if he sell it off, deemed profit will arise. So there will be another interesting provision. Sometimes they will take that asset into block of asset. From R&D department, asset is taken and go to factory. So if it is a plant and machinery, already in the factory there is a plant and machinery block. In that block, research asset is coming. Then what is impact? Then the actual cost of this asset will be taken as zero. So there are two possibilities. After the research is over, the research asset may be directly sell it off, or you can brought it into block of asset. If it is directly sell that asset, this is the treatment. Original cost or sale price, whichever is less, deemed profit, and over and above original cost, capital gain. But if that asset is brought it into block of asset, there will be no business income, because it is part of block. But actual cost is nil, because if you put any figure as actual cost, you will claim depreciation. Actually, the entire cost of this asset originally allowed as deduction to the tax law. Already you got the 100% cost of that asset is you got this benefit. So again, if the cost is allowed, you will get again depreciation, double deduction. That is not possible. So that is why they are saying actual cost is nil, but you can escape from deemed profit. Once you put under the block, and then after 1 year or 2 years, if you sell that asset, there will be no deemed profit, because if a block of asset is selling, we will reduce from block. So block is decreasing, depreciation will decrease. There will not be a direct income impact. So usually the large corporates, when they want to dispose the scientific research asset, they will not sell it off. They will simply put it under block of asset. Maybe 2 year or 3 year, they will use it for some business purpose. Then they will sell it. So the sale price will be reduced from block only. Directly no income is applicable. So direct income is applicable only when after the research is over, or we does not want that asset for research purpose no more. Directly selling, at that time deemed profit arises. So now we will take a small break, then we will come back and discuss. Okay. From section 32 onwards, we can start numerics problems. After that, provision analysis is important. And if you have any doubts, you can ask. Okay. It will be interesting. earlier claimed as deduction. So there is one more condition you have to keep in mind. Earlier claimed as deduction and allowed as deduction. Sometimes we are claiming bad debts under income tax law. We are claiming, we are debiting to P&L, but assessing officer may not be allowed that. So if a bad debts is not allowed, means disallowed earlier, now that is recovered, no tax impact. So earlier allowed as deduction, and now it is get it back, recovered. It is a deemed profit as per section 41. If it is not treated as an income into the P&L, then we have to add it to net profit. Treat it as a deemed profit. There is an important point you have to keep in mind. In case of amalgamation, demerger, conversion of company into LLP, proprietorship is taken over by a company, that is known as succession of a firm's business by a company, or partnership business or proprietor's business by a company. So there are two succession. Proprietary concern is taken by a company, or partnership firm is taken by a company. And one conversion, private company or unlisted public company can be converted into limited liability partnership. A public company cannot be converted into an LLP under the tax law, but a private company or unlisted public company can be converted into LLP. Then amalgamation, then demerger. One more thing, inheritance. Father or mother is carrying on business, after their death, the children continuing their business, that is known as inheritance. So in these 6 cases, sometimes the bad debts is claimed by predecessor. Amalgamating company or vendor company or the old company claimed bad debts, and then amalgamation took place. So amalgamated company getting some money from the old debtors, that is recovery happened in the hands of the successor. Now the question is whether section 41 can be applied for the successor, whether deemed income taxable in the hands of the successor, because bad debts is claimed not by the assessee, by the predecessor. So section 41 Act says even though the bad debts is claimed by the predecessor, but that recovery happened in the hands of the successor, section 41 applicable, it must be taxable in the hands of the successor. So in these 6 cases you have to keep in mind. Sometimes in examinations, see a final comprehensive question, they are asking adjustment like this to confuse. So they will say actually this recovery of these particular bad debts earlier claimed by the predecessor in 2021-22 or in 2016-17. Later on this company got into merger with this company. They will say like that. So but still 41 applicable. Similarly, there is another provision regarding bad debts deduction that we will discuss in 36. Sundry debtors created by predecessor, but bad debts arise in the hands of the successor. So successor write it off, but debtors claimed by predecessor. Veerabadran Rao K. Koteshwara Rao, Supreme Court case. So Supreme Court says if the predecessor's same business is carried on by the successor, even though debt is created by the predecessor, bad debts allowed to the successor under section 36. Similarly, recovery also, even though the bad debts is claimed by predecessor, but recovery happened in the hands of the successor, section 41 applicable. It must be taxable as an income in the hands of the successor. Now next one is amount withdrawn from special reserve. So that is for public financial institutions and the banks, mandatorily they have to create a special reserve as per the RBI requirement. So whatever profit is transferred to that reserve, they can claim it as a deduction up to 20% of their income. That we will discuss in section 36. So once they transferred it to special reserve up to 20% of the current year profit, they can claim it as deduction. And later on, if that money has been withdrawn from that special reserve, it must be treated as a deemed profit. Not that much relevant, not that much important for final. But anyway, we have to know there is a provision like that. When we are transferred to a special reserve, at the time of transfer, we can claim interest deduction, and when it is withdrawn, it is treated as deemed profit. Applicable only for banks and public financial institutions. Only they can claim that deduction. So, for those who are claiming that deduction, this provision is applicable. Now, generally, under the income tax law, a loss can be carried forward and it can be set off up to maximum 8 assessment years. In case of normal business loss, even capital loss, we can carry forward for 8 years, 8 assessment years. 8 assessment year from the end of the first assessment year in which loss was computed, maximum 8. But in 35 AD business loss, infinite period. Unabsorbed depreciation under section 32 subsection 2, infinite period. All other losses generally 8 years, and 2 losses 4 years. Speculative loss 4 assessment years, and owning and maintaining racehorse loss 4 years. These are the 4 years. All others are 8. 35 AD, unabsorbed depreciation, infinite period. But even though in case of a business loss, even after 8 years, we can set off a particular loss. So that is, if a person getting any one of these first 5 income, that is first item, that is any expense earlier claimed as deduction subsequently recovered, or balancing jar, or scientific research asset sale proceeds, or bad debts recovery, or withdrawn from special reserve. Any one of these income received by an assessee even after 8 years, that means business is discontinued, business is stopped, discontinued, and in the year of discontinuance there is a loss. Year of discontinuance there is a loss. Say in 2016-17 the business is discontinued. The year of discontinuance 16-17, that assessee has a business loss of 8 lakhs. 8 lakhs. So that loss is carried forward. So now 8-year time is expired. 8 year is over. During the year 24-25, 8 year is over. 16-17 is the assessment year. First assessment year 16-17. 17-18, 18-19, 19-20, 20-21, 21-22, 23-23, 23-24, 24-25 assessment year. Last assessment year is expired. Loss is expired. Time period expired. Current year 2024-25, that is assessment year 25-26, or maybe assessment year 26-27. If there is any recovery of any one of these items under section 41 from that business, there is a tax planning. Such a loss which already got expired can be taken, can be set off against this income. So this is the only case where loss can be carried forward even after 8 years. That is when there is a discontinuance of business. In the year of discontinuance there is a loss, and that loss can be taken and set off against an income prescribed under section 41 which is received even after 8 years. So if it is received after 8 years, any of the recovery from this section 41, and that same business has loss in the year of discontinuance. So any year prior to the year of discontinuance, if there is an accumulated loss, that won't be permitted. The loss of the year in which business is discontinued, that loss can be taken even after 8 years, and you can set it off against this income. So this is the privilege. It's a tax planning, because generally loss set off is provided from section 70 to 80 of the income tax law, but this loss is fixed in section 41, so that is why time period is not applicable. Even after 8 years you can set off if there is a receipts from section 41. Now first item, section 41 subsection 1, any expense earlier claimed as deduction subsequently recovered, or cessation or waiver of trading liability must be treated as a business income. Okay, related to that you have to study this case law. No need to remember the name. If you are able to remember, you can do that. Otherwise the concept is very important. Indirect taxes like GST or excise duty or customs duty or sale tax or these type of taxes, especially indirect taxes, has been paid under protest, and we filed a case, and finally case decision came. We won the case, and if you obtain refund, that refund must be treated as deemed income, taxable under section 41. Polyflex India Private Limited, Supreme Court 2002 decision. And JK Synthetics Limited. JK Synthetics Limited is little bit different concept. In which year that recovery or that refund should be taxable? Whether in the financial year in which court order came, or whether in the financial year in which amount is actually received as refund. So if these two are in two different financial years, then the amount should be taxable as deemed profit under section 41 when we are getting actually the refund of the GST or customs duty or excise duty as the case may be, applicable to indirect taxes. Originally this case happened, it related to sale tax, but now instead of sale tax, GST. So sometimes they are asking questions like this. Earlier in 2011 or 12, they asked an adjustment. Question says, total indirect tax GST paid under protest 10 lakhs. Out of this 10 lakhs, we filed a case under protest, we paid it. Decision came, 6 lakhs refunded. 6 lakhs refunded. Out of that 6 lakhs, 4 lakhs distributed to ultimate customers who incurred that tax liability, who incurred the burden. Out of 6 lakhs, 4 lakhs distributed. Balance 2 lakhs put in balance sheet under current liabilities, not refunded. This is adjustment. Total 10 lakhs paid under protest, 6 lakhs obtained a refund, 4 lakhs. Again, we obtained the refund and we distributed to the ultimate customers who paid the tax, and balance 2 lakhs put in balance sheet liability at current liability. So the adjustment is simply take that 2 lakhs shown in current liability, added to net profit, and put this case low. It is deemed income. Sir, what about that 4 lakhs? Current year refund obtained and distributed, so offset, zero effect. Current year obtained 6 lakhs refund and 4 lakhs distributed to customers in next year. Okay, then in the current year to the net profit add 6 lakhs. And next year when you redistribute that 4 lakh to customers, claim it as deduction. Sir, what about that balance for 2 lakhs? Balance 2 lakhs, if it is distributed to again paid it to customers, you can claim it as deduction. Otherwise it is income. Because earlier you paid it, claimed it as deduction, now you obtained a refund, it is income. So if it is again repaid to the ultimate customers from whom we collected the tax, claim it as expense. So they asked some 2-3 times this adjustment. Actually it is related to section 41. Indirect taxes paid under protest. Now 41 is over. In 41 first item, usually examination the adjustment is sundry creditors waived off. Regularly they are asking that adjustment. During the year 2022-23, raw material purchased for 20 lakhs and charged to P&L. In the current year, out of this 20 lakhs, 5 lakhs waived by creditor, which has not given effect to the books of account. So that waived 5 lakhs is deemed income, added to net profit, because they are clearly saying not adjusted in books. That means still it is showing as credit balance in creditors balance, creditors account. We have to take it as income. So added to net profit. So once we know the provision, read the question. In question what they are saying, in books of account what they actually done. Now correct that. Sometimes you have to add it, sometimes you have to do nothing, sometimes you have to reduce it, and then we make an adjustment separately. So once we know the idea, in applying question depends upon situation of the question. In question or in books of accounts what they are already doing or what they already done, that we have to understand, then make the adjustment. Okay, so provision is like this. So section 41 is over. That means chargeability part, we can say that it is over. Chargeability part, there are two sections, 28 and 41. It is important, especially some of the theory prescribed in these sections are, they are asking as practically adjustment in compulsory question. Remember, PGBP 99%, they are asking in compulsory question. So for the first question, we need all these points. Now, there is a High Court decision regarding classification of head, whether PGBP or IFOS. SSC is doing lottery business. So to do the lottery business in a state, remember as per Indian Constitution, lottery is a state subject. Lottery is a state subject. So state government license is required. So to do the lottery business, SSC want to obtain the state government license. To obtain the license, they applied. So at that time, the state lotteries department is requiring the SSC to produce a bank guarantee. So to obtain bank guarantee, SSC approached the bank. So the bank is saying, we will provide you the bank guarantee, but equivalent amount of fixed deposit, you have to make it, because you are not a regular customer of the bank. So if you put a fixed deposit, equivalent amount guarantee we will provide. So he made a fixed deposit with the bank. Bank provides bank guarantee. That bank guarantee is submitted to state government. He obtained a lottery license, started lottery business. At the year end, this FD generated interest. So usually under the tax law, FD interest is taxable under income from other source. No doubt. Even though surplus business fund is FD, put it as FD, surplus profit, obtained interest, IFOs. Income tax refund, we obtained interest, IFOs. No doubt. Interest is income from other source. Here the question is, to obtain the bank guarantee, we put the fixed deposit. Why we obtain the bank guarantee? To get the license. Only if we got the license, we can do the business. So our main business is lottery. To obtain the license, we obtain the bank guarantee. To obtain the bank guarantee, we put the FD. So assessee is saying it is absolutely business income. That FD interest must be taxable under PGBP. Department is saying no. It is not into PGBP. It should be taken to income from other source. Sir, what is the relevance if it is taking in PGBP or IFOs? Anyway, it is income. Then what is the difference? See, if an item is put under PGBP, we can claim all the expenses from 30 to 37, numerous expenses. So definitely the income will be zero or loss, or income will be lower. But in IFOs, there is limited deductions. So if you put the income under IFOs, there is a possibility to pay tax. But if it in PGBP, the income will be less. So that is why people are making this type of classification. But now in this particular case, contention of the assessee is, as this interest income is inextricably connected to our existing business activity or to start our business, it is related to business. So it should be taken to PGBP. It should be taxable under PGBP. But department is saying no, it should be taken to IFOs. And the case went to High Court. So High Court says it is PGBP. The reason is the connection. The main business is lottery. To do the lottery, we have to obtain the license. To obtain the license, we need the guarantee. To meet the guarantee, we made the FD. So it is connected to the business. It should be taken to PGBP income. K and company. Actually, it is not a company. It is a firm. It is a partnership firm. So exam purpose, the importance. If you don't read this case law and if you are not aware about this provision, usually FD interest you will take into IFOs. What is the problem? For a partnership firm, for an LLP, partner's remuneration is related to book profit. Book profit means current year PGBP income computed from 28 to 44. So if this interest income is put under IFOs, not into PGBP, your book profit will be wrong. If the book profit is wrong, remuneration, everything is wrong, you won't get the mark. Even practically also it is important, because in some areas, current year PGBP income is important. Based on that, some other deductions are allowed. So if you are taking this item into IFOs, not into PGBP, the answer is wrong. So it is important. It is important. For a partnership firm and LLP, current year PGBP income is very important. So in that case, if an item which is taxable under PGBP, if you are put it into IFOs, the PGBP income will be wrong. Accordingly, book profit will be wrong. So any calculation based on that book profit will be wrong. Okay. Now, some of the concluding points related to 28 and 41. One is business gift. We already discussed. Remember, by just seeing gift, don't jump into the conclusion that IFOs gift is only last. First see who is giving the gift, who is getting it, what is the relationship, employer-employee, salary, business client, professional client, PGBP. There is no these type of connections. Okay, then see whether the gift is covered under jewelry, archaeological collection, work of art, paintings, sculptures, bullion, shares, securities, land, building, and it must be capital asset for the recipient. I am a jewelry trader, gold jewelry trader. My friend gifted 1 kg gold in my birthday. No income from other source. Why? It is stock. Okay. If there is a friend who is gifting 1 kilo gold to me, probably I will not sit here and teach you, right? 1 kg gold means more than 1 crore rupees, right? Put it into FD, get the interest, enjoy, right? Now the gold price is around 82,000, it's jumping, right? Estimation is it will reach up to 1.5 lakhs. That's a prediction, maximum possibility. There is also possibility that it may come down, right? So this is the provision: business gift, professional gift, PGBP. Okay. Other than these two, no employer-employee relationship, no business-client relationship, but under the defined property list, and it is capital asset, value more than 50,000, IFOs. If a gift not coming under these three category, not taxable anywhere under the provisions of income tax law. Earlier example, my birthday, my friend gifted me BMW car. Not taxable anywhere under the provisions of income tax. There is no provision, right? It is not an income, it cannot be taxable. Even mobile phone gifted, not taxable. But I am a businessman, my customer gifted me mobile phone, some sort of a business connection is there, PGBP. Legal or illegal income is taxable. This is a very interesting point under the tax law, very interesting principle. When it is come to expense, they will always say legal expense only will be allowed. Illegal expense will not be allowed. Explanation 1 and explanation 3 of section 37. Any expenditure which has any illegal element or tainted element, it will not be allowed. It will be disallowed. But when it is come to income side, it is silent. Whether legal income or illegal income, it is taxable. Okay. So income, tainted income as well as legal income, both are taxable. But when it is come to expense, legal expense only will be allowed. Illegal expense not allowed. Sir, what about losses? Loss, even though illegal loss, it is allowed. Why? Because income, legal or illegal, taxable. Income, negative means loss. So loss, legal, illegal loss allowed. But expense and loss, not the same. Expense is different, loss is different. Now, a person who is a dealer in share, instead of selling some shares, is exchanged. Some shares is given to another security trader and obtained some new shares of some different companies. So share exchange, definitely there will be PGBP income. What is the fair market value of the shares exchanged? That is deemed to be sales. So difference between that fair market value and the original purchase cost of that share, difference is the business income if you are a share trader. So instead of selling, even though a share trader making share exchange, that is also deemed as a business income. Supreme Court case, Orient Trading Company, it's an old Supreme Court case. So these are the major points you have to keep in mind. Some other points you have to keep in mind. Vacant plot of land. Sometimes some businessman will have some vacant plot of land and which will be let it out. So rental income from vacant plot of land, income from other source. It cannot be taken to PGBP. Unless your main business is leasing of land, okay, then it is PGBP. If your main business is some manufacturing or some trading, and you have some land, vacant land, let it out, then it will be taken to income from other source. Main activity is manufacturing, some building, part of the building is let it out, HP, house property. Main business itself is letting of properties, development and letting of property, PGBP, no HP, PGBP. So these are the main point you have to keep in mind. Chargeability side is over, you are going to expense side. So income side, these points you have to keep in mind. We will solve some good questions. At that time we will again practice some exam oriented adjustments. Okay. Now we can go to the expense side. So simply speaking, what we discussed is credit side of P&L. Now what we are going to discuss is debit side of P&L. So under the income tax law, income means net of expense. Salary, expense section 16. House property, expense section 24. PGBP, expense 30 to 37. Capital gain, expense 48. Cost of acquisition, improvement, expense for transfer. IFOS, expense is 57. Remember, income tax on income. Income means net. Net means gross minus expense, net. Okay, if that is negative, loss. So what are the expenses allowed under PGBP? So the first one, section 30. Before starting expense, I will tell you a common point. From 30 to 36, specific deductions. Name of expenditure and condition clearly mentioned each section. That is known as specific, no ambiguity, not general, very clear. Name of expense, condition specified. Majority of the business expenses are not covered from 30 to 36. So go to 37. For those expenses which are not covered from 30 to 36, claim under 37. Under 37, no name of expenditure, but some 5-6 conditions are mentioned. If those conditions satisfied, any expense you can claim under 37. So this is the way they are structured the provision. So first 30, expense related to building. So building must be used for business or profession. If the building is used for business or profession, for expenditure related to that building, you can claim it as a deduction while computing VGBP income. Number 1, rent paid as a tenant. Rent paid as a tenant. So if you are carrying out your business or profession in your own building, you are not a tenant. You cannot claim rent. Notional rent, not allowed, not allowed. So rent paid as a tenant, that's very important. So you are carrying out your business or profession in a rented building. So that rent you can claim it as a deduction under section 30. Remember, building used for business. 10,000 square feet building has been taken on rent. Only 6,000 is used for business. Balance 4,000 sublease. Entire 10,000 rent you cannot claim. Only rent attributable to 6,000 square feet you can claim under section 30. Balance 4,000 square feet you sublet. Okay, subleasing. So rent from sublet IFOS. So that 4,000 square feet proportionate to rent paid can be claimed as expense under IFOS. Section 57. So building used for business, rent paid as a tenant. So related points, if the rent paid or payable for the financial year exceeds rupees 2,40,000 as per section 194I, you have to deduct TDS, and that TDS must be paid to the government before the due date for filing income tax return. Otherwise, 30% of that rent debited to P&L must be disallowed. And from next attempt onwards, from May 2026 onwards, the TDS limit has been changed. If monthly rent is more than 50,000, TDS will be applicable. 194I, monthly rent. This limit has been changed in Finance Act 2025. Not applicable for Jan exam, but for May exam onwards, the rent will be monthly 50. That is a trap. Here it is annually 2,40,000. New provision says, new limit says, monthly rent exceeds 50,000. So even though you take it by building for 3 months rent, you are liable for deduct TDS if the monthly rent is more than 50. So it's a new provision. But for assessment year 25-26, this is a provision. If the rent exceeds 2,40,000 in a financial year, TDS is applicable. TDS must be deducted during the previous year, and deducted TDS must be remitted before at least before the due date for filing income tax return. That is, if tax audit is not applicable, 31st July of assessment year. If tax audit is applicable, October 31st. And if it is a company, October 31st. So before that, the rent, TDS must be paid to government. Otherwise, 30% of that rent expense will be disallowed. Suppose if the rent is paid or payable outside India, section 195, not 194I, 195, TDS must be deducted. Otherwise, not 40A1A, 40A1, 40A1, 100% of such a rent expense debited to P&L will be disallowed. So 40A1 or 40A1A may be connected to this item if the rent exceeds the prescribed limit. TDS provisions will be applicable. So even though section 30 says rent paid as a tenant will be allowed, it is subject to other conditions or other sections. Second item, current repair. Current repair. So what is current repair? Current repair means revenue nature repair. Revenue nature repair means a repair expenditure will be treated as revenue if it is incurred to preserve and maintain an already existing building. So to preserve and maintain in the present position, exact position, we incurred some expenditure to maintain that. That is current repair. But by incurring the repair, if the capacity of the building is increasing, then it is capital nature. Go to 32, add to block and claim depreciation. If you are owner, you take the building under a lease agreement and incurred a capital expenditure, in that case also you can claim depreciation under section 32. If it is a revenue repair, you can claim under section 30. And here also there is a possibility, large companies, they will have a huge factory, there will be annual maintenance, they will give it as a contract, and if the contract amount exceeds rupees 1 lakh or single payment exceeds 30,000, 194C, TDS must be deducted, TDS must be remitted before the due date, otherwise same disallowance, 40A1A, 30% of that repair expenditure under a contract will be disallowed. So current repair, there is a possibility of TDS 194C, because usually business building repair will be given as a contract. So 194C will trigger. Third one, insurance premium to ensure the building can be claimed as a deduction. Usually it will be incurred by the owner, because owner only will take insurance for his own building used for business. So insurance premium can be claimed as deduction. And the fourth item, that also will be paid only if the assessee is the owner of the building, municipal tax or property tax for the building. If the building is rented out, rental income HP, then municipal tax HP you can claim, house property, gross annual value minus municipal tax paid, net annual value. If the building is used for your own business or profession, the municipal tax paid can be claimed as deduction under section 30. What is a related connected provision? 43B. As per section 43B, any duties or taxes payable to central or state or local authority, it will be allowed as an expense only if it is actually paid before the due date for filing ITR. So if you are following mercantile system of accounting, municipal tax is due, debited to P&L, not enough. It should be actually paid before the due date for filing ITR. Otherwise, as per section 43B, it must be disallowed. So this is 30. Now some critical issues. Issue number 1. Partnership firm taken a building belonging to the partner. Firm is doing the business at the building belonging to the partner. So the firm is paying rent to the partner. So now there is a confusion whether this rent will be allowed to the firm, because as it is paid to the partner, he is one of the owner of this firm. So whether it will be allowed. So under the income tax law, not like foreign countries, in India, partnership firm and partner both are different. But in a lot of foreign countries, they will be treated as fiscally transparent entity, only one entity. Partner only will be taxable, firm will not be assessed separately in foreign countries. But in India, partnership firm is very popular. Under the tax law, firm is different, partner is different. So it's very clear, even though the firm is paying rent to the partner, it is allowed to the firm as an expenditure, but on condition, partner is a related party of the firm. So as per section 40, capital letter A, subsection 2, 40A2, whenever you are making a payment of expenditure to relatives or substantial interested persons, that expenditure should be made at a fair market value. If the rent is more than the fair market value paid to partner, then excess will be disallowed as per section 40, capital letter A, subsection 2, 40A2. So that provision you have to keep in mind. So in assessment of firm and LLP questions, they may ask these type of adjustment. So if the rent is paid or payable by a firm to the partner, building belonging to the partner, if there is a rental agreement and paying rent at a market rate, no problem. It is allowed as a deduction and subject to TDS also. But if the rent is paid in excess of the market rate, excess must be disallowed as per 40A2. Got it? 30 is over. Now section 31. Expenses related to plant, machinery and furniture. Plant, machinery or furniture. Under the income tax law, the word plant and machinery does not mean plant and machinery. Plant and machinery means any asset which is not coming under building, not coming under furniture, not coming under intangible asset. All other assets are called as plant and machinery. So that word meaning you have to keep in mind. The income tax law, professional book is plant and machinery, bike is plant and machinery, car is plant and machinery, lorry is plant and machinery is plant and machinery, computer is plant and machinery. So keep it that word, right? Not literary meaning of plant and machinery. Residuary classification. Furniture. Only two expenses mentioned in 31. Current repair. Current repair means expenditure incurred to preserve and maintain an existing machinery. Machinery has been serviced, greasing, oil change, nuts and bolts changed, parts damaged, replacement of parts, belt broken, replacement of belt. That is current repair. Or just painted to prevent the rust, current repair. So replacement of parts of existing machinery is always current repair, irrespective of the cost incurred for repair. Cost of the machinery 1 crore rupees. Cost of the machine 1 crore. One of the parts damaged. The damaged parts replacement expenditure incurred rupees 65 lakhs. 65 lakhs. Machinery cost is 1 crore. It doesn't matter whether it is 65 lakhs or 70 lakhs or 75 lakhs. As far as it is a replacement of parts of existing machinery and there is no capacity enhancement, we are getting the same benefit as earlier. Substantial life is not extending, only to maintain the existing asset. It is absolutely revenue expenditure. So don't see at the cost. See what's the purpose. To preserve and maintain the existing asset, current repair, you can claim under section 31. So usually machinery plant repair will be given by corporates as an AMC, annual maintenance contract. So it will be a contract. So it will come under 194C. If the payment exceeds 1 lakh in a financial year in a contract or single payment 30,000 crosses, it will be liable for TDS under section 194C. If the TDS has not been complied, for TA 100 disallowance is possible to attract. 30% of that repair expense debited to P&L may be disallowed. And if the repair is given as a contract to a non-resident or a foreign company, then 195 TDS must be deducted. Otherwise, 100% of that expense debited to P&L can be disallowed. So TDS and disallowances are connected. Second, insurance premium to insure the, not the building, to insure the planned machinery furniture can be claimed as deduction. So planned or machinery or furniture insurance premium can be claimed. So one item is missing here compared to section 30, that is a rent of planned machinery furniture is not mentioned in section 31. It is purposefully not mentioned, but no need to worry, we can claim it under section 37. So rent of planned machinery furniture, even though not specifically mentioned in 31, we can claim under section 37 because it is a general business expenditure, rent of planned machinery furniture. Sometimes if the cost of the plant and machinery is very huge, people will not buy it, but they will take it on hire. So that rent can be claimed as deduction under section 37. Again, rent of planned machinery furniture, if it exceeds 2,40,000, 194I will trigger. If TDS is not complied, then 30% of expenditure can be disallowed. So section 31 is over. So 30 and 31, these type of some case laws related question they may ask. There is an old very interesting case is there. Dr. Shanti Bhushan, that is a advocate who is a legal counsel or advocate, incurred some heart surgery expenditure, some bypass surgery expenditure. He claimed it as a plant and machinery current repair and claim it as I'm a lawyer, my health is more important. So there is a heart surgery expenditure that is related to the profession. It must be treated as a current repair of plant and machinery. But it is not possible because it is absolutely personal nature. And heart or kidney cannot be shown as a plant and machinery in the balance sheet. It is absolutely personal. So it is not allowed as a deduction. Dr. Shanti Bhushan. Lot of other case laws are also there. Replacement of parts and replacement of machine, both are different. The word starting is replacement. The next one is the change. Replacement of parts, that means already there is an existing asset. Some damaged parts is replaced. New parts is purchased and repaired. So that is absolutely current repair. But if replacement of machine, old machine is sold and new machine is purchased, that is absolutely capital. You should go to block of asset. What is the amount received for old asset? Reduce from the block. What is the cost of the new asset? Add and claim depreciation. So replacement of parts of existing machine, revenue nature 31. But replacement of machine and purchase of a new machine, that is capital nature. 31 is over. Yeah. Didn't get that. Business has been rented building. Okay. Yeah. if the business has not been commenced in that year, that rent cannot be claimed as a reduction. Under section 30 or 31 or even 37, expenditure should be incurred during the previous year. So during the previous year, there should be income. If the income arises in that year, then only you can claim corresponding expenditure in that year. Yeah. No, you've taken a building. You are paying the rent. But in that building, you are not started the business. But in the other places, you taken for your business purpose, right? For related to this business, but didn't utilize. You cannot claim it as a reduction. It will be come under pre-operative expense and it will be treated as capital nature. You cannot claim it there. Even a single day, if that building is used for your business, enough. You can claim for the entire or pre-commencement like that. So it won't be allowed. Building must be used for your business or profession means that particular building must be used for business or profession. You can claim. 32. Depreciation. It is a very important section. So first I will tell some basic points, then we will go further in detail, in depth. Depreciation is a mandatory deduction. As per explanation to section 32, depreciation is compulsory. You must claim depreciation. If you have asset, you are the owner and you are using it for your business purpose, you must claim depreciation. Depreciation is a mandatory deduction. Suppose if assessee omitted to claim depreciation, then while computing the taxable income of that person, which is taken by assessing officer under assessment purpose, then assessing officer bound to calculate depreciation and allow it. So there are some judicial rulings, high court decisions, which says that as per explanation to section 32, depreciation is mandatory. That means even though assessee did not claim it, then assessing officer while completing the assessment is under an obligation to reduce depreciation. So depreciation is a charge on profit. It is a capital allowance. It is a must to claim. So that's a primary point. And second, under the income tax law, the only method possible is written down value method. Only for power generating assessee, they can claim depreciation under straight line method. That is also optional. All others, depreciation must be computed on WDV method. And the third point is rate of depreciation as prescribed under the income tax law. We cannot take our own rates or Companies Act rate. We have to compute depreciation under the tax law as per the income tax rate. WDV rate and straight line method rate are different. So we have to study only the WDV rates. SLM rate is not in our syllabus. So the rate is also different for power generating assessees. And then depreciation is not calculating on individual asset. Depreciation is calculated on block of asset. Block of asset means group of assets or pool of assets. Assets having same nature and same rate shall put together, form a group, and on that group or block we can compute the depreciation. So depreciation is always computed on block of asset. No individual asset. Individual asset have no implication. Only group of asset we are computing the depreciation. But same nature, same rate put together form a block. So these are the primary points you have to keep in mind. Now, legal condition. To claim depreciation, what are the legal condition? Legal condition, basically twin conditions. Two conditions simultaneously should be satisfied. Number one, ownership. Number two, use. So these both must be satisfied. Assessee must be owner of the asset. And number two, that asset must be used for the purpose of the business. Ownership can be further divided into four. Number one, absolute owner. 100% you are the owner. In your name, asset is purchased. You spend the money. You are using it. That is absolute owner. And second one, co-owner. So cost of the asset is huge. So some 2-3 businessmen sharing the cost, both the asset, they are using it on a shared basis. All these three owners can claim depreciation on their respective ownership share. So that is co-owner. And third one is deemed owner. So deemed owner means it is some of the principle emerged from Supreme Court decision, that is practically road transport vehicles like lorry, bus, car, etc. It is very difficult to register in some artificial name. that has to be registered in some natural person's name. So when a company is purchasing a lorry, it will be registered in the name of the director or some of the manager or MD's name on behalf of company, but registration purpose for motor vehicle registration requirement, it will be registered in some of the individual's name. That individual may be an officer or maybe a director in that company. That doesn't mean that the director owns the vehicle. So for road transport vehicles, and similarly in some cases building also, they will be registered in not in corporate's name, some of the directors or managers name, some authority's name, some manager or some natural person. So in that situation, it is known as registered ownership is in the name of some individuals or some managers, but beneficial ownership is belong to that company. So practically, registered ownership is not compulsory, beneficial ownership is enough to claim depreciation, but this rule can be applied only in respect of road transport vehicles and building. For all other assets, there is no need to register in somebody's name. It can be registered in assessee's name. Similarly, when commercial vehicles are purchased and giving for lease basis, sometimes for as per motor vehicle registration requirement, that should be registered in the name of the lessee. Actually, lessor is the owner, but vehicle will be registered in the name of the lessee if it is a long period commercial lease of vehicles. In that case also no problem. The lessor can claim depreciation even though the vehicle is registered in the name of the lessee. So, under the income tax law, registered ownership is not compulsory. Beneficial ownership is enough to claim depreciation, especially in case of road transport vehicles and building. Partnership firm purchased a lorry for business purpose, but that lorry has been registered in the name of a partner. So it is not registered in the name of the firm, but firm incurred the money and registered in the name of the partner. No problem, that firm can claim depreciation. So there also that same rule we can apply. So there are a lot of cases, ICDS Limited, Supreme Court, Shivagami and another High Court, Mysore Minerals Limited, Supreme Court, Podar Cement Limited, Supreme Court. So numerous cases, this principle is well settled. Registered ownership is not compulsory, beneficial ownership is enough to claim depreciation, especially vehicles and building. The fourth type of ownership is partial owner. Partial ownership is applicable only in respect of two cases, that is assets acquired under hire purchase system or installment purchase system. In case of hire purchase system, the moment you make the down payment, obtained the asset on the cash price of the asset, the hire purchaser can claim depreciation. But generally, when we make the last installment payment, we will obtain the ownership or title, but now need to wait until that. The moment you paid the down payment, obtained the asset on cash price of the machine, we can claim the depreciation. Assets acquired under hire purchase system or installment purchase system. But in case of lease, it's very clear, only lessor can claim depreciation, lessee cannot claim depreciation. As per accounting standard, in some cases, lessee is eligible to claim depreciation, but under the income tax law, it's very clear, only lessor can claim depreciation, lessee cannot claim depreciation. So there should be any one of these ownership. That is a must. Either absolute owner or co-owner or partial owner or deemed owner. Plus, during the previous year, that asset has been used. So use of asset. So use of asset, there are two types of use. Any one of these two should be satisfied. So number one, active use or actual use. Second one, passive use or kept ready to use. Active use or actual use means that asset purchased has been actually put to use during the previous year. Even a single day, that asset has been actually put to use. Actually, this rule is applicable in respect of new assets purchased. For an existing asset, this rule is not applicable. Why? Because Act uses the word used in the course of the business. USED. Used means past use is also enough. There is a High Court case, Yamaha Motor India Private Limited. Asset has been purchased 5 years back. For the last 4 years, this asset has been using. In the current year, that asset has not been used, but the value of that asset is available in the opening block. No problem. We can claim depreciation because used means past use also. So this condition implies for a new asset, if you purchased during the previous year, it should be actually put to use even for a single day for a business purpose. If it is not put to use, you cannot claim depreciation. You can add it to block of asset, but depreciation can be claimed only in the year in which it is actually put to use. Even a single day use is enough. Use doesn't mean 365 days you have to use. No. Whenever the requirement arises, you have to use it. And then passive use. Passive use means an asset is not actually put to use, but ready to use. Kept ready to use. So practically standby machines, emergency power backups, diesel generator set, inverters, firefighting equipments, standby machines. So these are the examples of assets kept ready to use. So in case of emergency, we can use it. So otherwise it is a ready to use. So for those assets also we can claim depreciation, even though that asset is actually not put to use, but was kept ready to use. That's enough. We can claim depreciation. So this is passive use. So passive use is very limited to these type of assets. That is examples: standby machines, diesel generator set, fire extinguishers, etc. Actually not put to use but kept ready to use, that is eligible for depreciation. Now there is another issue related to use. There are two types of interpretations. One set of interpretation says used in the course of the business means used by assessee itself. Another set of interpretation. Used in the course of the business means anyway it should be used for your business purpose. Whether it is used by you or whether it is used by some other person, whether the asset is located in your premises or whether the asset is located in somewhere else, it doesn't matter. As far as it is used for your business purpose, you are eligible to claim depreciation. An ice cream manufacturing company, in order to increase the sales, call for dealership or distributorship. So a lot of distributors came. So there is an issue. Ice cream should be stored in a cool environment. So for that purpose, they need large freezers, deep freezers or freezers. So freezer is very costly. So company is saying a suggestion. We will do one thing. We will buy the freezer. It will be given to you. You keep it at your premises and just give us some security deposit because it's a very costly machine. So give us some security deposit for a safety, and this security deposit is refundable. When you stop the dealership, we will refund it and give back the freezer. So up to that, the freezer can be kept in your premises and we will send you the ice cream. You store it there and sell it. Okay. So here the manufacturing company's balance sheet shows 100 freezers distributed to 100 dealers. And assessing officer is saying, where is the freezers? So assessor is saying the freezer is located at the premises of the dealers. So assessing officer is saying, no, you cannot claim depreciation because I have to see the freezer now. Okay, if you want to see the freezer, go to the dealer's premises, you can see there. No, why you are not keeping it here? Mr. Assessing officer, if I am keeping that fridge or freezers here, then what is the use? It is dealership, right? It is the distributorship. That's why it's keeping there. But I am the owner. I paid the money. Okay, I purchased it. So it is built in my name. But physically it is available there because my nature of business is like that. Ice cream has to be sold in those areas. So freezer is required there to store the ice cream. That is why it is keeping it there. They denied and the case went to court. Court clearly says why these type of discussions are coming into the court, right? It's basic common sense, right? Asset must be used in the course of the business. Nowhere Act says that it should be used by you, physically you, right? Every morning MD has to be sitting inside every freezer, right? To use it for our business. It's not like that, right? Vehicle leasing business. You have 100 commercial, the other agents locating in different parts of the country, they have to receive the signal and they have to decode it and give to the customers. So this encoder or decoder device is very costly. So this main company purchasing it, distributed to the dealers, they are using it. No problem. They can claim depreciation on that decoders because these decoders are necessary for their business. That it is not afforded or it is not affordable for the agents to purchase it. So the main principal businessman, they have to buy it and give to the agent to use it there. So no problem, they can claim depreciation. So the word use means used in the course of the business. It doesn't mean physical use by assessee. Moreover, the word used includes past tense. Used in past financial years, not used in the current year, No problem, you can claim it depreciation as far as it is available in your block. If you sell it, then reduce the selling price. You cannot claim depreciation. For those assets which are sold during the year, depreciation not available. If it is available in the block, even though not used in the current year, but last year it is used or prior years it is used, that's enough. In case of new assets purchased during the year, you have to put to use for a single day. If it is not put to use, depreciation not allowed in current year. If it is put to use in next year you can claim it as depreciation. So purchase in current year, use in next year, depreciation next year. But in the current year, the block of asset, you have to make addition. Add actual cost of addition you have to show. But depreciation won't be allowed. Depreciation will be available the next year or the year in which it is actually put to use. So these are the area we have to keep in mind. These are the main points regarding ownership and use. One more thing, earlier I discussed, for a partnership firm, asset is purchased but registered in the name of the partner, but firm purchased the asset, no problem, firm can claim depreciation. Again, that principle, registered ownership is not compulsory, beneficial ownership is enough to claim depreciation. One more thing, depreciation is a fixed allowance. It is a capital allowance. Depreciation is not an expense. Don't say expense. If you say expense, whatever disallowance available to expense will attract to disallowance, this depreciation. But actually it's not like that. Lot of disallowances are not applicable for depreciation because depreciation is a fixed capital allowance. Anyway you can claim it. So expense and allowance both are different. Anyway, depreciation is a deduction. We can claim it as a reduction from profit, but it is not an expense. It is an allowance. That is why section 32 subsection 2 says that unabsorbed depreciation you can carry over infinite period because it's not an expense. If it is an expense, then the unabsorbed portion will be known as loss. If you say loss, 8 years gone. It is not an expense, it is an allowance. Allowance, fixed allowance, capital allowance. Anyway, you will get it. If the asset is basic condition satisfied, you purchased it, put to use, you will get it. And one more thing, under the income tax law, depreciation is a fixed allowance. The other important area is, see, remember, 180 less than 180 days or more than 180 days, right? If the asset is put to use in the year of acquisition, if an asset is put to use for less than 180 days, you will halve the depreciation. If the asset in the year of acquisition, if it is put to use for more than 180 days, full depreciation. That means 1 day used, that is 31st March 2025, 31st March, last day, morning 10:30, asset purchased, afternoon 2:30, put to use, you will get half. If it is put to use in next April, no depreciation at all in the current year because it's not put to use. So 1 day use is equal to 179 days, half. 180 day is equal to 365 days. Either full or half, fixed allowance will be given. There is no day-wise calculation, right? So if it is more than 180 days, full. Less than 180 days, half. This is the rule for new assets acquired during the previous year and put to use in the same financial year. That will come into the calculation side. So major Supreme Court decisions you have to keep in mind. ICDS Limited. Yeah. 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 Yeah, used for company purpose. Absolutely, 100%. Numerous cases. Practically, it is like that. A car cannot be registered in artificial name of a company. That is not possible. Motor vehicle registration requirement. Car is a vehicle. It's used in road, right? When any case arises, how the company can be arrested? Whether the company can be arrested and put into jail. Company is an artificial person, right? So in some laws, it's a very strict law. Natural person, it should be registered. But below that, you can say on behalf of X Private Limited. That is possible. But main registered name, natural person. Yeah, it may be an employee, manager. In some factories, when vehicle lorries is purchased, sometimes it will be registered in the name of purchase manager or store manager, something like that. Not necessarily always the director. Sometimes it may be in the manager, no problem, they can claim depreciation. Even in showrooms, vehicle showrooms, the test drive vehicles will be registered in the name of the manager only. No problem, they can claim it as that test vehicle is actually their asset, that's not stock. So the major Supreme Court cases, ICDS Limited Supreme Court, that is depreciation on leased vehicle cannot be denied to the lessor, stating that it is physically used by lessee. See, as it is leasing business, it is a nature of business, so it should be used by the lessee only. Lessor cannot use it because his business is leasing, not for own purpose. So for business purpose, it should be used. Physical use by assessee is not required. If physical use is required as the nature of the business, then you should use it. Otherwise, depends upon the nature of business, it should be used for your business purpose. That's the only condition. And then for commercial vehicles, there is one more advantage is there. For commercial vehicles used for hiring business, we can claim higher depreciation of 30%. Normally for vehicles, the depreciation rate is 15%. But if it is used for hiring business, we can claim it 30%, double 30%. So that is also possible. ICDS Limited is a vehicle leasing company. Large commercial vehicles, including trucks, they will purchase it and give it to clients for 5 years or 10 years lease. So whenever the lease agreement is executed, in the lease agreement, ICDS will clearly say, these vehicles belongs to ICDS Limited. ICDS Limited is the legal owner. But as per motor vehicle registration requirement, there is one more law. If the vehicle is giving for hiring business or leasing business, then it is a very must condition that vehicle must be registered in the name of the lessee. Because majority of the time these vehicles are used by lessee only. So legal procedure must be taken against lessee. So that is why there is a law, when the vehicle is giving for long period lease, that vehicle must be on the RC book, registration certificate, it should be registered in the name of the lessee. So in this case, what happened? If we see the lease agreement between ICDS Limited and the client, lease agreement says this vehicle belongs to ICDS Limited. If you violate the condition of the lease, immediately the possession will be taken. But if we see the vehicle RC records, it is registered in the name of the lessee. So department contended that ICDS, you cannot claim depreciation because all the vehicles are registered in the name of the lessee and majority of the time the vehicles are used by lessee, so you cannot claim depreciation. And the second contention of the department, the vehicles are not used by ICDS Limited, it is used by lessee only. To claim depreciation, asset must be used by assessee. So these both contention, this ICDS Limited, they have opposite contention. Our nature of business is leasing of vehicle. So leasing of vehicle is our business. As far as these vehicles are leased out, we are using it for our business purpose. Section 32 does not say that it should be physically used by assessee. There is no such condition. It should be used in the course of the business. We are using it in the course of our business. And second contention, the opposite contention by assessee. Regarding ownership, the lease agreement is more important than RC records because the vehicle has been let it out or lease it out to the lessee based on the lease agreement, the terms of the lease, the repossession, ownership, everything clearly mentioned in the lease agreement. So the RC, registration certificate of the vehicle, is not important here. And further, only for the limited purpose of motor vehicle registration requirement law, or as per that law, vehicle should be registered in the name of the lessee. Only to comply with that law, it is registered in the name of the lessee. Otherwise, definitely it would have been registered in ICDS Limited because we spent the money, we bought it, and we are giving it for lease. And in case of any violation of lease agreement, we will put the possession back. So we are the owner. So we are using it for our vehicle leasing business. Give the depreciation. Department denied. Case went to Supreme Court. Supreme Court upheld the both contention of assessee and allowed depreciation. Further, one more thing Supreme Court mentioned, as it is a commercial vehicle used for hiring business, why you are claiming 15? Claim 30. So they can claim 30 also. Right? Department completely failed. See why they are going for these type of silly issues, right? Numerous Supreme Court case already there. Mysore Minerals Limited, very old case. Podar Cement Limited. See, lot of times Supreme Court already reiterated the principle. See, vehicle, beneficial ownership is enough. Registered ownership, see, you see the practical scenario. It cannot be registered in artificial name. And further, use, it doesn't mean physical use by assessee, used in the course of the business. Whether it is used for your business purpose, it's enough. You can claim depreciation. Textile manufacturing company, Tirupur, they have windmill in Damakalmede, producing electricity. Electricity is brought to the factory, using inside the factory to produce the textile. Assessing officer saying, no, you cannot claim depreciation on windmill. Why? Because it is not used in the factory. So is it possible to put the windmill inside the factory? See, there are a lot of very interesting case laws where department is for frivolous reasons, silly reasons they are filing the case. In a lot of cases, sometimes the court will scold the officers, right? Why you are doing these things, right? Basic common sense. Windmill is for generating electricity. It can be installed in a place where wind is there. It cannot be installed in factory. It should be installed in hilly areas where the wind is coming, right? As far as that windmill is used and electricity is generated and that electricity is used inside the factory, no problem. You can depreciation. Even you can claim additional depreciation if you are manufacturing, not opting for BW or BAB or BAC. You can claim additional depreciation also. Right? What an interesting case, right? VTM Limited, Chennai High Court. Okay, so ownership and use, I think you got a clear idea. Registration also you got the idea. And now we can go further. This Yamaha Motor India Limited, current regarding opening block of asset comprising lot of old assets. Current year, some of that old assets is not operating, but earlier it is used, it is still in the block, not scrapped, not sold it out. Still available, no problem, you can claim depreciation because the word used includes past use also. So the use condition you have to put in respect of newly acquired assets during the previous year. First, it should be put to use. Once it is already used, then it is coming under the existing block. Used means past use also. It is enough to claim depreciation. Yamaha Motor India Private Limited, Delhi High Court. Generally, lesser only can claim depreciation. There is an exception prescribed in the law. Building. If you are taking a building under a lease for a long period is not defined in the law, but usually more than 10 years or 20 years, 30 years, we can say it is a long period lease. So if the existing building is taken under a lease and under the lease agreement, lessor permitted lessee to make further construction on that building according to their requirement. It is agreed by the lessor. It's provided in the lease agreement also. And it is a long period lease. Remember, it's a pakka practical requirement. I am not the owner of the building. I took a old building for 50 years lease. I taken that building. I have to incur further construction on that building. Then only it will be suit my purpose. So I incurred some capital expenditure. I constructed some more building on this existing structure. And that building construction cost I can capitalize. I can depreciate under section 32. This is the only place where under lease lessee can claim depreciation. But remember, lessee must incur the expenditure for the new building constructed. Lessee is the owner, but that building is occupied in a already existing leased land or existing leased building. No problem. You can claim depreciation. But lessor should permit such a construction by lessee, and it must be a long period lease. So in case of lease, existing leased building, whatever capital expenditure incurred on that building by way of construction, lessee can claim depreciation, which is clearly mentioned in explanation to section 32. It is usually asking for exam purpose. In the P&L account, they will say during the year assessee incurred 25 lakhs, further construction of the existing leased building debited to P&L. So while doing the problem, just add back and then go to depreciation, claim the depreciation on that building, less depreciation. So add back that capital expenditure, less depreciation on that expenditure. So usually they are asking certain type of adjustments. In all other cases, Only lessor can claim depreciation, lessee cannot claim. This is only case. Next point we already discussed. In case of partnership firm, if the firm purchased an asset which is registered in the name of the partner, not registered in the name of the firm, no problem. Firm can claim depreciation as far as firm incurred the expenditure, firm purchased it and used it for firm's business. Firm can claim depreciation. Again, that same point, registered ownership is not compulsory. And now under the income tax law, plant and machinery meaning you should be very careful. Under the income tax law, plant and machinery means any asset which is not coming under the other classification. Total 4 classification. Number 1, building, furniture and electrical fittings, intangible asset. See, other than these 3, any assets, plant and machinery. So the literary meaning of plant and machinery should not be taken. Plant and machinery is a miscellaneous classification. Any asset not coming under first 3 categories classified into plant and machinery. Now the word plant and machinery never includes live animals, plantations, tea estates, coffee plantations, etc. So live animals, even though it is used as an asset for business or profession, or plantations and estates are the major asset for tea manufacturing company and coffee manufacturing company, but still they cannot claim depreciation. Regarding live animals, no depreciation allowed, but entire cost of that animal can be claimed as one-time deduction when that animal is died or permanently useless. Until then, no deduction. Regarding plantations and estates, as depreciation will be allowed as per section 33AB, up to 40% of profit deduction is allowed. That we have to study, we will study. Yeah. So plant does not include tea bushes, livestock. And plant does not include building and furniture. Why? Because building and furniture is separate classification. That is why. And this point relevant for final. It is not studying in India, but it is relevant for final. Business restructuring. See, this business restructuring, whenever I am using the word business restructuring, in your mind, there should be 5 points. Amalgamation, demerger, conversion, succession. Proprietorship is taken by company, partnership firm taken over by company, private company or unlisted public company converted into limited liability partnership, amalgamation, demerger. This is restructuring. During the previous year, if there is a business restructuring happens, in between, not in 1st April, not in 31st March, during the previous year, say 1st November, amalgamation took place. In that year, who can claim depreciation? Whether it is amalgamating company, holding company, or new company, amalgamated company. If demerger happened, who can claim? Whether demerged company or resulting company. Proprietorship is taken over by a company during the previous year. Whether proprietor can claim or company can claim. Similarly, firm. Similarly, conversion of company to LLP. So, Act says a very clear solution. First, compute the depreciation. Full year depreciation you compute. And then this depreciation should be allocated to the predecessor and successor based on number of days asset used by both of them. If that asset is used by both of them, out of total number of days used by both of them, how many days used by predecessor, how many days used by successor? Based on that number of days ratio, the depreciation must be splitted and both can claim. Predecessor and successor both can claim. So in case of succession, amalgamation, demerger to allocate it. So we have to solve a question on this, we will do that. Okay, this is the theory. Now, classification of depreciable asset. For CA final, business restructuring, they are asking question connecting various provisions. Loss set off and carry forward, capital gain, actual cost, depreciation, MAT credit balance, carry forward. By connecting these 5 items, they will ask restructuring question. After finishing PGBP, capital gain and set off, we will discuss restructuring. Sometimes they may ask a 8-mark question on restructuring. Only restructuring area. What are the various tax planning available to restructuring? So that area we will discuss separately after finishing set off. Because PGBP, capital gain, set off. These 3 will be connected in a restructuring question. That is, the question will be based on amalgamation or demerger or conversion or succession. By seeing the question, we can say it is a question related to various tax planning available in case of restructuring. So if we know all the points, simply we can finish the question. At that time, this will be one of the adjustment. They will give the asset details. Then they will ask what is the depreciation available to predecessor and successor. So we have to compute the depreciation and allocate. We will discuss the classification. We will discuss classification. Then we will go for lunch break. After that, we will do the problems on depreciation. Okay. First classification, building. Rate we have to by heart, because for final they will never give you the rates. We have to, even in there also we have to know the rates. Building used for residential purpose. Don't misunderstand. Residential purpose means workers' quarters, company's guest house, MD's premises, manager's accommodation, workers' dormitory. That is residential purpose. The rate is 5%. Temporary structure or wooden partition. Large building is taken without pillars. In between temporary partition or cabin is created. That is, we can claim depreciation 40%. All other buildings, general rate 10%. So simply they are saying building, you must take this particular rate 10. And special inclusions, well, tube well, even compound wall. Approach road. Approach road means private roads constructed inside the factory to connect the warehouse and the factory, to connect the workers' quarters and factory, administrative block and factory. In between, there will be road will be constructed. So that road is also depreciable. Well, depreciable for water. Well, depreciable. Tube well, depreciable. Compound wall is depreciable. The rate will be depends upon where the well or tube well is used. If the well or tube well is used inside a factory, 10%. If the well or tube well is used in workers' quarters, 5%. Approach road, we will generally take 10%. Compound walls also. If the compound wall belong to workers' quarters, 5. If the compound wall of factory, 10. So these are the 3 rates. So in building, 3 blocks. Building block 1, 5%. Building block 2, 10%. Building block 3, 40%. Land is not a depreciable asset. Only building. Second, furniture and electrical fittings. Electrical fittings, not electronic. Electrical. So lights, we can say fan, switchboard, switches, wiring. That is electrical fittings. Air conditioner, plant and machinery. Sound system, plant and machinery. Tab, plant and machinery. Computer, plant and machinery. Right? Projector, plant and machinery. Right? So plant and machinery, electrical fittings. The confused item is air conditioner. Remember, air conditioner is a plant and machinery. It is not a electrical fittings. Electrical fittings, generally we will take fan, lights, etc. And there are 2 different views. And practically some people for television, TV, some people they are taking 10% depreciation as electrical fittings, and some will take 15%. Actually, it can be taken as 15%. ICI in every problem, AC, even TV, all those are classified under plant and machinery, 15%. So furniture and electrical fittings 10%. So only one block. There is only one block because no rate difference. Only one rate is there. So one block. Whenever rate changes, block varies. So furniture and electrical fittings only one block, 10%. Third, intangible assets. This is important. This is important. Problem they may ask. Intangible assets includes. Okay. So the definition is not final. Definition is not final. Any item similar to these items will be included. So examples they are saying. Trademark, patent, copyright, franchise, license, or similar business or commercial rights. That's the original Bare Act wordings. Similar business or commercial rights. So to carry on liquor business, you need some Abkari license from State Excise Department. So Abkari license is depreciable. You can claim 25% depreciation. To make a stock trading as a stock broker in Bombay Stock Exchange or NSE, you need stock brokership. To obtain stock brokership, you have to pay lakhs of rupees or crores of rupees. So that amount you can depreciate under the income tax law. So stock exchange brokership, intangible asset. Abkari license, intangible asset. To carry on some franchisee, to obtain the franchisee, we will pay an on-time payment. We can depreciate. We can depreciate. If it is not refundable, you can depreciate. If it is refundable, it's not an asset, right? It is not a depreciable asset, right? That money is refundable. But on-time payment you have to pay to obtain a franchisee, that amount will not be refunded. Yeah, that is, you are obtaining a right, business right to carry on business. Intangible asset, you can depreciate. But goodwill, never eligible for depreciation. Earlier it was eligible, but people are misusing. That is why around 3 years back, they amended and blocked the depreciation of goodwill. So goodwill, even though it is an intangible asset, not depreciable. Remember, it is an intangible asset. It is a capital asset. If you transfer to goodwill, there will be capital gain also. But it is not depreciable. Depreciation is not allowed. Even though it is a purchased goodwill, depreciation not allowed. You not self-generated. We purchased it. Not allowed. So intangible asset depreciation rate is 25%. 25%. Only one block is there. So trademark, patent, copyright, franchise, license. The major words you have to keep in mind. But remember, similar business or commercial rights, if they are saying rights, business rights for a long period of time, not in 1 year. 1 year you are getting a right. Revenue expenditure, not capital. Charged to P&L, 37. You are obtaining a right for 10 years. Yeah, asset. Can depreciate if it is not goodwill. Then plant and machinery. Actually, the highest rate is 45, but 45 rate is not that much important because only during the financial year 1920, in a particular date, that is 23rd July 2019 to 31st March 2020, if some vehicles is purchased for hiring business, only in that case 45 is available. In all other cases, the highest rate of depreciation under the tax law is 40. Earlier there was 100% depreciation, now no more. The highest rate is 45 and then 40. So first we study what are the 40% depreciable assets. Computers, computer peripherals, software. Computer peripheral, a lot of high court cases. Conclusion, scanner, printer, UPS. Scanner, printer, UPS, absolutely computer peripheral. Without the help of computers, it's difficult to use these assets. So they must be classified as the rate of computer eligible for 40%. There are two high court decisions. BSES Yamuna Powers Limited, Orient Ceramics and Industries Limited. So BSES Yamuna Powers Limited, High Court, that is inverter that is UPS, should be treated as a computer. Similarly, other case is also there, that is Orient Ceramics and Industries Limited, that is computer printer, scanner. These are eligible for depreciation at the rate of 40% applicable to computer. Okay. Last, anyway, we will discuss the recent case laws which are filtered and given in the study material by ICI, that we will discuss. Okay. But some of the cases in between I will discuss, and then separately also we will make a discussion on the case law. So BSES Yamuna Powers Limited, Orient Ceramics and Industries Limited, scanner, printer, UPS should be treated like a computer peripheral, eligible for 40% depreciation. But remember, EPABX, that is, if there is a lot of telephone interconnections, there will be a device like a router, that is known as EPABX. So EPABX is not a computer, it is eligible for normal plant and machinery general rate 15. It's not a computer. EPABX, Federal Bank Limited, Kerala High Court. EPABX is not a computer. It's not a computer category, computer peripheral. So it is a general plant and machinery, 15% eligible. EPABX, Federal Bank, Kerala High Court. So that's a point you have to do computer. So what about computer software? Usually, if the computer software is purchased as inbuilt to a computer or laptop, we can capitalize and we can claim it as a depreciation to 40%. If you are purchasing a software separately, say for 2 years or 1 year subscription, you are purchasing a software, it is revenue expenditure charged to P&L. For a long period use, huge amount is paid for software, better keep it as computer software and eligible for depreciation 40%. If it is the period of use, we have to see. Generally, office software, local softwares we are purchasing, that we will charge it as a revenue expenditure under section 37, it is allowable. Professional books. Professional books. Chartered accountant, lawyer, doctors, they are purchasing books. There are two types of professional book. We can use it in 1 year and then there will be change in law. Next year we cannot use it. That is known as annual publication. Or some books are there, lifelong publication or lifelong we can use. So that is known as other than annual publication. For example, companies law, commentary, Ramaya, or income tax, the law and practice of income tax, Kanga and Palkiwala, or Sampat Iyengar. So those are big books, that is around 25,000 or 30,000 costing, some 10-15 volumes, like a master guide. So those are lifelong use as far as this law is there. But annual publication, say like Ready Reckoner, we are bought in CA offices, that is annual publication, no problem. Professional book, whether annual or not, 40% we can depreciate. Not periodicals, not journals. Periodicals and journals are not book, charged to P&L if it is related to business. Books in the library, 40% we can depreciate. Life-saving medical equipments used in hospitals, like ventilator, support devices, all those things, that is life-saving medical equipments 40. Aircraft, aeroplane, aero engine 40%. Windmills and renewable energy devices. Please add one more point, renewable energy devices including EV, electric vehicles 40%, electric vehicles, because nowadays a lot of electric vehicles, so 40%. So windmill, remember, if you are following depreciation under WDV method, 40. SLM don't take 40 because SLM rate is different, because windmill is used for generating electricity. So if assessee opted for WDV, the rate of depreciation for windmill is 40. Renewable energy devices, including electric vehicles, renewable energy devices, solar panel, related battery system, all those things related to solar, all those things will be eligible for 40. Air or water pollution control equipments in factories, chimneys are using to emit the polluted air, chimney, you can claim 40. Water treatment plants used inside the factory to treat the wastewater before discharging, we will treat it. So that wastewater treatment, even air pollution control equipments, 40%. Lot of other items are also mentioned, but these, for exam point of view, these we have to keep in mind. And then next 30% rate. Only if they are specifying vehicles used for hiring, leasing, plying business, they must specifically mention vehicles used for hiring, leasing, renting, then 30. Simply saying lorry purchase for transport of raw material, lorry for sending finished goods to dealers, 15. General rate, don't take 30. So vehicle used for hiring business, 30. Motor car acquired in a particular period and put use in that period, 30%. That is 23rd August 2019 to 31st March 2020, the depreciation rate will be 30%. So at that time there was some recession in automobile industry, and all those associations, persons approached Nirmala Sitharaman at that time. She was also the finance minister, asking to boost the sale of vehicles. So that is why they put that period. If the motor car is acquired between and put to use between these date, 23rd August 19 and 31st March 2020, then the depreciation will be 30. Otherwise, it will be 15. So in this period, 30. And in this period, if any vehicle used for hiring business, that is 45. 23rd August 2019 to 31st March 2020, any vehicle used for hiring business, purchased and put to use, 45. Sir, whether this date is relevant now? Yeah, it is little bit relevant, because if there are a lot of assets purchased in this period, motor vehicles or hiring business assets are purchased, and still that block exists, you can claim 45. So as far as that block continues, you can claim 45 or 30. So that is why still that date is relevant. So only if they specifically mention these dates, 1920, these dates, then only you should keep in mind. Otherwise, general rate of vehicles 15, vehicles used for hiring business 30. That's it. 15, 30. Mold used for producing plastic or rubber goods, you can claim 30% rate. So 45, commercial vehicles used for hiring business acquired and put use between these dates, 45. But motor car purchased for normal business between this date, 30. But motor car, including motor car, any vehicle used for hiring business acquired in this date, 45. 45. Now, ship, boat, speed boat has a very good life. So that is why 20%, 20% depreciation. For all other plant and machinery, the general rate will be 15%. So based on rate, they will confuse. Sometimes they will charge depreciation to the P&L wrongly, at wrong rate. So in those problems, you have to correct that. So excess depreciation we have to add back. If the depreciation they claimed is not enough, we have to claim that adequate depreciation we have to again further reduce. Otherwise, we have to add back. So those type of adjustment they are asking. So the rate is very important. We have to by heart these rates. These basic rates we have to by heart. So plant and machinery is the last classification. Remember, the word plant and machinery does not include live animals, not eligible for depreciation. Similarly, plantations and estates, not eligible for depreciation. Oil well is eligible for depreciation. Oil well is a plant and machinery. General rate is 15%. Oil well. Okay. Now after the lunch break, we will resume. Okay. Then we will start the problems of depreciation calculation. So we are continuing. So depreciation rates and the classification over. So now the computation format. In between there are some case laws that we already discussed. That is EPA BX should not be treated as a computer, and hence EPA BX is not eligible for 40, but you can claim 15% normal plant and machinery depreciation. And similarly, computer accessories and peripherals like a printers and scanner and server, etc. Equal to computer, eligible for 40. BSCS Seminar Powers Limited, 2013 Delhi High Court, and UPS is also eligible for 40% depreciation. That is Orient Ceramics and Industries Limited. Now, computation format. So opening, if it is an existing assessee, opening value of the block as on 1/4/2024, opening WDV, add actual cost of additions during the previous year. The word actual cost is defined under 43, general meaning, and there is certain special cases also. At the final level, we have to study that special case also that we will discuss. So generally, actual cost means the cost incurred to purchase an asset, brought it into our site and make it ready to use. Whatever expenditure incurred up to the date of first put to use of that asset must be capitalized. Cost incurred to purchase an asset, cost of transportation, loading and unloading, installation expenditure, trial run related expenditure, trial run production related expenditure, even commission or brokerage paid for purchase of asset. So all these expenses must be added to the cost of the asset. And whenever you are purchasing an asset, if the payment for purchase of an asset in a single day to a single person exceeds rupees 10,000, it should be paid only by way of account pay check or account pay draft or other prescribed electronic mode. Other prescribed electronic mode so far notified is debit card payment or credit card payment, National Electronic Fund Transfer or NEFT, NEFT, or RTGS or IMPS or Aadhaar payment or UPI payment or BEAM app payment, Bharat Interface for Money payment. So these are the prescribed electronic mode, or account pay check or account pay draft. In a single day, for purchase of an asset, if the payment exceeds 10,000 and you are made in any other model, not in account pay check or account pay draft or other prescribed electronic mode, that is to say crossed check or bearer check or cash, then such actual cost is not allowed. Not allowed means you cannot consider that actual cost into the block. That means no benefit for that asset under the tax law. You won't get, see, no depreciation means no other deduction. So anywhere else we cannot claim, right? It's gone. For example, 1 lakh rupees is the purchase cost. 75,000 rupees we paid by account pay check. 25,000 rupees we paid by normal check or cash, but single asset. So 75,000 we can claim, no problem. That 25,000 only won't be allowed. So whatever payment is made exceeding 10,000, that much amount is not allowed. Remaining payment made in prescribed modes we can claim. So that is add actual cost of addition. Actual cost of addition means asset purchased during the year, whether it is put to use or not, you have to add. If it is put to use in next year, depreciation you will claim in next year, but in the current year block of asset you have to make it as addition. Then plus during the previous year, out of this block any asset is sold, then reduce selling price, discarded or scrapped, reduce scrap value, destroyed, you got insurance compensation, reduce insurance compensation. Always keep in mind, whenever an asset is going out, either sale or scrap or destruction, don't reduce the cost of that asset, reduce the money received or receivable for that asset. So whatever money you received or receivable, so that is why if it is sold, selling price, it's not similar to books of accounts. In books of accounts or in accounting, what we are doing is the WDV of that asset will be reduced and compared with the selling price. So that is a treatment. But in tax law, it's not like that. In a block, whatever amount is received for the sold asset, only that selling price should be reduced. You should not reduce the WDV or cost of that asset or market value of that asset, that you cannot reduce, only the selling price. So even though it is 1 rupee, that 1 rupee you need to reduce. Maybe the value of that asset at present may be 5 lakhs. You receive only 10,000 rupees. You have to reduce not 5 lakh, 10,000 rupees. So money received or receivable in respect of assets sold, discarded, destroyed during the previous year. If it is sold, selling price. If it is scrapped, scrap value. If it is destroyed and you have insurance, insurance compensation received, reduce it. So difference amount should be positive. That means opening and addition should be more, sale value should be less. Then only there will be positive value. If there is a positive value, that is known as value of the block, or we can say WDV before depreciation. On this block value, apply the depreciation rate. While applying the depreciation rate, whether we need to take half the rate depends upon the next condition. In the year of acquisition, that means current year there is an addition. That asset is put to use for less than 180 days. So you should be very careful. If the asset is acquired in last year, put to use in current year, this rule is not applicable. Acquired in current year, put to use in the same year, and it is less than 180 days, half. Asset acquired in 2024-25 financial year, put to use in 25-26, less than 180 days. You can claim full depreciation. Because it's very clear, both acquisition and put to use, both falls in the same financial year, then only less than 180 days rule is applicable. So practically, to memorize easily, remember that date, October 4th. If an asset is put to use on October 4th or thereafter, it will be less than 180 days. So in the year of acquisition, if the asset is put to use for less than 180 days, half of the normal rate only should be applied. So out of the block value, we should identify whether there is any addition during the year and in the same year put to use for less than 180 days. Maybe acquisition in June 24, put to use in December 25, less than 180 days. Acquisition and put to use in September, more than 180 days. So we need to find out only the less than 180 days cases. That is also, remember, the acquisition and put to use both must be in the same financial year. Acquired during the year and put to use in the same year for less than 180 days, half. For the remaining block value, full. Out of the block, allocate less than 180 days, half. Remaining block value, full depreciation. So always first we need to allocate towards less than 180. Only if there is a remaining value for the block, then only there will be more than 180. So in some questions, block value 5 lakhs, less than 180 days addition asset 6 lakhs. So block is only 5, but addition less than 180 is 6. Out of 5, we cannot allocate 6. So this entire 5 lakhs represents less than 180. So 5 lakhs into half. There is no more than 180, so no full depreciation, only half. If half and full both are covered, then okay, first half should be provided. For the remaining block, we can provide full. So after reducing the depreciation, we will get the closing return on value that will act as the opening WDV for the next year. So now the issue, the block should be always positive. If the block is negative, there is no question of depreciation. Physically, you may have assets, but the block becomes negative. Why? Opening 10 lakh, addition 5 lakh, 10 plus 5, 15 lakhs, sale value 20 lakhs. So 15 minus 20, negative 5. Block becomes negative. No depreciation. There will be capital gain that we will discuss separately. Capital gain and capital loss of block we will discuss separately. So this is normal case. Block should have positive value. That means addition and opening WDV should be more. That two figures together should be more. Sale value should be less than that. Then only there will be positive value for the block. Once we got the positive value for the block, remember addition and put to use in the same year, less than 180. Allocate half, remaining full. So this is normal depreciation. For CA final, if they are asking depreciation, usually they won't ask depreciation problem. If they are asking a problem, definitely it will be based on comprehensive question as an adjustment. So there will be additional depreciation also. So we are going to discuss the next incentive. It is an incentive, additional depreciation. Then we will go to problem. Section 32 has a structure. Section 32 subsection 1 subclause 1, that is SLF. That is SLF. What we are studying is WDV method. Remember 32 subsection 1 subclause 1 SLM. 32 subsection 1 subclause 2 WDV. 32 subsection 1 subclause 2A additional depreciation. So additional depreciation available only for assessee who is following WDV. So for straight line method persons, no additional depreciation. That is power generating assessee. If they opted for SLM, no additional depreciation. So only for an assessee who is following depreciation under WDV method, they can claim additional depreciation. Remember, it is an incentive. As it is an incentive or tax planning, it is not available for assessee following 115 BAC. Not available for assessee following 115 BAA. Not available for assessee following 115 BAB. So for corporates, if the company opted for concessional rate of taxation under section 115 BAA or BAB, they cannot claim additional depreciation, but they can claim normal depreciation. They can claim additional not available. If it is an individual HUF, AOP, BOE and they opted for BAC, additional depreciation not available. So additional depreciation, as it is an incentive, it is not available for assessee opting for concessional rate of taxation scheme or default tax regime in case of individual HUF, not available. Similarly for corporates, BAA or BAB. For CA final, we should keep more importance for the company. So if a company opted for BAA or BAB, they cannot claim additional depreciation, but they can claim normal. So now we are going to discuss the additional depreciation provision for those assessee who are not opting for BAA or BAB. Additional depreciation, there are other two names also, accelerated depreciation or enhanced depreciation. These three are same. Additional or accelerated or enhanced depreciation is same. This depreciation is available in addition to the normal depreciation. But it is not over and above original cost. Anyway, it is up to the original cost or up to the block value. It is not extra. But the only thing is, in a particular year, you will get more depreciation. So that is additional. So what is the eligibility criteria? Assessee must be engaged in production or manufacture of any article or thing. Any moving article or moving thing should be produced, manufactured. So construction assessee cannot claim. Hotel industry cannot claim. Service industry cannot claim. Hatching of egg, not eligible. That is not manufacturing. Cooking food in a hotel, not manufacturing. Construction of dam, bridge, not manufacturing. Production or manufacture of any article or thing. Any distinct item should be produced or manufactured. So what about electricity? Electricity is movable, electricity is marketable, electricity is goods. So electricity producing company, if they are opted for WDV, they are eligible. Because electricity is goods, article. It's movable, marketable. So assessee must be engaged in the production or manufacture of any article or thing or generation of electricity. But regarding electricity, they should be opted for WDV. Because SLM people, they cannot claim additional depreciation. It's a primary condition. And second, so while you are trying a particular question, especially company assessment or firm assessment or LLP assessment, if the question starting manufacturing, at present under the PGBP, this is the only provision you have to keep in mind. If it is additional, if it is manufacturing assessee, they can claim additional depreciation. And if it is a new manufacturing company started recently, 115 BAB, that is also another possibility. Then we will discuss later. In assessment of company, we will study that. But in PGBP, the main impact, if the question says it is manufacturing, you should think about additional depreciation adjustment. So in the previous year, eligible plant and machinery put to use. Eligible plant and machinery put to use. So what is eligible plant and machinery? Act is not defining eligible plant and machinery, but Act is saying what are the machines which are not eligible. That is mentioned in that law. But they are not saying what is eligible, but they are saying what is ineligible. Negative list they are mentioning. And how the additional depreciation is calculated. Additional depreciation is available at the rate of 20% on actual cost of eligible plant and machinery. So additional depreciation is calculated on actual cost of eligible plant and machinery. So out of the block value, what is the actual cost of the eligible plant and machinery? Find out that. So on that actual cost, apply 20%. But if the eligible plant and machinery is put to use for less than 180 days, in the same year in which it is acquired, it is put to use for less than 180 days, then additional depreciation also half. Half means 10% of actual cost. There is another issue. Additional depreciation available for a plant and machinery only once. For one plant and machinery, additional depreciation available only once. Next year, if you want additional depreciation, again purchase new plant and machinery, you will get again 20%. So for one machinery, one die. But if that eligible plant and machinery put to use for less than 180 days, we are getting only 10%, half of the 20, that is 10%. In that case, balance 10% additional depreciation can be claimed in the immediate next year. The immediate next year. So this is the only possibility where additional depreciation available in 2 years for a single asset. For an eligible single machinery, 2 years additional depreciation available only if in the first year acquisition and put to use for less than 180, 10% only will be allowed. So balance 10% can be taken in the second year. If in the year of acquisition put to use for more than 180 days, 20% over. The next year, if you need additional depreciation, again buy another eligible plant and machinery, then you will get it. So additional depreciation available only once for a plant and machinery, eligible plant and machinery at the rate of 20% on actual cost. If the eligible plant and machinery put to use for less than 180 days, then additional depreciation available only 10% of the actual cost. In that situation, balance 10% will be available in the immediate next assessment year. Immediate next year. And additional depreciation not available for ineligible plant and machinery. So what are the plant and machinery which are ineligible? So ineligible plant and machinery, they are saying number 1, ship, aircraft, road transport vehicles not eligible. Ship, aircraft, road transport vehicles not eligible. The last part you have to keep in mind, RTV, road transport vehicles. So there are a lot of vehicles which are used inside the factory for special purpose, like for moving raw material, trailer, semi-trailer. For after a particular production schedule, the plant and machinery should be moved to another location. For that purpose, they will use forklift truck, FLT, forklift truck. Actually, it has engine, tire. It can be transported through road, but it is not a road transport vehicle. It is a heavy lift or weight lift machine. That is forklift truck. It is not a road transport vehicle, so it is eligible. Tank, protected vehicles, special vehicles used inside some factory or inside mine. So all those items are special purpose vehicle. They are not road transport vehicle. Eligible. So that word is very important. Road transport vehicle. Lorry, truck, lorry, bike, car. Okay, all these not eligible. But special purpose vehicle like a trailer, semi-trailer, for protected vehicles used inside the factory, no license to operate in the roads. So those vehicles, even though it is vehicle, as it is not a road transport vehicle, we can claim additional depreciation. And second, any plant and machinery used by any other person prior to assessee, either within India or outside India, not eligible. So in simple words, second-hand plant and machinery not eligible. But if you are studying like that, then remember, domestic as well as imported second-hand plant and machinery not eligible. Otherwise, you should study the original Barak language. Any plant and machinery used by any other person prior to assessee, either within India or outside India, not eligible. So that is a correct, because there will be no confusion. Even though it is imported, but some other person used outside India, we are the first user in India, still it is second-hand, not eligible. Connected to this point, under section 35 AD and section 10 AA, imported second-hand plant and machinery will be treated as new. Under section 35 AD and 10 AA special economic zone, there is a condition. Out of the total plant and machinery requirement, 80% plant and machinery must be new. In those two sections, there is a relaxation. Imported second-hand plant and machinery will be treated like new. But under section 32, additional depreciation, imported second-hand plant and machinery is not eligible. Now, any plant and machinery installed in office premises, residential accommodation, guest house, not eligible. Any plant and machinery installed in office premises, residential accommodation, guest house, not eligible. Air conditioner installed in factory, eligible. Air conditioner installed in warehouse, eligible. Air conditioner installed in storeroom, eligible. Air conditioner installed in office, not eligible. Fridge or freezer purchased to store the raw material, eligible. Freezer purchased to store the food items in workers' quarters, ineligible. Computers installed in factory, eligible. Computers installed in office, not eligible. So any plant and machinery installed in office premises, residential accommodation, guest house, not eligible. Next they are saying office appliances, not eligible. Office appliances. Scanner is an office appliance. Printer is an office appliance. Projector is an office appliance. So office appliances not eligible. Next point is nowadays not relevant. Any plant and machinery for which 100% depreciation allowed in 1 year. At present, the highest depreciation rate is 45 or 40. There is no 100%. So that point is irrelevant. Earlier it was relevant because prior to 3-4 years, there was 100% depreciation for a lot of assets. But now there is no more 100%. So this point is not relevant. So first 4 points are relevant. So any ship, aircraft, road transport vehicles not eligible. Any office appliances not eligible. Any plant and machinery installed in office premises, residential accommodation, guest house not eligible. Second hand plant and machinery not eligible, whether domestic or imported not eligible. Okay. So this is ineligible. For the eligible plant and machinery, first we must compute the normal depreciation. Immediately after that, put the additional depreciation. So normal depreciation first we have to compute, then we have to compute the additional depreciation. All this depreciation to be reduced from the block to arrive at the closing written down value. So this is the way additional depreciation we are calculating. Just I will show you an illustration and straight away we will go to the question. So X Limited, a manufacturing company not opted for section 115 BAA or BAB. Okay. Opening WDV of plant and machinery, say it is 15% block. Opening WDV 12 lakhs. 12 lakhs. Addition. AC acquired and put to use on 1st September 24. Say AC rupees 3 lakhs. This is installed in office. Again, they purchased a car on 1st November 24, rupees 5 lakhs. And again, they purchased a machinery on 1st Jan 25, rupees 3 lakhs. And then they purchased the AC on and put to use on 1st May 2024, which is rupees 2 lakhs, which is installed in factory. So these are the additions. So 12 plus 3, 15, 15 plus 5, 20, 25 plus 2, 20, 25, right? This is 12, 12 plus 3, 15, okay? 15 plus 5, 20, 23 plus 25, less. Sold old asset. It's correct, right? 25 correct, right? Less sold old, one of the old asset out of the opening WDV has been sold for 8 lakhs. 8 lakhs. So this is the block value, that is rupees 17 lakhs. Block value. So as there is no space, I'm going to the that side. Okay. Block value 17 lakhs. So first I am claiming normal depreciation. So always write like this, less normal depreciation underline. Then put to use for less than 190. Then use for more than 2 figures. Normal depreciation 2 figures. Then put the side heading additional depreciation. Then eligible plant and machinery less than 190. Then eligible plant and machinery more than. This is the easiest way to compute, so that there will be 4 answers. Normal depreciation less than 180, more than 180, additional depreciation less than 180, more than 180, total depreciation, closing WDV. Easy way. So out of this 17 lakhs, which are the asset put to use for less than 190 days. Here car less than 190 days because 1st November 24. Assume acquisition and put to use same date. Same year acquired and put to use on the same date. 1st November. See, after on or after 4th October, it will be less than 190 days. So for 1st November, less than 190. This machinery, 180 May 24. So 5 plus 3, 8 lakhs. So out of this 17 lakhs, 8 lakhs into 7.5% depreciation. 17 minus 8, balance will be 9 lakhs, right? Into 15%. Balance is more than 180. So don't go for reconcile less than more than. First allocate less than. Remaining, if there is any balance value in the block, that will be more than 180 days. So don't go for reconcile. Less than, more than. Over. Now additional depreciation. Find out eligible plant and machinery. So AC installed in office, not eligible. Car, road transport vehicle, not eligible. Machinery, eligible. Eligible. AC installed in factory, eligible. Okay, there are two assets which are eligible, machinery and AC. So which is less than 180? Machinery less than 180, 1st January 25. So 3 lakhs into 10%. So simply take the original cost of that asset, apply less than 180, so 10%. And AC is more than 180. So we can claim 2 lakhs into 20%. Over. Balance is the closing WDV. And we have to put one more note regarding this eligible plant and machinery, 3 lakhs, balance 10% additional depreciation available in assessment year 26-27. Next year it will be available. So this is the way depreciation is computing, normal and additional. This is only one block. If there is 40% block, we have to give separate column, separate column. Okay. So while computing depreciation up to block value, there should not be any confusion. Simply take the opening WDV, add actual cost of additions in that block, less sale value, balance block value. Once you got block value, remember the first step, less normal depreciation. In between, less than 180, more than 180. Normal depreciation for asset, put to use for less than 180, more than 180. And then additional depreciation. Eligible plant and machinery less than 180, eligible plant and machinery more than 180. So there will be 4 figures. So this will be easy for the valuer also. Normal depreciation less than, more than, additional depreciation less than, more than. So all these together will represent the total depreciation which can be claimed under section 32. Balance is the closing WDV. This is the normal way of computing normal depreciation and additional depreciation. Yeah. 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 BAA, BAB, and as it is a company, right? For company, the concessional rate of taxation is BAA and BAB. If it is not a company, individual, HUF, AOP, BOI, the concessional rate of taxation is 115 BAC. As it is a company, yeah, for company, BAC is not applicable, right? For company, the concessional rate is either BAA or BAB. If they are not opting for these two sections, any one of these two sections, okay, BAB is for new manufacturing companies and BAA for existing companies, concessional rate. They should not claim a lot of incentives. That will study in depth in company assessment, okay. Otherwise means normal provision. Normal provision, they can claim all incentive, everything. At that time, they can claim additional depreciation. Yeah, they are not claiming concessional rate. They are coming under normal provision, this company. So they can claim additional. You got it? This September 25 attempt, they asked the question of company assessment, normal. They are not opting for BAA or BAB. That means for January attempt, there is a possibility that they may ask for BAA or BAB. Okay, you can start problem, take the workbook. So take PGBP. So we will do only 2 questions. That's enough. 2 questions. Then we will move further. Okay. First, you have to do question number 3. Third question. Page number, workbook page number 149. So workbook page number 149, question number 3. Question number 3. In that question, there is no single block. There are two blocks, 15% block and 40% block. So you have to put two columns, 15% block and 40% block, because air pollution control equipment, 40% block. is a block value of 15% block? 18 lakhs, 93. So additional depreciation not available for second hand plant and machinery, not available for AC installed in office. Other two items are eligible. If that is complete, just one more question to clear the concept of computation of depreciation. That is question number 21. Question number 21, page number 157. Sorry. Yeah, here it is not 15. Sorry, it is 40. Correct. 40. Yeah. Can you tell me the final figure? 5,25,000 to 7.5%. How much? 5,25,000 into 7.5. 39,375. 1368 into 15%. 2,05,200. So here it is 325 into 10%, 32,500, right? 8 lakh in 20%, 1,60,000. And here 2,50,000 to 40%, how much? 1 lakh, right? And here it is 50,000. So total depreciation for both block together, that is a final answer because they are asking for total depreciation. So all these together, that is the final total depreciation available for assessee under section 32. So now go to that question. Question number 21, page number 157, PGBP question number 21. There are also two block, right? Two block, right? Because computer 40 and all others are, and windmill also 40. Windmill 40, computer 40, all others 50. So two blocks, 15 and 40%. Windmill is also plant and machinery, computer is also plant and machinery, both are same rate, put it into one block. Regarding that new imported machinery which have not been put use in the current year, put use in next year, but keep in mind while you are taking block, it must shown as addition because it is current year's addition. We have to put as add actual cost of addition, that imported machinery 12 crore you must add, But while calculating depreciation purposefully, we should avoid that. So out of the block, reduce 12 crore, remaining claim depreciation, because this 12 crore you will get depreciation only the next year. That means this 12 crore should be completely available in your closing WDV. So we should make it as addition, but don't claim depreciation on that asset, because put use in next year, 3rd April 25. So for that new imported machinery 12 crore, they will get normal depreciation as well as additional depreciation next year. If the company next year also not opting for BW or BAB, then next year they can claim both the normal depreciation as well as additional. To get additional depreciation, assessee should be engaged in manufacturing. Eligible plant and machinery should be installed or put to use. That's the only condition. There should not be any operational connectivity between manufacturing activity and eligible plant and machinery. There is no such requirement under the law. There is an interesting case that is also again happened in Tamil Nadu. Windmill issue. So windmill is installed and electricity is generated, and that electricity is used in manufacturing textile, and some electricity they are selling outside. Now officers say that no, you cannot claim additional depreciation on windmill because your activity is generating, not the generating electricity. Your main activity is manufacturing textile. Okay. So the plant and machinery should be directly related to your manufacturing activity, then only it will be eligible. Such a type of condition they are saying. So the case went to Chennai High Court. So High Court clearly mentioned, no, there is no such condition. Once you are manufacturing, all eligible plant and machineries are eligible for additional depreciation. There is no operational connectivity is required. So even though a computer is purchased and put to use in storeroom to account the stock of that goods, it's eligible for additional depreciation. Air conditioner installed in raw material store or warehouse or depot where finished goods is storing, there we installed a air conditioner, no problem, we can claim. There is no need for any operational connectivity between manufacturing activity and the eligible plant and machinery. That's not required. If you satisfy the basic condition, you are engaged in manufacturing, eligible plant and machinery put to use, and you are not opting for concessional rate of taxation provisions, then you are eligible for additional depreciation. That's it. Now the depreciation, we are continuing. Meaning of actual cost. Actual cost, general meaning we discussed. The cost incurred to purchase an asset, brought it into site and make it ready to use. Whatever expenditure incurred up to that moment, we can add it to the cost of the asset, and that is known as actual cost. And second thing, in a single day, the purchase of an asset, if you are making payment exceeding 10,000 to a single day, to a single person, either single payment or aggregate payment in that day, morning 5,000, afternoon 6,000, both payment made in same day, both payments made to a single person, take the aggregate, so 6 plus 5, 11. So either single payment or aggregate payments made in a day to a single payee exceeds 10,000 for payment for purchase of asset, then it should be made only by way of account pay check or account pay draft or other prescribed electronic mode. Account pay check, account pay draft, other prescribed electronic mode, you will be required in a lot of places. One is section 43 for depreciation purpose, another one is section 35 AD, specified business deduction, and then section 40 capital letter A subsection 3, and then presumptive 44 AD, and then tax audit 44 AB, and then 80 JJAA. Numerous places. This word is used: account pay check, account pay draft, other prescribed electronic mode. Once we finish all these sections, we will make a small note on that. Wherever they are using these words: account pay check, account pay draft, other prescribed electronic mode. So in all those places, the meaning is same. Now, if the payment is made exceeding 10,000 other than these three prescribed modes, then nothing will be allowed. Even a single rupee you cannot claim it as actual cost. So that payment is gone. But in a single asset, part payment is made in account pay check and remaining part payment exceeding 10,000 made in cash, then that payment made in cash only we have to eliminate. Whatever payment, even though it's a single asset, part of payment made in account pay check, eligible. special cases of actual cost. Special cases of actual cost. One more thing I need to clarify. As per section 40, capital letter A, subsection 3, 40A3, in case of any business expenditure, 30 to 37, any business expenditure, if the payment exceeds 10,000, if it is not paid in account by check or account by draft or OPM, other prescribed electronic mode, then that expenditure will be disallowed. That is 40 capital letter A, subsection 3. Listen carefully. 40A3 speaks about revenue expenditure we are claiming as a deduction under PGBP. Under section 40A3, there is a special limit of 35,000 if the payment is made to transport operator, goods transport agency, lorry freight, truck freight, lorry freight, carriage inwards, carriage outwards, lorry freight. You can make payment up to 35,000 in a single day. If it exceeds 35,000, account by check, account by draft, OPM. Otherwise, that freight expense will be disallowed. So instead of 10, the limit is 35, which is prescribed in 40 capital letter A, subsection 3. This is 43. 43 speaks about asset purchase. So for purchasing an asset, you arrange the transportation. So lorry freight is paid for transportation of machine to our factory. So that lorry freight, they are not mentioning 35. The limit will be 10. So if it exceeding 10,000, the lorry freight for purchase of asset is made. That freight expense cannot capitalize, will not be added to actual cost. You cannot claim. So remember the difference. 40 capital letter A, subsection 3 speaks about revenue expenditure claimed from 30 to 37. Section 43 speaks about asset purchase, capital expenditure. So when freight is incurred to transport a asset to our site, the transportation charge need to be capitalized, because whatever expenditure incurred for purchase of an asset up to the date of put use or up to the point of put use installed or first trial run production, up to that point, whatever expense incurred must be added to the cost of the asset. So here it is, asset purchase transportation freight. There is no separate 35,000 limit under section 43. 43 says 10,000. There is no 35. 35 limit for transport operator available under section 40 capital letter A, subsection 3, which speaks about revenue expense claiming through P&L. Should be clear. Now, special cases of actual cost. An asset originally purchased for scientific research. You claim the deduction under section 35. And then subsequently, instead of selling directly, why? Because if you are selling directly a 35 scientific research asset, there will be a deemed profit. Original cost of the asset or sale proceeds, whichever is lower, taxable as deemed profit under section 41. To avoid that, sometimes people will do like that. That research, once the research purpose is over, that asset will be nicely transferred to factory or office purpose. And they will say it is used as a depreciable asset. So if scientific research asset subsequently brought it into block of asset, actual cost must be taken as nil, 0. But anyway, we have to show as add actual cost of addition. Even the amount is nil, you must add actual cost, but the amount is nil. Why? Because once it is brought into the block, it is part of the block of asset. And then subsequently, if you sell it, there will be not deemed profit. It will be simply reduced from the sale price, will be simply reduced from the block of asset. Only block value will be reducing. There will be no direct impact of section 41. So, research asset subsequently brought it into block of asset, actual cost is 0. Then I got a depreciable asset as a gift, and immediately upon the receipt, I am put it into business. So depreciable asset received as a gift. So the rule they are saying original cost of the donor minus notional depreciation, remaining is the actual cost, add to the block of asset. So original cost of the donor, if the donor purchased that asset 2 years back, reduce depreciation for 2 years, find out the opening WDV as on 1/4/2024. If it is our previous year 24-25, gift is received. Find out WDV as on 1/4/2024. Remaining under income tax law, in between depreciation calculation is not there, only at the year end. So if you received a gift of depreciable asset on 1st July 24, we cannot claim depreciation up to 30th June. Provide depreciation up to 31st March 2024. You will get the opening WDV as on 1/4/2024. Take it as actual cost and add. Then claim depreciation for 24-25. So gift of a depreciable asset, original cost of the donor minus notional depreciation for the period used by the donor. This is a fraudulent intention, used asset, second hand asset, acquired at a higher price. Intention to show more actual cost, thereby claim more depreciation. That won't be permitted. If second hand asset is acquired at a higher price with a view to claim more depreciation, then the actual cost shown by the assessee will be rejected and actual cost will be found out by the assessing officer. With the prior approval of joint commissioner, assessing officer will find out the actual cost. What will be the actual cost determined by AO? Usually, what is the fair market value of that second hand asset at that time in the market? What is its fair market value? That only will be allowed as actual cost. If any amount showing extra, that will be rejected, that won't be allowed. So second hand asset acquired at a higher price with an intention to claim more depreciation, then actual cost will be determined by assessing officer. But remember, practically assessing officer will find out the market value. Act is not saying that, but practically that is the implication. Fair market value of that asset at that time, at the time of purchase, what is the real price? So that will be taken as the actual cost, and our actual cost will be rejected. Next one is also important. That is also some sort of a fraudulent transaction, chain of transaction. We are selling a depreciable asset. Actually, we are depreciating it, and that same depreciable asset we are selling, and then it is repurchased subsequently from the very same person. That same depreciable asset we are buying back. So sale and repurchase same depreciable asset. At the time of repurchase, what is the actual cost? So very interesting provision. They are saying what is the WDV of that asset at the time of original sale. When this depreciable asset you sold, what was the WDV as per income tax law for that asset? Find out that. Now compare repurchase cost. Whichever is lower only will be permitted as actual cost. So sale and repurchase same depreciable asset by assessee. The actual cost at the time of repurchase shall be. Actual cost at the time of repurchase shall be WDV at the time of sale. The same asset earlier you sold. At that time, what was the WDV as per income tax, not as per books. As per WDV, what was the WDV of that asset at the time of sale? And now what is the repurchase cost? Compare, take the lower. That lower figure is the actual cost which will be permitted. So sometimes repurchase price will be lower, WDV will be more, then repurchase price can be claimed as actual cost. Sometimes repurchase price will be more, WDV at the time of sale will be less, then WDV at the time of sale must be taken. You may be sold 1 year back or 2 year back or 3 year back, but still we have to take the WDV at the time of sale. Even though it is 5 year back, WDV at the time of sale. Or now the repurchase price, whichever is lower only will be allowed. Practical issue arises. 5 machines in a block. Only 1 machine sold. After 2 years, that same machine repurchased. Repurchase cost given in the question. We know the repurchase price. How we will find out the WDV at the time of sale? Because this asset was part of a block. We know only the WDV at the time of sale of this entire block. We don't know this individual assets WDV. Because under the income tax law, there is no individuality. Only block is there. So out of this block, only 1 asset is sold. And that same asset is repurchased. We have to compare not the entire block value. We have to compare the WDV of that particular asset at the time of sale. And then repurchase price whichever is lower. So in that situation, out of this 5 asset block, which asset you sold, find out the original cost of that asset, find out the original date of acquisition. From that date till the date of sale, provide depreciation under section 32 notionally, you will arrive the WDV. So that WDV should be compared with the repurchase price, whichever is lower should be taken. Got it? Because under income tax law, depreciation is claiming not on individual asset, on block. Now, the next one, asset sold, lease back. The fourth one is asset sold and repurchase. But here it is not like that. Asset sold and lease back. Earlier, we was the owner, but now we are the lessee. So, who is claiming depreciation? Lessor. The person who is buying that asset from us, he is claiming depreciation. So, what is the actual cost of the lessor? That they are discussing under section 43. So remember a situation Mr. A is selling an asset to Mr. B, and then the same asset is taken under lease. So sold and lease back. So now B is the lessor, or we can say owner. So what is the actual cost of B? A sold this asset for rupees 8 lakhs. At the time of sale, WDV at the time of sale is rupees 6 lakhs only, but sold it for 8 lakhs and then lease it back. So in this situation, actual cost of lessor shall be WDV at the time of sale. This should be taken as the actual cost of lessor. So WDV of the seller at the time of sale of that asset as per income tax law should be actual cost of the lessor. Here also that same issue arises. 5 assets in a single block. Only one asset is sold and lease it back. Out of this 5 entire block of asset, this particular assets WDV should be arrived. Take the original cost of that asset, reduce notional depreciation for those period, you will get the WDV. That should be taken as the actual cost. So here there is no other comparison. Just the WDV at the time of sale of the seller shall be actual cost of the lessor. To attract this condition, seller must take the same asset as lease back. If B is selling that asset to somebody else and then take it under lease, it is difficult to apply this provision. Sale and lease back, same asset from the same person. Now, building used for personal purpose, subsequently brought it into business. Simple rule: take the original cost of that building, reduce notional depreciation under section 32 for those period asset used for personal purpose, so that you will get a WDV now. That should be taken as the actual cost. So 5 years back, purchased a building for personal residence. 6th year, converted into office for the past 5 years. Reduce depreciation at the rate of 10% under section 32. WDV method, reduce. You will get opening WDV as on 1/4/2024. That should be taken as actual cost for 24/25. And then claim continue depreciation. But this rule is applicable only for building used for personal purpose and subsequently brought it into business. That means any other personal asset like a vehicle, computer, or any other asset subsequently brought it into business, this rule is not applicable. Then what we will do? Simply take the original cost as the actual cost. No need to reduce notional depreciation. So there is a loophole. This provision says only building used for personal purpose subsequently brought it into business. That means any other personal asset other than building subsequently brought it into business, no need to reduce notional depreciation. You can straight away take the original cost, that past period original cost you can take now as actual cost and claim depreciation. So this rule not applicable for any other personal asset. Now the next case is Pakka restructuring, amalgamation, demerger, transfer of asset between holding company and subsidiary company. Amalgamation, amalgamating company transferred all the depreciable assets to amalgamated company. So after amalgamation, amalgamating company is no more. Now amalgamated company is there. So what is the actual cost of these assets in the hands of the amalgamated company? Because usually there will be some revaluation, some fair value concept. Asset will be revalued, but all those revalued figures or intrinsic value has no relevance. WDV of the predecessor as per income tax, actual cost of the successor. That means no change. Previous owner's WDV will continue in the hands of the new owner. So amalgamation, demerger, WDV of demerged company, actual cost of resulting company. WDV of amalgamating company, actual cost of amalgamated company. Holding subsidiary. Some 2-3 places we will study the concept of holding subsidiary under the tax law. Always keep in mind, to set to be a holding subsidiary under the income tax law, it should be 100% holding subsidiary. So holding company must hold 100% shares of subsidiary. As per the Companies Act, if they hold 51%, that's enough to set to be holding subsidiary. But that is not enough under the tax law. Under the income tax law, holding company shall hold 100% shares of the subsidiary. So it must be a wholly owned subsidiary. Then holding company selling depreciable asset to subsidiary company at any price, that price cannot be taken as actual cost of the subsidiary or vice versa. Only the WDV of the transferor, actual cost of the subsidiary. That is, or subsidiary selling to holding, WDV of subsidiary, actual cost of holding. So likewise. Next one, sometimes they may ask in problem as an adjustment in large questions as a small adjustment. Loan taken to purchase depreciable asset, but there is a delay in put to use of that asset. For purchase of asset, loan has been taken, but asset has been obtained, acquired, but put to use there is a delay. So simple rule, from the date of loan, interest due from the date of loan till the date of first put to use of that asset. For this period, interest must be capitalized. It should be added to actual cost. So interest after the date of put to use, claim under section 36, charge to P&L, business expenditure. So from the date of loan till the date of first put to use, these periods interest should be added to cost of the asset. And after put to use, the depreciation came claimed under section 36. The loan is taken from bank to capitalize the interest. Whether the interest is paid or not doesn't matter. Interest due is enough. From the date of loan till the date of first put use, you can add it to cost of asset. But after put to use, the interest can be claimed as deduction only if you comply with the section 43B. That interest should be actually paid before the due date for filing income tax return if the loan is taken from bank, public financial institution, cooperative bank, NBFC. Then interest will be allowed only on payment basis. But to capitalize interest, there is no such condition in 43. So interest is due, enough. The period is important. From the date of loan till the first put to use date of that asset add. Whether paid or not. After that, the interest can be claimed only if it is paid, if the loan is taken from banks, etc. Now, GST on purchase of depreciable asset, simple rule. Double benefit under IDT and DT, not possible. So, if input tax credit is availed under the input tax credit provisions of the CGST Act, then here do not add that GST portion to the cost of the asset. But under IDT, you cannot claim input tax credit. Maybe you are unregistered person, you cannot take ITC there. Or if it is section 17 subsection 5 of the CGST Act, it is a blocked credit. You cannot take credit there. For example, it's a motor car having approved seating capacity of less than or equal to 13 including driver. So in that situation, it is blocked. You cannot take credit there. So now add it to cost. If credit available there, do not add to cost. So either DT depreciation or IDT ITC for GST portion on asset purchase. Now subsidy or grant directly related to purchase of a depreciable asset, it must be reduced from the cost of the asset. As per ICDS 7, any grant or subsidy other than this should be treated as income, PGBP income. Only this particular subsidy, that is a subsidy or grant directly related to acquisition or creation of a asset, that subsidy or grant must be reduced from the cost of asset. All other subsidy or grant must be treated as income under the income tax law as per ICDS 7, government grant. We'll discuss ICDS separately. Just a connected point I discussed. Okay. Now, asset used by a non-resident outside India, subsequently brought it into India. So now you want to claim depreciation in India. What is the actual cost? Simple. Original cost of that asset outside India. Reduce notional depreciation for the period this asset is used outside India. You will get WDV. That should be taken as the actual cost in India. Asset used by non-resident outside India, then brought to India. Similar to gift. Original cost minus notional depreciation. 35 AD asset. Inter-unit transfer. Within the same assessee have two business. One is 35 AD business, another one is non-35 AD business. Asset purchased for 35 AD, claimed reduction there. Entire cost of the asset claimed under section 35 AD. Then this asset is transferred to non-35 AD business within 8 years. 8 years is counted from the date on which this asset is installed here. Under 35 AD, on which date it is installed, from that date, within 8 years, 35 AD asset should not be transferred to your other business. If you transfer that asset to the other business unit, definitely there will be deemed business income. In that situation, in the recipient unit, this asset you can depreciate. So what is the actual cost? Original cost of that asset for which deduction claimed under 35 AD, take the original cost, reduce notional depreciation for the period that asset has been used under 35 AD business. That is, instead of claiming section 35 AD deduction, if assessee had been claimed depreciation, what would have been the amount of depreciation? Reduce that. So you will get a WDV. That must be taken as actual cost in the recipient unit. And the same WDV will be treated as deemed income and taxable. So that figure has double role. Due to violation of condition of lock-in period of 8 years, that figure will be treated as deemed income. And that same deemed income figure can be shown as actual cost in the recipient unit, and you can depreciate in the non-35 AD unit. So from here 35 AD, non-35 AD, transferred within 8 years. So here deemed business income, and that same figure here actual cost. So what is the actual cost or deemed income figure? Original cost of that asset for which deduction claimed under 35 AD minus notional depreciation for the completed years it has been used in 35 AD. Remaining WDV, deemed income, that same figure is actual cost in the recipient business. So what about after 8 years? After 8 years, this lock-in period condition not applicable. So there is no deemed income. So there is no actual cost. You cannot depreciate. So after 8 years, if 35 AD asset is transferred to non-35 AD business of the same assessee, actual cost is 0, nil. So these are the special cases of actual cost. Now I will discuss when capital gain or capital loss arises for a block. Then we will go for a break. After the break, we will finish depreciation. Okay, straight line method and some restructuring, depreciation finish, and today itself we will go to the next section. Block of asset or capital gain or capital loss on block of asset. Section 50. Actually, capital gain provisions prescribed in 50, what we are studying is 32 and 43, but as it is related to block of asset, we have to study now. Capital gain or capital loss on block of asset. Theory is very simple. In a block of asset, block means group, pool. It's a combination of assets or group or pool. So in a group of asset, block of asset, when capital gain arises? Answer is very simple. When the sale value of one or more asset in the block is sold during the year, the sale value exceeds opening plus addition. So block becomes negative. So that negative value is known as capital gain. So law says when one or more asset in the block is sold for a value which is more than opening plus addition, there will be negative value for the block. So that negative value is known as capital gain. Block becomes negative. We cannot claim depreciation. To claim depreciation, block should have a positive value. Why? Because depreciation is applied as a percentage on block value. If block is negative, depreciation cannot be claimed. So when block become negative, sale value exceeds opening plus addition. To arise capital gain, not necessary that entire asset has been sold. That's not required. Even a single asset is sold, but the sale value becomes more. Block has 10 assets, but only one asset is sold. That sale value exceeds opening plus addition. There will be capital gain. When capital loss arises, to attract a capital loss, very strict condition, complete assets in that block is sold and sale value less than opening plus addition. So it is a case similar to depreciation. Block has positive value, but at least one asset should remain in that block to claim depreciation. But complete asset is sold. So block has a positive value, but no asset remains. We will put a note. We cannot claim depreciation as the block does not have a single asset. So this positive value of the entire block value can be claimed as capital loss. As per section 50, block of asset, capital gain as well as capital loss, always short up. Gain is short up. Loss is short up. They are not saying asset is short up. No, don't study like that. If the block is held for more than 24 months, long term, block is long term, but always the gain or loss is short term. Why? We cannot identify. There may be some assets acquired 3 years back, 10 years back. There may be an asset acquired 1 year back. There may be an asset acquired 6 months back. So one of the asset is sold. How you will allocate whether it is long term or short term? It is impossible. That is why law says always short term. Deem it as short term. But block may be long term. Showing an example of normal case gain loss. So plant and machinery, WDV as on 1424, receive 10 lakhs. I have 5 machines. Just I am putting number of assets also. I have 5 assets in the block. Addition, rupees 3 lakhs. I purchase 2 more assets. So total I have 7 assets. Block value. Opening plus addition 13 lakhs. Less sold old. One of the old asset in the block is sold, or 2 assets has been sold, and the sale value is 9. So there will be a positive value for the block, rupees 4 lakhs. So what is assets remaining? Assets remaining is 5. Usual case, no problem. Claim depreciation. Block has positive value 4 lakhs. Block has assets, 5 assets. At least 1 asset is enough. 5 assets. So claim depreciation. So we can claim depreciation. This is block value. So 4 lakhs into 15% depreciation. Closing W. This is what we studied, normal case. Now capital gain. So same, opening WDB 10 lakhs. I have 5 assets. Addition 3 lakhs. I have 2 more assets purchased. So total 13 lakhs. 7 assets. Old 2 assets sold, but the selling price is rupees 17 lakhs. So if the selling price is 17 lakhs, the problem is if we put 17 here, there will be negative. So negative 4 lakhs. So whether assets remains? Yes, 5 assets remains, but the block is negative. So we'll put a note, no depreciation as the block is negative. Therefore, short-term capital gain is equal to rupees 4 lakhs, and it will take into capital gain. Now capital loss. Open WB 10 lakhs, 5 assets, addition 3 lakhs, 2 assets, total 13. I have a 7 assets. All seven sold for rupees 5 lakhs. Complete asset has been sold. So I have nil assets. Sale value 5 lakhs. So 13 minus 5. I have a positive value of 8 lakhs. But no depreciation as no asset remains in the block. Therefore, short-term capital loss is equal to 8 lakhs. So this is capital gain or capital loss. So there will be never a situation where depreciation and capital gain, depreciation and capital loss will never occur. Either depreciation or capital gain or capital loss. There is no individuality for assets. Even though a single asset is sold, or 2 assets is sold, or 3 assets is sold, the point is if the sale value exceeds opening plus addition, then only capital gain arises. At the final level, you have to keep in mind another important point I am discussing. See, block is long term, but capital gain is always short term as per section 50. Now the question is, from this capital gain, can I claim section 54F? Can I claim section 54EC? This is the question. So what section 54F? 54F says if you have any long-term capital assets other than residential house property, if you have any long-term capital asset which is transferred and the sale proceeds is used to purchase one residential house within India, you can claim 54F exemption proportionately. What 54EC says, if you have a long-term land or long-term building and transferred, gain arises within 6 months, invested in specified bonds, maximum 50 lakhs, exemption 54EC. These two sections, even 54 or 54F or 54EC. So mainly into the business world, we have to keep in mind F and EC. 54F and EC says capital asset transferred must be long term. Under 54 easy, long term land or long term building must be transferred. They are not saying gain should be long term. No, they are not saying. Under the income tax law, there is only one situation. Asset may be long term, gain will be short term. That is depreciable asset. So depreciable block is long term, gain is short term. All other conditions satisfied. Straight away you can claim exemption. Exemption 54 easy exemption is possible. For example, block of factory building, block of office building used for business purpose. The block is held for more than 24 months. Block is long term, transferred, gain arises. I invested in National Highway Authority of India Limited bond, or Rural Electrification Corporation Limited bond, or Power Finance Corporation Limited bond, or Railway Finance Corporation Limited bond within 6 months, maximum 50 lakh. I can claim exemption, no problem. I satisfy all the conditions. So this point is very important. Even section 50 says capital gain from block of asset is short term. Section 50 never says block is short term. Block may be long term or short term, depends upon period of holding. If the block is held for more than 24 months, block will be long term. The block is held for lower than 24 months, short term, depends, right? Period of holding. So there is a connection between capital gain tax planning and the depreciable asset. You should keep in mind. Now we will take a break. After the break, we will finish the remaining provisions of depreciation, unabsorbed depreciation and straight line method, and some 2-3 questions. Then it will be over. So in depreciation, the last two topics, one is straight line method. We'll explain straight line method, and then we will move to unabsorbed depreciation, so that 32 is over. Then some questions will wind up 32. Straight line method depreciation available for an assessee who is engaged in generation or generation and distribution of power. So generation is a must. So first year, when they start business in the first year, before filing the ITR, due date for filing ITR, they have to select whether they need WDV. Otherwise, by default, SLM. So they have an option to go for WDV. If it is SLM, straight line method, they are choosing straight line method, then how the depreciation will be computed? Remember, no block. For each and every asset, separately depreciation must be computed, no block. So individual asset, separate depreciation. Method is straight line. The rate is different, not like WDV, the rate will be different, and the rate is prescribed. For our exam purpose, if they are asking a question on SLM, definitely the question will carry the rate, because in our syllabus, SLM rate is not prescribed. So no block, individual depreciation, SLM method. Calculation of depreciation is very easy, nothing to ask. The only thing is sale of SLM asset, what is the tax impact? That you have to study. Original cost in 2022-23, say 10 lakhs. Assume 10% SLM rate. So first year, 22-23, 10% depreciation they claimed 1 lakh. Less than 180, more than 180 rule here also applicable. If asset is put to use in the same year for less than 180, half. That is applicable for SLM also, but no block. So here it is more than 180. So first year depreciation 1 lakh, balance 9 lakh. So 23-24 also depreciation claimed 1 lakh. So WDV, we cannot say it as WDV, value of asset as on 1/4/2024 rupees 8 lakhs. This asset is sold. Selling price in 2024-25 sold for, if it is sold for 8 lakhs, what is impact? If it is sold for 5 lakhs, what is impact? If it is sold for 9.5 lakhs, what is impact? If it is sold for 13 lakhs, what is impact? So 2 years we already depreciated. At the third year, the asset is selling. So if the asset is sold for 8 lakhs, no impact, no profit, no loss, nothing. 8 lakhs is the value to be depreciated. Sold it for 5 lakhs. So there will be a loss. So the loss is 3 lakhs. This 3 lakhs loss is known as terminal depreciation. This entire terminal depreciation allowed under section 32. And this asset is over. So if the straight line method asset is sold at a loss, that loss, we will not call it as capital loss. You cannot call it as capital loss. Once it is depreciated, even 1 year is completed, second year it is sold at a loss, it is known as terminal depreciation. Sir, when capital loss will arise? The first year, before completing an year, first year itself, purchased it and immediately sold it at a loss, there will be capital loss. Once you depreciate it, then sell it, the loss is known as terminal depreciation. Entire terminal depreciation you can claim under section 32 completely. 8 lakhs is sold for 9.5 lakhs. Okay. At that time we should think about 41, section 41. Already you claimed 2 lakh depreciation. This is known as depreciation claimed. Profit to the extent of depreciation claimed, taxable as balancing charge, business income under section 41. So here the profit is rupees 1.5 lakhs. 8 lakhs is sold for 9.5 lakhs. So 1.5 lakhs compared to 2 lakhs, it is within the range of depreciation claimed. Up to 2 lakhs balancing charge. The profit up to 2 lakhs balancing charge. Here is only 1.5 lakhs. it is taxable under section 41, balancing charge or business income. Business income tax. 8 lakhs sold for 13 lakhs. So what is the total profit? Total profit is 5 lakhs. 13 minus 8, 5 lakhs. So what is the impact? Out of this 5 lakhs, balancing charge under section 41 is 2. 2 lakhs balancing charge. Out of 5 lakhs minus 2, balance 3 lakhs. This is capital gain. Capital gain. As it is more than 2 years, it is long term. Capital gain we can compute in another way also. Full value of consideration 13, cost of acquisition 10, 3. Likewise also we can calculate, or we simply take the difference. Both will be the same effect. So up to the depreciation already claimed taxable as balancing charge, and over and above original cost if there is selling price, that excess is known as capital gain, taxable under capital gain head. 3 lakhs is capital gain, 2 lakhs is balancing charge, entire 5 lakh is taxable in 2 heads, PGBP and capital gain. If the sale price is less than original cost but more than the value to be depreciated, balancing charge. Over and above original cost, balancing charge plus capital gain. So this is straight line method. Remember, if an assessee claiming depreciation under straight line method, no additional depreciation available, only normal depreciation only. So SLM is over. So you need to remember the concept of balancing charge, terminal depreciation, CG, capital. That's it. Maximum you can expect in MCQ, numerical problems, no chance. Unabsorbed depreciation. Capital loss. Capital loss. Capital loss. Yeah. There is no terminal depreciation. To set to be terminal depreciation, at least 1 year you should depreciate. Second year you sold it loss, capital loss. Plus balancing charge also possible. Same year if it is sold, okay, only capital gain. Or same year if it is sold at a gain, capital gain. Sold at a loss, capital loss. Once completed, terminal depreciation, balancing charge, capital gain. Unabsorbed depreciation at the final level, you have to keep in mind certain important points. So what is unabsorbed depreciation? Simple. 30 to 37, lot of expenses are there. Other than 32 current year depreciation, all other expenses you claimed, there is a negative. We will call it as business loss. While claiming depreciation, negative came. Unabsorbed depreciation. So anyway, PGBP is negative. Out of that negative, to the extent of depreciation, unabsorbed depreciation. Balance, business loss. What is the difference? Business loss can be carried forward only if the return is filed within the due date as per section 139 subsection 3. Read with the section 80. Business loss can be carried forward only if the return is filed within the due date. Current year loss. Once it is already carried forwarded for the next 7 years, automatically it will come. But in the year in which loss is incurred, to carry forward, return must be filed within the original due date. Even a single day delay, that loss will lose forever. That's the first impact. But unabsorbed depreciation, you can carry forward even though return is filed belated. And second, business loss, we can carry forward up to maximum 8 assessment year from the first assessment year in which a loss is computed. But unabsorbed depreciation, infinite period. Next, current year business loss, you can set off with other heads. Brought forward business loss only against the PGBP income. You cannot set off with other heads. But current year business loss, you can set off with capital gain, or current year business loss can be set off with HP income. Current year business loss can be set off against other source income. Brought forward business loss only against the PGBP income. What about unabsorbed depreciation? Brought forward unabsorbed depreciation can be set off against any head of income. Even though unabsorbed depreciation belonged to 10 years back, their unabsorbed depreciation can be taken in current year. You can set off against the capital gain. You can set off against HP. You can set off against IFOS. But basic rules you should be keep in mind. PGBP loss cannot set off against a salary. So unabsorbed depreciation cannot set off against a salary. You cannot set off any loss against the casual income, winning from lottery, betting, gambling, card game, online game, black money. You cannot set off. So unabsorbed depreciation cannot set off against the casual income. Unabsorbed depreciation cannot set off against the black money. Unabsorbed depreciation cannot set off against a salary. But against all other income, other head you can set off, even though it is brought forward unabsorbed depreciation. But remember, business loss, current year business loss you can set off with other heads, brought forward business loss cannot set off. So what is unabsorbed depreciation? Due to non-availability of profit or unavailability of profit, entire amount of current year depreciation, including additional depreciation, we cannot set off. So there is a negative. That is known as unabsorbed depreciation. Section 32 subsection 2, infinite period can be carried forward. Even though return is felt belated, we can carry forward because section 139 subsection 3 restriction not applicable for unabsorbed depreciation. And in case of business restructuring, predecessors, unabsorbed depreciation will be available to successor, and successor can carry forward infinite period. So these are the major points you have to keep in mind regarding unabsorbed depreciation. It is very concessional provision. Why? Again, depreciation is not an expense. It is an allowance. It is an allowance until it is completely utilized. It carry forward. That is why it is not an expense. It is a deduction of allowance, capital allowance. There is other two sections where capital expense is infinite. 35, scientific research. Capital expenditure you are claiming. Profit is only 5 lakhs. Capital expenditure on scientific research is 8 lakhs. 5 lakhs minus 8 lakhs. 3 lakhs loss. Don't call it as business loss. That will be added to unabsorbed depreciation. Infinite period. Other capital expenditure 35 AD. Infinite period you can carry forward. So for capital allowance, such a privilege is available under the tax law. Even prior to introduction of 1961 income tax law, prior to that some other law was prevailing. In that law also such a concept was there. That is followed. Okay. Next, another simple adjustment. If an asset is partly used for business and partly used for personal purpose, then only proportionate expense is allowed in business, including depreciation. Out of the total asset use, how much is for personal use? Proportionate expense is not allowed. It will be disallowed. That is a power of assessing officer under section 38. 38. Yeah. So depreciation, the only last point we have to discuss is restructuring, that we already discussed during the previous year. If there is a business restructuring, first to find out the depreciation, then the depreciation is allocated to predecessor and successor based on number of days asset used by both of them. Split it. So restructuring, they can ask a question similar to that. Now we will do a question covering capital gain as well as special cases of actual cost 43 and capital gain together in a single question. That question we can do. In our workbook, second question. So first read the complete question carefully and then start. Rameshwaram, we cannot say like that. Rameshwaram, okay. Rameshwaram, after purchase put to use on 15th December 22. So the question start from the financial year 22-23. So we have to start from there because they may ask depreciation for current year. To obtain the current year depreciation, you need opening WDV. So you have to start from the beginning. 22-23 the first year. A machine worth rupees 3 lakh. Eligible for depreciation 15%. He sold this machine to Ganesham On 1st January 24. 1st January 24 means 23-24 financial year. For 3,25,000. Fair market value on that date was 2,50,000. Who after having used the machine for his business purpose again sold it back to Rameshu. Chain of transaction. Rameshu sold it to Ganeshan and then Ganeshan claimed depreciation. Again Ganeshan returned back to Rameshu. When 15th November 24. Which year? 24, 25. So 22, 23, 23, 24, 24, 25 chain of transactions. So you have to start from 22, 23, come to here and then go back to there. They are asking for depreciation. From assessment year 23, 24 to 25, 26. 3 year 23, 24. Assessment year 23, 24, 24, 25, 25, 26. For both Rameshwam and Ganesham. There may be capital gain, there may be depreciation. That we can know only when we are solving that question. Do it. They are saying no need to compute additional depreciation. Okay, ignore additional depreciation. And further question doesn't say manufacturing. Okay, only if they are saying manufacturing, we can take additional. Yeah. 23-24 asset is transferred. So 23-24 you won't get depreciation. The claim depreciation asset should be remain in your hand as on 31st March 24. But in that year he can claim, Ganeshan can claim, okay, he bought it. Before taking actual cost of Ganeshan, you should be very careful. Ganeshan is purchasing a used asset. Explanation to section 43. When a second hand asset is acquired at a higher price, actual cost will be determined by AO. What will be the actual cost? The value of that asset at that time. It's given in the question. What is the actual cost? 2,50,000. So we have to put a note on that. Used asset, second hand asset acquired at a higher price compared to market value to claim more depreciation. Fraudulent intention. Actual cost will be determined by AO. So we are step into the shoes of AO. So we are doing that. Market value. Even though he purchased for 3,20,000, 3,20,000 cannot be taken to Ganeshan as actual cost. Actual cost will be 2,50,000 FMB. Sold for 3,10,000, right? $78,750 short-term capital gain, no depreciation. Can come back to. Again, come back to Rameshwam. So for Rameshwam, assessment year 25, 26. So he is purchasing this asset for rupees 3,10,000. The problem is that same asset is earlier sold and now repurchase. If asset is sold and repurchase, the rule is WDV at the time of sale or repurchase cost, whichever is lower. WDV at the time of sale, that is 2,77,500, or repurchase cost, that is 3,10,000, whichever is lower only allowed as actual cost of Rameshwam. So actual cost of Rameshwam is 2,77,500. November 24. Therefore, depreciation at the rate of 7.5%. 277,500 into 7.5%. 12,000, 20,000, 8, 813. This is the depreciation. Final answer, they are asking for depreciation, right? So first year depreciation 22,500, then depreciation here 18,750, then depreciation 20,800. So we have to put some notes on this question. One is explanation to section 43. When second hand asset is acquired at a higher price with a view to claim more depreciation, actual cost shall be determined by assessing officer, that is market value in this case. And then if a asset is sold and repurchased the assessee by the same assessee, actual cost shall be WDV at the time of sale. WDV at the time of sale means opening WDV of the financial year in which original sale happens, because under income tax law there is no calculation of depreciation until the date of sale. There is no such thing. Only at the end of the year we are computing depreciation. In between there is no depreciation calculation. That's only in accounts. So 277,500 or repurchase cost 310, whichever is lower. 277,500 is the actual cost. Now we are moving to the first question, so that we will complete depreciation, right? First question. I am reading that question. Sai Limited has a block of assets carrying 15% rate of depreciation. It's a company, Sai Limited, whose WDV as on 31st March 24, after reducing depreciation for previous year 23-24 was rupees 40 lakhs. That is simply speaking, opening WDV as on 1/4/2024, 40 lakhs. It purchased another asset, second hand plant and machinery of the same block on 1st November 24 for 14.4 lakhs and put use on the same day. Sai Limited was amalgamated with Shirdi Limited with effect from 1st January 25. You are required to compute the depreciation allowable to Sai Limited and Shirdi Limited for the previous year 24-25, assuming assets were transferred to Shirdi Limited at rupees 60 lakhs. Also assume that the plant and machinery were purchased by way of account pay check. So first of all, we can say the 60 lakhs rupees has no relevance under income tax law, because whenever depreciable asset is transferred under amalgamation, WDV of the amalgamating company shall be actual cost of the amalgamated company. So there is no impact of this intrinsic value, or this value, that is 60 lakhs, has no relevance. So whenever there is an amalgamation as per section 32, depreciation can be claimed both by the predecessor and the successor based on number of days asset used by both of them. So we have to compute depreciation first and then allocate based on number of days. So 1/4/24, the end of the previous year is 31st March 25, and the addition happened on 1st November 24, 1st November 24, and amalgamation happens on 1st January 25. January 25. So open WDV 40 lakhs, 40 lakhs. Addition is rupees 14.4 lakhs. 14.4 lakhs. It's 15% block. So first compute depreciation on opening WDV separately, so that easy for allocation. So 40 lakhs into 15%. How much? 6 lakhs. So this 6 lakhs should be allocated to Sai Limited, and from this date onwards Shruti Limited. This is the date of amalgamation. So 6 lakhs depreciation. This asset is opening WDB asset is used to buy both of them throughout the year. Both of them together 365 days. It is not a leap year, so 365 days into. From 1st April till 31st December, this asset is used to buy Sai Limited. Thereafter, Shruti Limited. So the number of days from April till 31st December we have to take. So April 30, May 31, June 30, July 31, August 31, September 30, October 31, November 30, December 31. What is the total? $275. What? Yeah, definitely. You should take days because Act uses the word days. Income tax is a strict interpretation, right? We are saying days, we should take days. This question not asking from depreciation. This question is this will be one of the adjustment and restructuring problem. 8-mark problem. This will be one adjustment carrying 2 marks. So 6 lakh by 365 to 275. How much? 452,055. This will be available to Sai Limited. Remaining will be Shruti. Simply take the difference. Now need to again find out the days because balance will be available to the Shruti Limited. So for Shruti Limited, the depreciation will be 6 lakhs on opening WDB will be 6 lakhs minus 4,52,055. Balance 946, 945. This will be available to Shruti. Always in these type of questions, opening WDB depreciation allocation is easy because full depreciation we can find out. We can put 365 days denominator and multiply number of days used by the predecessor. So remaining will be successor. But in some question there will be tricky. I will tell you the adjustment. In some question they will say, even though amalgamation took place on 1st January 25, there was a disruption in business and Shruti Limited started business only on 1st February 25. Even though amalgamation took place on 1st January, they started business on 1st February. If they are saying like that, we cannot take 365 days in the denominator. Then you should be careful. There is no 365 days use. Because 1st January to 31st January, nobody is using this asset. So 365 minus 31, we have to put in denominator. Got the idea? But this question is easy because there is no disruption in business. Simply we can put 365 days denominator. Now, what about addition? Okay, I am taking the addition. This is 14.44 lakhs. This addition is made by Sai Limited. This is less than 180 days. So depreciation on 14.4 lakhs into 7.5%. How much? 1 lakh? 8,000 divided by. We have to count the date from here, 1st November till 31st March. So 151 into number of days from here to here, 61. So available to Sai Limited is rupees. How much? How much? 629. And balance will be available to Shruti Limited. That is rupees 1,08,000 minus 45,60. Much? Here 43. Okay. So what is the balance? 64. 371. This is Shruti. So total depreciation to Sai and Shruti, we have to take separately and take the total. This is the total depreciation available to Sai Limited, Shruti Limited. Sai Limited 452.55 and 43,629 for Sai, and for Shruti 147,945 and 60. So the only thing you have to keep in mind is if there is disruption of business after restructuring, after amalgamation or demerger, this rule can be applied in 5 cases: amalgamation, demerger, conversion of private company or unlisted public company into limited liability partnership, proprietorship is taken by company, partnership firm is taken by company. In 5 cases, this can be asked. So if there is, even though there is amalgamation, demerger happened on 1st January, for example, suppose the business has been started by Shruti only after 2 weeks or after 1 month. Remember, total number of days, we have to reduce that disruption. So in denominator, we cannot take 365 in case of opening WDV assets. One more thing, after restructuring, if the addition is made by the new company, entire depreciation will be available to the new company. There will be no depreciation allocation for predecessor if the addition is made after 1st January 25. So here the addition is made in 1st November before restructuring, that is why allocated. Because if the addition is made after the restructuring, it is not used by the predecessor. Act says asset used by both of them, number of days used by both of them. So depreciation is over. Now we can move to the next section, section 33AB. Section 33AB, tea, coffee or rubber development accounts. So it is a special deduction available to an assessee who is engaged in growing and manufacturing tea or coffee or rubber in India. Remember, growing plus manufacturing. So only growing, absolutely agriculture, no question of income tax. Only manufacturing, business income taxable, 33AB not available. So you have your own tea plantation or coffee plantation or rubber plantation, plus you are cultivating tea, coffee, rubber, taking the tea leaves or coffee beans or latex, produced rubber or produced tea powder or produced coffee powder. Okay, you are eligible. You cannot claim depreciation on plantations and estates, so that is why this a particular special deduction is given. There are 2 advantages available for tea, coffee, rubber development account assessees. Number 1, this deduction 33AB, and another benefit is if they are getting any subsidy from government for replantation or to putting new plants. So for that subsidy completely exempted under section 1030 and section 1031 of the income tax law. So as per section 10 subsection 30 and 31, if these tea, coffee, rubber development assessees are getting some subsidy from the government for replantation, because after 70 or 80 years, this plant will go on, so they have to recultivate, right? New plant they have to put it. So for that purpose, government will give subsidy. So sometimes if there is any hailstorm or something like that, some natural calamity, this plant has been gone or plant become dead. In that case also government will sometimes, this tea board or coffee board or rubber board under central government will give them some subsidy. So that subsidy is completely exempted. And another advantage is 33AB deduction under the tax law. So this is very important. Growing and manufacturing, both together, composite activity, composite, agriculture plus business. An activity must be carried out in India. If growing and manufacturing in Sri Lanka, assessee is resident, complete income is taxable in India, no exemption for agriculture income and no deduction also. Okay, can be claimed by any assessee. So during the year, first find out the current year PGBP income of this assessee. Simply find out the PGBP income of tea, coffee, rubber, growing and manufacturing assessees. Out of that PGBP income, part of the profit should be transferred to a special deposit account opened with tea board or coffee board or rubber board. It is a special account like a reserve account opened with tea board or coffee board or rubber board. Usually it is an account in bank account. It's a bank account, but it is under the control of tea board, coffee board, rubber board. So we have to transfer a part of the profit to that account. Or you can transfer the part of the profit to NABARD, a special deposit account opened with NABARD. So both is not required anyone, either with the tea board, coffee board, rubber board, or with the NABARD. And now to that the special deposit account, part of the profit must be transferred within a time limit. The time limit within 6 months from the end of the previous year, or due date for filing ITR, whichever is earlier. That is practically September 30th. So before September 30th, we have to make the deposit out of the current year profit. Profit must be transferred to that special deposit account. So within 6 months from the end of the previous year will be earlier, because due date for filing return will be October 31st. Because to claim this deduction, audit is compulsory. So for those assessee, audit is applicable, the due date is October 31st. So 6 months will be September 30th. Assessment year September 30th. Before that, they have to deposit part of the profit into tea board, coffee board, special deposit account. So okay, if these conditions satisfied, they can claim a deduction. The deduction is what is actual profit transfer, or 40% of current year PGBP income, whichever is lower deduction. So amount deposited with the special deposit account with the tea board, coffee board, rubber board, or NABARD, or 40% of the profit. Profit here means PGBP income computed for the current year, before setting off of losses and before claiming Chapter 6A, and without considering all other heads. Only current year PGBP computed from section 28 till 44. Computed income under income tax, not accounts profit. PGBP computed. But current year PGBP only. To compute the 40% of PGBP, don't set off brought forward loss. Don't claim Chapter 6A. Only current year PGBP before set off of losses in Chapter 6A. Into 40% or transferred amount, whichever is lower. So we can say maximum profit transferred up to 40% of current year profit will be allowed as deduction. And once we claim directly, we can simply claim as deduction. So our profit will be reduced. Only the remaining profit only we have to pay tax. So now the profit is available with the tea board, coffee board, or rubber board. Okay, can we withdraw that money? Yes, it is possible. You can withdraw that profit subsequently, and it can be utilized for specified purposes. Either it must be utilized for purchase of plant and machinery, or it can be utilized for special deposit purposes or special purposes mentioned in the scheme. Scheme means tea board, coffee board, rubber board will say certain purposes. For these purposes, you can withdraw the money and can utilize. So what are those purposes? General meaning is enough. Generally, that money can be withdrawn and it can be utilized for genuine business purpose, to pay bonus to the employees, for tea factory maintenance, to protect the plant. So for all those purposes, genuine business purpose, you can utilize that money, or it can be utilized for purchase of plant and machinery. But that plant and machinery has certain restriction. So that plant and machinery should be eligible plant and machinery. Here eligible means it should not be installed in office premises. It should not be installed in residential accommodation. It should not be installed in guest house. It should not be an office appliance. It should not be a plant and machinery used for producing 11th scheduled goods. 11th scheduled goods means alcohol, office stationaries. So those type of some unpriority items are mentioned in 11th schedule. So those goods mentioned in 11th schedule should not be manufactured by using this plant and machinery. So that point is not that much irrelevant, but other points is very important. That should not be installed in office, residential accommodation, guest house, or office appliance. Sir, what will happen if we purchase a computer? Okay, if the computer is purchased and installed in factory, no problem. If the computer is purchased for office, violation. So any amount withdrawn from special deposit account. What is the importance of amount lying in special deposit account, for which you originally claimed reduction? You claimed reduction, and the money lying in special deposit account you can withdraw, but it should be utilized only for purchase of eligible plant and machinery or for the purposes as prescribed in the scheme. That means for genuine business purpose, you can utilize. And now, sir, if I utilize for ineligible plant and machinery, then what will happen? Okay, then cost of that plant and machinery will be treated as deemed business income. Deemed business income. if you are utilized for ineligible plant and machinery purchase, deemed business income. And one more thing, this eligible plant and machinery acquired out of the money withdrawn from this account, there is a lock-in period of 8 years. 8 years. So that plant and machinery should not be transferred within a period of 8 years from the year of acquisition, not the date of acquisition, from the year of acquisition. Even though it is a small point, you should keep in mind, because while doing in a practical application, there will be a confusion whether the 8 years should be counted from date of acquisition or from the end of the year in which it is acquired. Both are different. So if the machine is purchased in 2022-23, then from 31st March 2023, 8 years, fresh 8 years, not from the date, from the year of acquisition. Lock-in period 8 years. Okay, if violated, same result, deemed business income. If this eligible plant and machinery acquired out of the money withdrawn from the special deposit account is transferred within a period of 8 years, they will be deemed business income. Cost of that machine can be treated as business income, because cost of that machine means withdrawn from special deposit account, means the amount for which you claim deduction. There are two exceptions for lock-in period. If this machine is transferred to government, no problem. Or if it is a firm, and this firm has been taken over by a company within 8 years from the year of acquisition of that asset, due to that succession happens, this firm transferred this asset to company, no problem. So there are two exceptions for 8-year lock-in period. If the asset is transferred to government or government company or government corporation, no problem. If the asset is transferred in a scheme of succession of firm's business by a company, so this is the firm claimed deduction, firm purchased asset, within 8 years, this firm is taken by a company, so this asset is given to company, no problem. In all other cases, this eligible plant and machinery should not be transferred within 8 years. Now, so can we claim depreciation on this plant and machinery? There are two views. View number one, as it is an amount for which deduction is allowed, depreciation is not allowed. For this machine purchased out of this deposit account, depreciation again not allowed. There is another view, depreciation is not expenditure, it is an allowance. So anyway, if it is depreciable asset and put to use, we are eligible for depreciation, should be allowed. There are two views are possible. You can write some notes in exam if they are asking, but they never asked a question on that area. As it is some two views are possible, that may be the reason they never asked a question on that area. But anyway, the general point is, if an asset is purchased out of deposit account, you cannot claim depreciation again, because it will amount to double deduction. Similarly, any amount withdrawn from deposit account and used for purposes mentioned in the scheme, assume the purpose mentioned in the scheme is you can utilize it for payment of bonus to workers, plantation workers. Amount withdrawn, bonus is given to plantation worker, no problem. But that bonus expenditure again should not be debited to P&L, because that is again double deduction. This bonus you incurred out of the money withdrawn from deposit account, right? For those money deposited in account is eligible for deduction and you claim deduction. And again it is allowed as a business expenditure, double deduction. That is not possible. So they are clearly saying any expenditure met out of deposit account for which deduction earlier claimed, such expenditure again should not be debited to P&L. Again should not be debited to P&L. If it is debited, it will be disallowed. So that is why I am saying, if eligible plant and machinery is purchased out of this deposit account, you cannot claim depreciation of that asset, because same effect, double deduction, not possible. Out of the deposit account, money withdrawn and used for repair of factory building, and that repair expenditure is debited to P&L, to be disallowed, Double deduction, not possible. And the next point we have to remember is, if any person withdrawing money from deposit account, there is a very strict condition in which financial year you are withdrawing from deposit account either to purchase machine or for specified purposes. Keep in mind, before the end of that previous year, it should be utilized. You cannot keep in hand. So any money withdrawn from special deposit account either to purchase eligible plant and machinery or for the purpose mentioned in the scheme, it should be actually utilized before the end of the previous year in which money withdrawn. Before the end of that year, it must be actually utilized. If there is any unutilized amount as on 31st March, deemed as income, taxable immediately. In that year itself, it will be taxable. So withdrawn amount to be utilized before the end of the previous year in which amount was withdrawn. Otherwise, that amount not utilized will be treated as deemed income upon the expiry of 31st March. That means in that year itself, it will be treated as an income. What? No, that won't be counted. Once you withdrawn, either you should purchase or you should utilize. Otherwise, it will be taxable. Redeposit will not be counted. Now, finally, if the special deposit account is closed, business discontinue. So I am not going to continue my business. I am stopping it. Some money is lying credit in deposit account. I want to take it back. So your account is closed and money is withdrawn. In 3 circumstances, that money will not be taxable. If it is withdrawn due to liquidation of company, not taxable. Death of individual, not taxable. Dissolution of partnership firm, not taxable. So in 3 situations, it is not taxable due to liquidation or this closure of business. Sorry, if it is liquidation of business or death of proprietor, it is not taxable. So if account is closed and amount withdrawn due to death or partition of HUF or liquidation of company, it is not taxable. But in 2 situations, it is taxable. Dissolution, it is taxable. Proprietor closed the business, not death, no partition of HUF, simply closed the business, money withdrawn, taxable. And dissolution of partnership firm or LLP, that money lying credit in that special deposit account is withdrawn, taxable. But remember, only those amount for which deduction earlier allowed is only taxable. Suppose 40% of the profit is 4 lakh, we deposited 5 lakhs, only 4 lakhs is allowed as deduction, that excess 1 lakh, not taxable. Because deduction is 40% of profit or amount deposit, whichever is lower. So if you are depositing more than 40% of profit, that excess amount, you are not getting any deduction. So that excess amount, if you withdraw, nothing will happen. So to the extent of deduction allowed amount lying credit in deposit account, you are making withdrawal, it will be taxed plus deemed business income. In the year of withdrawal, if the withdrawal is happened due to closure of business and dissolution of partnership firm or LLP. But if the account is closed and money withdrawn due to death of individual or partition of HUF or liquidation of company, it is not taxable. So this is the treatment when the account is closed and money is withdrawn. Now, while doing problem, there are a lot of confusions and a lot of issues. How we will solve a question on 33AB. I will tell you the biggest challenge here is it is a composite income, agriculture and business together. Under the income tax law, agriculture income from India is exempted as per section 10 subsection 1. Agriculture income exempted. So growing and manufacturing tea, coffee, rubber, composite, agriculture and business. Agriculture is exempted, but it is composite. So we have to split. Agriculture income is not taxable. So we have to split out of this composite income. Agriculture business we have to split. Government is prescribed rule. Growing and manufacturing tea. 60% of profit must be taken as agriculture, 40% business. 60-40. Growing and manufacturing tea, then we have to split as 60-40. And if it is coffee, coffee grown and cured, then 75-25. If coffee is grown, cured and roasted, then the ratio will be 60-40. Growing and manufacturing rubber, or we can say centrifuged latex, then 65-35. So this is the ratio for splitting up composite income into agriculture and business. So growing and manufacturing tea, 60-40. Coffee grown and cured, 75-25. Coffee grown, cured, roasted, 60-40. Growing and manufacturing rubber or centrifuged latex, 65-35. So we have to apply this ratio and split. Okay, we have to claim 33AB deduction, 40% of profit. Which profit? After splitting, take the business income into 40% or composite income into 40%. Lot of confusions. At which point we will claim the reduction? If there is a brought forward loss, when we will set off the brought forward loss? What about chapter 6A? It's a lot of confusion. So this is the steps for doing the problem. First we should do the PGBP. Make all the adjustments from 28 to 44. Make all the disallowance. Claim all deduction, depreciation, everything. Compute PGBP income. It is composite. Now we are not thinking about agriculture and business. Simply compute the P&L account, take the P&L account prepared by tea, coffee, rubber manufacturing company, take the P&L account as per accounts, take the net profit, add less, we got the PGBP. Don't claim 33AB now. Simply compute the PGBP. Okay, we got the PGBP. Okay, next step is 33AB deduction. So other than 33AB, all other expense you should be claimed. All disallowance you have made. So you got the PGBP. And now claim 33AB. Out of this PGBP income into 40% or amount transferred to special deposit account before 6 months, whichever is lower, deduction claim. So remaining income, apply ratio. So the second step is ratio splitting. So first step, composite income, claim 33AB, take the remaining composite income, split it. So keep in mind, deduction is claimed from, not from pure business, deduction is claimed from agriculture plus business income. We are claiming deduction. Then split. Agriculture is exempted. Remaining business income, that is known as current year PGBP taxable. From that, if you have brought forward loss, set off. Balance is the current year taxable business income. Now take HP, capital gain, IFOS, GTA, chapter 6A, total income tax. So first PGBP, then 33AB, then split into agriculture and business, and then current you will got current year PGBP income, then set off of losses, remaining is the taxable business income. So this is the order while solving a question, or practically we are trying a tea or coffee or rubber growing and manufacturing company. This is a steps. So any one step is, we made any mistake, the answer will be wrong. From this special deposit account, you can withdraw utilization, everything, right? I am showing a numerical illustration. Then we will go to exam question or exam type of question. So I will show the illustration. A tea growing and manufacturing company. So current year PGBP before 33AB. Computed, say 120 lakhs. 120 lakhs. Okay, I am claiming 33AB deduction. Amount deposited to Nagar, say rupees 60 lakhs or say 30 lakhs, or 40% of 120, whichever is lower. So 40% of 120 will come to 48, right? 48 or 30, whichever is lower, 30 lakhs. I claimed deduction. This 30 lakhs I deposit in Nagar's within 6 months. So this is previous year 24-25. I deposited on 30th September 25. So I go deduction. Remaining 120 minus 30. Assume it's a tea growing and manufacturing. So 120 minus 30, 90. This is composite income after deduction. Now split. Less agriculture income under section 10 subsection 1 exempted. So T, so 60% of 90, how much? 54 lakhs. 600. What is balance is the taxable business income for the current year. How much? 36. Assume I have a brought forward business loss of last year or prior years. Assume 20 lakhs. 20 lakhs at all. So current year PGBP income or taxable income is rupees 60. This is the current year. Now I am going to withdraw. I am going to withdraw some money from the depositor. So out of this 30 lakhs, I claim deduction. The board has 30 lakhs. Under 30 deduction claim. Out of this 30 in 2025-26 on 1st January 2026 withdraw rupees 20 lakhs. Out of this 20, I purchased the eligible plant and machinery for rupees 18 lakhs on 1st March 26. So balance rupees 2 lakhs not utilized. Not utilized till 31/3/26 not utilized. So the impact, this 2 lakhs is treated as business income, deemed income. Now, while taxing this 2 lakhs as business income, assessee will say this 2 lakhs is part of 20 lakhs. This 20 lakhs is part of 30 lakhs. That 30 lakhs is the deduction claim. That 30 lakhs is part of this 120 lakhs. That 120 lakhs contains agriculture income plus business income. So, you cannot re-tax entire 2 lakhs because I claimed reduction from composite income. So, while you are making re-taxing me due to violation of condition not utilized, entire amount cannot be taxed because that income includes agriculture income. Contention of the assessee is absolutely right. So, out of this, 40% only will be taxable. 40% taxable income will be rupees 80,000, 0.8 lakhs only will be taxable. 60% will be exempted. So remember, while applying the re-taxing provision, we should apply the ratio of agriculture and business because we are claiming deduction not after splitting agriculture and business. We are not claiming deduction from pure business income. We are claiming deduction from composite income before deduction or before splitting up, right? So that is why while re-taxing, assessee can claim my income includes agriculture. Agriculture is never taxable, 10(1) accepted. Only balance income will be taxable. Assessee, this plant and machinery transferred in 2028-29. Lock-in period is 8 years. 8 years it should not be transferred. 28-29 he transferred this plant and machinery for rupees 21 lakhs. He sold. Again, violation of condition. There will be two income. First capital gain and then deemed business income. Capital gain I am computing. Selling price 21 lakhs. Original cost 18 lakhs. 18 minus 21, 3 lakhs capital gain. Long term capital gain. Because more than 2 years. Long term capital gain. And now, lock-in period violated. So, original cost of the plant and machinery 18 lakhs. Because this 18 is coming from 20. That 20 coming from 30. So, re-taxable. Again, assessee can say, entire 18 lakhs you cannot tax because 60% is agriculture. Only 40% is taxable. So, 18 lakhs into 14%. 40% how much? 18 lakhs into 40%. How much? 3 lakhs you no need to split up because that is capital gain. That is there is nothing in as agriculture income. 7.2 lakhs. So total taxable will be 7.2 plus 3, 10.2. Unutilized amount may be re-taxable. Ineligible purpose spending, re-taxable. 8-year lock-in period violated, re-taxable. All these three cases, keep in mind, entire amount is not re-taxable, only business portion. If it is coffee, 25. If it is rubber, 35. If it is tea, 40. As it is tea, we put 40. That's very important. Entire amount cannot be taxable. Why? Because the deduction is claimed from composite income. Composite income includes agriculture and business. Agriculture income from India is exempted as per section 10(1). It's a constitutional provision. Central government does not have the power to levy agriculture income. That is why income tax says section 10 subsection 1 exempted. If that is taxable, it is unconstitutional. That is not possible. So that is why agriculture income is exempted. That you can eliminate, only business income is taxable. If it is coffee, we will put 25, 25. This is the way we have to do a problem. Now there is another doubt. Sir, in 2025-26, unutilized amount, 2 lakh into 40%, 80,000 is taxable. Sir, that 80,000 will be added to 25-26 current year profit, right? Yes. Sir, then we will calculate again 40% of transfer to deposit, we will get a deduction, right? You didn't get that idea. If this 80 lakhs added to 25-26 current year profit, 25-26 profit will be more, right? On that, if we apply 40% of profit or NABARD transferred amount, whichever is lower, you will get more deduction, right? So that is why Act clearly says this 80,000 will be taxable separately. That cannot be added to your current year income, because you will again, your current year income will be more. So in that year's 33AB deduction will be more, because profit into 40% or transferred, whichever is lower. So if profit is more, the 40% will be more. So this should be added only last. 2025-26 there will be current year profit. 25-26 there will be transferred to NABARD account. 25-26 deduction will be there after last current year income. So otherwise we can say that for 25-26 there will be an income like this, right? You got the point? To that add this 80,000. You cannot add to here, right? Equivalent 25-26 there will be a profit, right? You cannot add to that, or even you cannot add to here, or you cannot add to here also. You should add to last only. Otherwise there will be double deduction. That is why. So 33AB deduction, if they are asking a question like this, everything will be in a single question. If they are going to ask, everything will be in a single question. Otherwise they will ask nothing. In some attempt they are not asking 33AB, but if they are asking, they will go to extreme level. Current year brought forward and then withdrawn, everything is there. Other possibility, they may ask a comprehensive assessment of company question. The question will say, X Limited engaged in growing and manufacturing tea. Its P&L account is given. A large P&L account will be given. Lot of further information. Last they will say, it transferred rupees 78 lakhs to NABARD. Compute total income and tax liability of the company. It will be an assessment of company question with the 33AB adjustment. So you have to keep in mind this particular step. First compute current year PGBP, then claim 33AB, then split it, then brought forward loss set off. Usually in that type of question they will say ignore math, because if they are asking math also, they have to give 32 marks for that question, right? So they can ask like that. They asked similar type of question. Okay, 3 times they asked such type of questions. But recently they are not asking, but study material contains some good question on 33AB. Actually that question is a past year exam question. They put it in. So there is a possibility. So we have to know, because in India there are a lot of tea, coffee, rubber manufacturing companies. So practically it is important. That is why they are asking. We will try a question. What? Current year PGBP? Current year loss, you won't get deduction. 40% of profit should be positive. If loss, you won't get deduction. No. That can be. If you have a current year loss, that current year loss can be set off next year, but next year's after deduction only you can set off. Why? Because a set off point is less. Now there's only one question that we can solve. Question number 23. Page number 158, question number 23. Yeah, I will explain. Out of this 11 lakhs, current year you clear. Out of this 11 lakh, 10 lakhs is withdrawn. Amount withdrawn financial year is 24-25. So before 31st of March of 25, it should be utilized. Out of 10, 6 lakhs is utilized correctly for purchase of non-depreciable asset as per the scheme. 6 lakhs, now there is no impact. The only impact arises when that asset is sold within 8 years. Balance 4 lakh is there. Out of that 4 lakh, 3 lakh is used for ineligible plant and machinery violation. That 3 lakh can be taxed, but at that time assessable claim, this 3 is forming part of composite income. So this 3 includes agriculture. So 3 lakhs into 60% exempted, only 40% is taxable. Balance 1 lakh utilized only in April 25. April 25 means next financial year. Act says in the financial year in which it is withdrawn, before the end it must be utilized. So that is also violation. So April utilized means equal to unutilized. This asset is sold in April 25. April 25 means previous year 25-26, assessment year 26-27. There will be 2 consequences. One is original cost of the asset 6 lakhs into 40% taxable as business income 2,40,000. 60% is agriculture exempted. Further, there is a capital gain. Full value of consideration, it is sold for 8 lakhs. Cost of acquisition 6 lakhs. 2 lakh. Short term capital gain. This is business income added to business income. This is capital gain. Assessment at 26-27. Don't think about indexation. After 23rd July 2024, indexation not available. After 23rd July 24, if asset is transferred, indexation not available. After 23rd July, indexation available only for resident, individual and HEF in respect of land and building. That is only for the limited purpose of computing rate of tax. Computation, indexation not available. For calculating tax rate, they may compare with indexation 20 or without indexation 12.5. Otherwise, indexation not available, so should not take indexation. Yeah, but that is violation. That won't be counted. Okay. So, other possibility of asking this area, that is along with the assessment of a company, that is assessment of a tea company or coffee company, they can ask as a compulsory question. New syllabus they didn't ask, but in old syllabus, I think in 2017 or 18, they asked the question like that with the assessment of company of a tea company. Prior to that, they asked the question in 2009. That was my first attempt. When I am writing first attempt in June 2009, there was a question. Okay. Now we can go to the next section. So 33AB is actually important because it is not there in inter syllabus. It's only for final. So that is why it is important. In Munnar or in Ooty, there are a lot of tea manufacturing companies. They are doing 2 types of business. One is from their plantations, they will pluck the tea leaves, and some of the fresh garden green tea leaves will be directly sold to other tea companies, direct sale. And balanced tea leaves they will take to their factory, process it, and they will take the tea powder. So now the question is, what is the tax treatment of that direct sale of green tea leaves plucked from the own tea garden and sold? What is the tax impact? So Supreme Court says in a case, see, they are not doing any processing, simply plucking the green tea leaves and sell it directly in the open market. is absolutely agriculture income, section 10(1) subsection exempted. No need to include in any of these computation. So when we are taking the PGBP computed, from that PGBP reduce that profit credited to P&L. Because usually that sale of green tea leaves will be credited to P&L account. They will say sale of green tea leaves without processing. So that should be first, that should be reduced from net profit. That is not taxable. It is agriculture income, purely agriculture income. There is no business element, no manufacturing. Belkachi Tea Company Limited, that's the name of that case. So in that case, Supreme Court mentioned income from sale of green tea leaves, 100% agriculture income, and it should be reduced from the profit, and it is not taxable. Okay, so 33AB is over. This section, I know the CA final history from 2008 onwards. Okay, from 2008 till 2025, they never asked this section. Never. So there are two possibilities. Also, they will never ask. Or another possibility, they may ask. Okay, never ask. It's an unimportant section because very few people are doing this business. That is why. Those are big corporates. That is production of petroleum or natural gas in India. And they should have an agreement with the Ministry of Petroleum and Natural Gas. They can claim a deduction. Just study, compare it to 33AB. Make a comparative study so that easy for memorization. 33AB, growing and manufacturing tea, coffee, rubber. Here, production of mineral oil. There is NABARD. Here, SEBI, special deposit account with the SEBI. Sorry, not SEBI, SBI, State Bank of India. There is tea board, coffee board, rubber board. Here is Ministry of Petroleum and Natural Gas Authority. You have to open a special deposit account. There what we studied is, we have to transfer the part of the profit to that special deposit account within 6 months from the end of the previous year. Here they are saying, before the end of the previous year, you have to transfer. Before the end of the previous year. There is 6 months. And there is the deduction is, under 33AB, the deduction is 40% of profit or amount transferred, whichever is lower. Here, 20% of profit or amount deposited or transferred, whichever is lower. Just these things is enough. Leave it. Go to next section. 35. Scientific research. We will study 35 and then today we will wind up, okay? Till 35. Tomorrow onwards, we will start from 35 AD onwards. Third day, day after tomorrow, we have to wind up PGBP. Okay, then we will go to capital gain 2 days, IFOS, set off, and then we will go to assessments. So today you have to, during the night time and morning, early morning, you have to, whatever we discussed in the class today, you have to study that. Then it will be easy, right? By 20-25 days, you can finish the DT paper, then you can do the revision. Section 35, scientific research reduction. Again, incentive. Again, it is a tax incentive. Section 35, scientific research. The purpose is make in India or reduce the dependence on foreign technologies. Government is always promoting in-house research. So government is saying, if you are doing in-house research or you are promoting scientific research, we will give you deduction of that expenditure under the income tax law. Either if there's no section like 35, then whatever R&D expenditure, you cannot claim under income tax if there is no such section. So this section is very important. Only because of this section, we can claim R&D expenditure as a business expenditure under while computing income tax. There are two types of research, in-house research and donation to outsiders. If assessee, 115 BAC, BAA or BAB, contribution or donation not allowed. But in-house research is possible. So in-house research, there must be a connection between the research activity and the business carried on by the assessee. So the research work must be related to the business. That is the only basic condition. In-house research means your own in-house research setup. You have an R&D department, you have scientists, You have research staff, you have a research building, and you are carrying out research along with your business. So that is in-house research. So only large corporates can afford that in-house research. Donation means in India, there are a lot of research associations or institutions like Indian Institute of Technology, Institute of Medical Science, or All India Institute of Agriculture Research Institute, or Indian Institute of Science, Bangalore, or IITs, or national laboratories. They are doing research. To that research associations, we can give donation. In that case, their research and our business may not be connected, may not be related, but no problem. But for in-house research, your research work and business must be connected. Depends upon the period in which research expenditure is incurred. If we can divide it into two parts, pre-commencement period research and post-commencement or current year research. Pre-commencement period research means prior to the date of commencement of business. Prior to date of commencement of business, preceding 3 years. 3 years, that is known as pre-commencement period. During that 3-year pre-commencement period, you carried out any scientific research, all the revenue expenditure as well as asset purchased for that in-house research, you can claim it as deduction. So one of the biggest advantage of in-house research is capital expenditure is allowed. Building, plant and machinery, furniture and electrical fittings for research purpose purchase, no need to go to 32, no need to claim depreciation, entire cost can be claimed under section 35, just like 35 AD. Full cost is allowed in that year itself. But regarding pre-commencement period, remember, we are not commenced business. So all that 3 years pre-commencement period expenditure should be accumulated, and in the first year in which business commences, you can claim it as deduction. What is current year? Current year means even after commencement of business, you cannot stop the research. It's a continuing process. So research will continue. So after commencement of business, every year, the expenditure incurred for research, you can claim in concerned year as current year expenditure. So that is current year research expenditure. Whether it is pre-commencement or in current year, remember, land cost is not eligible for deduction under the income tax law. Cost of the land is never allowed as deduction in any of the provisions of the tax law. There are total 298 sections. Anywhere, land cost is not eligible, but building cost is eligible. So if you construct building for research, eligible, but land cost is not eligible. All other capital expenditure eligible. During the pre-commencement period, perquisites given to research staff is not eligible. Pre-commencement period only. Post-commencement period, you can give research staff any perquisite, no problem. Pre-commencement period, perquisites given to research staff is ineligible. All other revenue expenditure and capital expenditure except land eligible. And what is post-commencement? Post-commencement means current year expenditure. Again, revenue expenditure and capital expenditure is eligible. Land cost is not eligible. Perquisites also eligible, no problem. While claiming scientific research expenditure, there is two elements, revenue and capital. First, we should claim revenue expenditure. After claiming revenue expenditure, the profit is 5 lakhs, for example, 5 lakhs. We claimed revenue expense, but now we have to claim capital expense like plant, machinery, equipments, etc. purchased for research. That is 6 lakhs. Profit is only 5 lakhs. So 5 lakhs minus 6 lakhs, negative 1 lakh. Don't call it as business loss. It will be called it as unabsorbed depreciation. It will add it to that. So unabsorbed depreciation total, there are 3 family members. One is pure unabsorbed depreciation, that is subsection 2. Second one, unabsorbed capital expenditure on scientific research. And third one, unabsorbed capital expenditure on family planning for corporate assessee under section 36. Family planning expenditure under 36, 5 equal installments, that 1/5. If due to inadequacy of profit cannot be absorbed fully, that deficiency, similar to unabsorbed depreciation, will take it like that. So total 3 items. So usually we know unabsorbed depreciation, that is subsection 2, but remember, there are 2 more items to that family. Unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure installment on family planning under section 36. All these 2 will be treated like 32 subsection 2, infinite period carry forward. Even though return is filed belated, you can carry forward, can set off against any head of income. All the privileges of unabsorbed depreciation available to this. For a capital expenditure, that is asset, purchased for 35, deduction claim, and after that sold directly. selling price or original cost, whichever is lower, deemed profit. Over and above original cost, capital gain. Didn't solve it directly. Research asset is converted into block of asset. Actual cost is nil, 0. So this is a subsequent treatment of research asset for which reduction is claimed. So this is section 35. In-house research can be claimed by any assessee. Even though you are opting for concessional rate of taxation, you can claim in-house. All assessees it is available. Donation, not available for default tax regime BAC. If assessee is individual HGF, AOP, BY. If it is a company and company opted for concessional rate of tax under section 115 BAA or BAB, not available. So if the assessee is coming under regular provision, not opting for concessional rate, donation can be claimed. Total 4 type of donation. One is donation given to an Indian company. The main objective of that Indian company is scientific research. We can claim as deduction under section 35. And second one, research association. The main research objective of research association is social research or statistical research. Eligible. Third, donation given to IIT or national laboratory approved under section 35 2AA, eligible. These 3 are very specific. Indian company, main object, scientific research, approval section 35 1 2A. That's Indian company. The DONI organization is Indian company. Second one, it's not a company, it's not an institute, it's a research association. Social or statistical research is the subject, not normal applied sciences, not technical sciences, social science. Then IIT or national laboratory. Okay, other than these 3 specific, any other institute approved under section 35 like universities, colleges, etc. If it is approved, that is also eligible. So that donation can be claimed as a deduction, but we can claim deduction only if the DONI organization filed a prescribed statement that we received this much donation from these persons. They have to file a statement in income tax, and income tax department will cross check, then only the donor will get the deduction. If the DONI organization did not file the prescribed statement, deduction will be denied to the donor. Deduction with respect to donation given by the assessee to any research association only if they are filing a prescribed statement and issued a certificate to the donor. Usually they have to file the prescribed statement at least before September 30th. That is at least 1 month before the due date for filing ITR. They have to file the prescribed statement, then only we will get the deduction. Earlier there was no control mechanism, so people are simply putting donation to research and they are claiming it. So now it's cross checking, right? Similar to chapter 6A. If you are claiming 80C, we have to give the policy number, right? If we are claiming 80D, we have to give the health insurance policy number. If it is a disability, we have to give the specialist doctor's license number, right? Immediately the system will correlate, right? They will check. So similarly like that, a control mechanism is there. So malpractice is not possible. Once we claimed deduction for scientific research and subsequently solved it, treatment we already studied, original cost or sale value, whichever is lower, deemed income. Business income 41, deemed profit. Over and above original cost, capital gain. But if the research asset is not selling directly, but we brought it in under block of asset, actual cost must be taken as 0. Okay, this is section 35. Remember one important point, if the assessee is going for section 115 BAA or BAB or BSc for individual HGF, etc. BAC, donation not allowed. But in-house research still possible for all assessees. Donation only is prohibited. The second item we are studying under PGBP, not available for concessional rate of taxing assessees. One is additional depreciation and second one is donation to research association. Okay. So tomorrow 9:30. If you have any doubts, you can ask. Okay. Everybody? Fine. Anybody is writing in May 26? Okay. Later we will put some amendment videos, right? That you can incorporate. Workbook will be new. Solved on assessment date 26, 27. new. Workbook only will be new. For notes, amendments will be added and separate amendment will be. And for you, this Jan 26, okay, suppose bad luck, didn't get it. Next year, 26, you have to finish it. Otherwise, May 27 onwards, Income Tax Act 2025. Every section number will be changing. Conceptually, not that much change. Changes are there, but the big problem is we cannot correlate section numbers. Especially for you, because you studied old one, right? For a new student who is studying intermediate at the Income Tax Act 2025, he does not feel any difference. But for we studied old, and for the transition, it's very difficult, right? We cannot even write a single section number. That will be the problem. It's very difficult because a lot of section numbers has been totally changed. Chapter 6A, everything is put in schedules, EDS in schedules. So it's completely different. It's very difficult to cope up. So you have a lot of time, no problem, but as earlier possible, try to clear in Jan 26. Last time, the exam was easy. Don't expect like in January. Okay. The September 25 exam was easy. I saw the question paper yesterday. It is easy. Simply they can score 50, 60 marks.